pause today. Jay Powell making it clear that the decision to hold today is based on how far we've come. Take a listen to some of the other comments that he just made at that press conference.
Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
The chairman of the Federal Reserve speaking just a little while ago, a little bit earlier today. Bloomberg opinion columnist Bill Dudley said that there were going to be 5 key things that he was watching in today's Fed forecast, including will there be another rate hike this year? What's the outlook for unemployment? How low can unemployment go without stoking inflation? And what's the neutral Fed's funds rate? And when will rates start coming down? Now that the forecasts are out, let's bring in Bill Dudley, joining us right now, former New York Fed president, former vice chair as well, and over at Princeton University Senator for Economic Policy Studies. And let's start with the neutral rate, because this seemed to be one part of the press conference where he seemed to struggle a little bit in articulating exactly how they're going to assess when they think they've finally arrived at that rate.
I think the message of the meeting was basically 2 things. Number one, soft landing is more likely because you can see the unemployment rate only has to rise now to 4.1% to get the job done. Back in June, it had to rise to 4.5%. And number 2, economy stronger than expected, and therefore, while policy is probably not as tight as we think it is. So there have been a little bit of an upward movement in people's estimates of the long-term federal funds rate in this summary of economic projections, first in June and again this month. So what basically the Fed is concluding is maybe monetary policy is not quite as tight as we think it is, but they're also very, very happy about how the labor market's unfolding. They basically think a soft landing is more likely. Quite a bit more likely. I'm a little surprised by the market reaction. I think the market reaction should be bond yields up because the Fed's going to be tighter for longer. Stock price is sort of mixed. Higher bond yields weighing on stock prices, but more chance of a soft landing. That's a good thing for stock prices. So I'm a little confused by the market reaction.
That's interesting. You mentioned the stock market reaction, because one point you make in your column today is that keeping a rate hike in the forecast, you write, has the tactical benefit of restraining markets, which might otherwise decide that we're done and generate an unwanted easing in financial conditions. Bill, you've been in the room before during these discussions. How mindful are policymakers of the market's tendencies to immediately make assumptions off of each clue that's dropped?
The market's always searching for what the Fed's going to do from anything, from the statement, from press conferences, from speeches. So I do think keeping one rate hike in the forecast does sort of, keep the market from running away from the Fed. But as Chair Powell mentioned in his press conference, it probably doesn't really matter that much at the end of the day whether they do that rate hike or not. It's not like the economy is going to turn around dramatically if the Fed does a quarter point more or a quarter point less. I think the way he's trying to explain why they might do another quarter is to make themselves more confident that they're going to achieve their objective. So let's imagine the data is sort of ambiguous as we go through the next couple of months. So if it's ambiguous and the Fed's not really sure that they're actually going to achieve their objective in a timely way with the current level of rates, you do one more rate hike to try to increase your level of confidence. So at this point, it's not really about, do they have to go another quarter or not? It's really more about would going another quarter make them more confident that they're going to have the outcome that they seek.
And Bill, beyond whether or not they're going to hike one more time or not, I think it was interesting that they actually took a few cuts out of next year's forecast. When you think about the expectations for 2024, what should we read into that? Is that the soft landing perhaps coming into fruition, or should we take that as maybe inflation is going to continue to be a problem here?
Well, they didn't really change the inflation trajectory very much. So I think the way I view taking the rate cuts out is the fact that the economy is just stronger than expected. If the economy has more momentum, I don't need to support the economy as much with rate cuts. So I think that's really the message, because the inflation forecast didn't really change in a meaningful way.
We're in conversation right now with Bill Dudley, Bloomberg opinion columnist, and of course a former chair of the New York Fed. I want to bring into this conversation our very own Michael McKee, our chief international and economics correspondent here at Bloomberg, who actually wants to participate in this conversation. Mike, take it away.
Yeah. Well, let me tell you what I take out of this press conference, and then I want to ask Bill what he thinks, because he's the central banker, and he has a much better idea than I do of what they're talking about in the room. But it seems to me that there's a bit of an internal inconsistency in their forecasts, in that they've more than doubled their growth forecast. They significantly lowered their unemployment forecast, and yet inflation is supposed to come down. So are they saying at this point that the stronger growth we've seen is not inflationary? And my takeaway from that would be they're done, but they're leaving that extra rate increase in before the end of the year as an insurance policy. And the same sort of thing holding true for the cuts they took out last year. If the economy were to produce inflation, then they have something in there that they can point to the markets and say, we did this. Bill, is that kind of the way people should take this?
I think that's the way people should take it. I mean, I think it's very interesting that before they had the unemployment rate going up to 4.5%, now the unemployment rate only has to go up to 4.1% to do the job. What that's telling them is they're taking quite a bit of signal of the fact that the labor market seems to be getting to better balance, even without the unemployment rate rising very much. So they're more confident that the labor market can essentially normalize on its own, that the Fed doesn't have to generate as much slack in the labor market to get inflation back down to 2%. So, and Chair Powell talked about the increase in labor force participation. He talked about the fact that the ratio of unfilled jobs to unemployed workers has come down. So they're taking quite a bit of positive signal about how the labor market is developing.
Well, if the economy develops ambiguously, as you say, over the next couple of months, would you be surprised if they raised rates again?
I think at this point they probably think that they will not have to, but they know that if they're going to move in one direction or the other in the next few months, it's definitely a rate hike, not a rate cut. So I think it's going to depend on how the data unfolds, and as the press conference. There's a lot of discussion in the press conference. There's a lot of shocks hitting the economy right now. Government shutdown, auto workers strike, the beginning of student loan repayments, oil price shock. So I think the Fed may not actually have the government data in terms of the economic releases if the government shutdown goes on for any length of time. So I'm going to be very surprised if they hike in November, and then we'll see where we are at the December FOMC meeting.
Yeah, we'll see where we are, and that's something that Powell made extra clear. They're going to proceed carefully, cautiously. Bill Dudley, thank you so much. Bill is Bloomberg opinion columnist, senior advisor to Bloomberg Economics, and of course, the former New York Fed president. And of course, our thanks to Bloomberg's Michael McKee in Washington. Here in New York with us right now to continue the conversation after the Federal Reserve policy setting meeting is Torsten Slok, partner and chief economist at Apollo. It's so good to see you here in studio today. Did Jay Powell come across to you as hawkish or dovish?
Well, I think the clear signal they want to send here is that we need to slow this economy more down. I mean, they could have decided to hike rates today. Obviously, that was not market expectations. But I think this was a very hawkish pause. I mean, the whole communication, the way that the statement was written and changed, and what he said at the press conference, it clearly signaled that we can allow ourselves to keep rates higher for longer, and taking 2 cuts out of next year, by definition, means that rates will be higher for longer. And the fact that, as Bill Dudley just mentioned, the fact that this is happening without any increase in the unemployment rate today is 3.8. And now they see it going up to 4.1. That's really almost a rounding error. So saying the labor market is just not going to change in their forecast, that is quite incredible, in particular when they at the same time say we're worried about inflation. And they're really saying we're worried about inflation being too sticky, and therefore the risk that inflation might not come down to 2%.
Well, Torsten, seizing on the idea that higher for longer is really the takeaway from this decision, from this presser. I want to go right to your notes, because you wrote before the decision that rates and therefore the cost of capital are going to stay elevated for another 9 to 12 months, and credit and equity investors should plan accordingly. What should that plan look like? Because I look at the equity market this year, I see it double digits higher, look at credit spreads, and they're pretty tight.
I know, but what's going on, and he was asked about this also, is that you're seeing both for consumers and for firms, higher interest rates or higher cost of capital are beginning to bite harder and harder. We're beginning to see delinquency rates going up for consumers on credit cards and auto loans. We're beginning to see default rates going up on high yield. if we are going to keep rates at these levels for another 9, 12 months, we should be extrapolating the current lines for what's going on with delinquency rates and default rates. And that runs the risk, in particular in high yield, where default rates are now up to 4.3 in the data for August that just came out, that could continue for the next 6, 9 months. And that's then going to open up a risk that if we begin to see the cost of capital bite harder and harder on companies every single day that cannot either get a new loan or refinance an existing loan, we begin to run the risk, of course, that we'll begin to see more companies defaulting. And on the consumer side, more people falling behind on their payments. He was asked about, are you worried about delinquency rates going up for consumers? And he said, oh, this is just a normalization. But I think the important thing here is, why is it normalizing? Because interest rates have gone up. So I do think that high interest rates are biting both on consumers and on corporates, and they're going to allow that process to continue now for potentially even not only the next 9 to 12 months, but maybe even the next 18 months, because they're going to keep rates higher. And I think that process is exactly what I would call the crystallization of the transmission mechanism of monetary policy, trying to slow the economy down gradually more and more. And that's the process that we're seeing across the board, both for consumers and corporates.
And Powell really did make that correlation, maybe not explicitly, but as explicitly as we're ever going to get out of a Fed chair, when he did talk about this idea that if the economy strengthened or did perform better than what was already in their projections, then we were going to get more hikes here. So he's basically sending that message loud and clear that at least the economic activity we're at right now, that might actually be the baseline, or I should say maybe the top line.
Absolutely, because think about it in credit markets. We are every single day when interest rates and cost of capital, as Katie has just highlighted, are at these high levels. This is having real implications. There are real firms that need to roll over loans. There are real firms that need to think about, do they want to have a new loan? And if the cost of capital stays at these levels for another year, that means that for the next 3, 4 quarters, we are likely to see the increase in default rates, in particular for lower rated companies in loans and in high yield, continue to slowly grind higher. And this becomes a difficult process to manage for them, in particular if this starts to spread. Remember, there's about 11 million people who work in the companies that are high yield issuers. So that means that from a total employment perspective, there's potentially a lot of people in the high yield industries that are at risk of losing their jobs if this default cycle continues.
I'm curious, when you looked at the SEP numbers today, the economic projection numbers today, are they pretty much in line with your own outlook?
Yeah, I would also expect the summary of economic projections, as it said, that things are still okay for now, but they are projecting, and that's also what I would expect, that's also what the consensus is expecting. They are expecting that things gradually continue to slow down. Remember, they have 2 goals, of course. They have inflation and they have employment, and you need to have a soft landing, not only in inflation, we are well on track there, but we also need a soft landing in the labor market. And the fact that they are almost saying that we have almost achieved a soft landing because the unemployment rate is very close to the end goal where they think it will be in 2 years, that's saying that we can get inflation down with no implications for the labor market. That would be quite remarkable when you at the same time think about how companies, as we speak, are seeing default rates going up, in particular, again, for lower rated credits with higher leverage and lower interest coverage ratios.
All right, Torsten, really appreciate your time. Great to see you on set with that instant Fed analysis. That is Torsten Slok of Apollo. Meanwhile, you take a look at these markets. Stocks down, yields up. Bloomberg's Jess Menton standing by with a check.
Okay, Katie, Romaine, and Scarlett, taking a look at the S&P 500, the round trip it's made since the Federal Reserve first began raising interest rates in this cycle back in March of 2022. If you look in that span, the S&P 500 is up close to about 4% in that time frame. But also, if you look back where it bottomed in October of last year, up well over 20%. Actually around 23% at this time frame. But if you're looking at where things are trading today, not a ton of movement as stocks have been fluctuating this afternoon. Typically, historically, over the past 3 decades, the stock market, usually on Fed days, the S&P 500 does end flat. But going through today, there actually has already been 101 trading days since the last time the S&P 500 has seen a decline of at least 1.5%. So today would mark 102 trading sessions. That's the longest streak since 2018. So it's going to be interesting to see. Apparently, this wasn't necessarily the catalyst that investors may have been expecting to see a downward decline there, but something to definitely keep an eye on. Katie, Romaine, and Scarlett.
Jess, great roundup. Really appreciate it. And you know it's a big day because Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey is in the New York office, coming up from Princeton. And Ira, it was really interesting listening to Jerome Powell. He brought up real yields multiple times. Just to go through some of the headlines here, he said that real interest rates are, quote, meaningfully positive now, and also that they need to stay positive for, quote, some time. When you think about where real rates are right now, you think about 5-year real rates well above 2%. How much of a tightening impulse is that doing for the Fed?
Yeah, I think that the tightening and the real rate environment is exactly where the Fed wants it. So I think the question becomes is how long do they keep it there, and then what happens if, say, inflation continues to come down a lot and therefore real rates just are even higher, right? So one of the things that we looked at in a note this morning was where the market is pricing the expectation for the real Fed funds rate a year from now. And basically where the market's thinking that actually real rates are going to come down a little bit, because this morning anyway, or last night when I put the piece together, everyone thought that the Fed might, be cutting interest rates a little bit more than they think now, right? But I think that the fact is that the market still wants and still believes that the Fed is going to be able to hold the policy rate above inflation for at least the next couple of years.
One question I thought was really interesting was the question on the efficacy of rates, this idea that households and businesses that should be hurting more from the steady increase in rates have actually done okay, in large part because they locked in lower rates, either through 30-year fixed rate mortgages or refinancing before the Fed began raising rates. What did you think of Chair Powell's explanation about how just balance sheets are healthier than we might have expected?
Yeah, so he didn't mention this directly, but it all goes to the long and variable lags argument, right? So it's just a longer and maybe more variable this time, in large part because of what you just noted, right? A lot of basically the terming out of debt, both by the household sector and the business sector, and it's something that's basically been going on since the late 1990s. So this is a generational shift. It just means that it's going to take monetary policy longer to work. It's not that monetary policy won't work, it's just that it takes much longer to feed through the system. When 25% of corporate debt was in commercial paper and it was all 2 and 3 month CP, that affected the market immediately.
Yeah.
There's no more CP as a share of corporate funding, right? So it's not going to affect businesses and business activity as much now. But over time, you have less CapEx, right? Because maybe you're not willing to borrow a little bit more to do that capital expenditure that you would have. But again, that's a much longer, that's a 3, 4, 5 year type of activity rather than 3 months or a year.
All right, Ira, great to catch up with you here. Ira Jersey over at Bloomberg Intelligence, the chief U.S. interest rate strategist there, as we continue our special coverage of the Fed Decides here on this Wednesday afternoon. We continue to count it down to the closing bells as well, which are just about 14 minutes away. And Ira, we want to actually keep you here, Ira, if you can, before we let you go, because you're so good. We decided to ask you additional questions. And I do have one question here about the idea that how many people were betting on the steepening of the curve, meaning investors in the market. And when you looked at the dot plot and the economic projections here, do you think that's going to be enough ammunition to actually see a significant unwind in some of those bets?
Yeah, so I think that's actually one of the reasons you've seen some of the what we call bear steepening over the last couple of weeks, which is people thought that maybe the Federal Reserve was going to cut interest rates pretty aggressively next year. And because of that, you wind up with 2-year yields rallying a lot and 2-year yields much lower, and that was the interest rate, the steepener, and that was a consensus for a while. And I thought that for a little while too, although I backed off from that the last couple of months. So I do think that some of the move that you're seeing today are people saying, okay, well, look, if the Fed's on hold, 2-year yields aren't going to go down a whole heck of a lot.
I want to follow up on that too, because I mean we're something like 18 months from when we first started this cycle, and really close to 2 years when you consider when you started to try to jawbone the market. Your expectations when you go back maybe to late 2021, early 2022. Compared to your general expectations now here, did they shift meaningfully?
Well, yeah, of course, because we wound up getting much higher inflation than we thought, right? We were thinking that 10-year yields would peak somewhere under 4%. We've obviously peaked above 4%. The challenge with managing money and trying to determine where interest rates are going to go, particularly longer-term interest rates, it has to evolve, right? So getting direction right ends up being much more important than getting the magnitude right, because you can always stay in a trade longer if it's working than getting it wrong and getting stopped out or losing a lot of money, right? So we thought that yields were going to go up in 2022, right? That was a pretty consensus view.
Yeah.
But we thought again like 3.3%. Now it's 4.3%. I do think, though, overall, you have to think about for the longer end of the curve, are we near or at the peak of interest rates. And I think we probably are, but there is a big risk here because we've tested this 4.35% on the 10-year.
Yeah.
If we break through that, there's going to be a lot of stops where a lot of people like buying at like 4.25, but if you get to 4.5, those people are going to get out of that trade, and you wind up with a big spike in interest rates.
What would be the impulse for long end rates to go higher, for the 10-year specifically to reach 4.5? What would be the actual catalyst to drive it there?
Yeah, I think it would have to be a reacceleration of inflation. So basically CPI and the core PC deflator moving up a bit. And then as that occurs, basically even more shifting of expectations for what the Fed's going to do. So I think in order to see, a 5% 10-year, you probably need to have expectations of a 6% Fed funds rate or higher, just because the market is going to continue to think that at some point the Fed will cut interest rates. But if the Fed is still hiking interest rates, then you wind up having a significantly higher 10-year yield as well. So, another 50 basis points or 75 basis points of hikes by the Fed, that might get you close to 5% on a 10-year. Now, that's not our base case expectation, obviously, but that's probably the likely market outcome of that scenario.
All right, Ira, now you can go.
Thanks, Romain.
I think the Amtrak trains are back up and running. Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey there, helping us walk through not only his take here on those economic projections, guys, but more importantly, how the market might react should some of those projections get hit. And, of course, the big move today is in that 2-year yield, the most rate-sensitive part of, at least the main part of the curve here, up 7 basis points right now, 5.1587 and change.
The highest level since 2006. We also have the 10-year yield moving marginally higher. One thing that we were trying to figure out yesterday was the big move up in yields as well. And there are different reports, but Canadian CPI picking up, quickening in August after, it had appeared to stabilize, raising some concerns that we're going to see a similar reacceleration of inflation here in the U.S. because the Bank of Canada was ahead of us with the hawkish pause.
Yeah. And it's interesting, too. I mean, we talk about the equity market reaction. We're still around session lows here for most of the major equity indices here. And I was just looking at the S&P sectors, and basically what's leading it right now is consumer staples and healthcare and real estate.
And then you take a look at the NASDAQ 100, your big tech names. The NASDAQ 100 off by 1.2%. I thought it was interesting. It was Bill Dudley, right, who said that, okay, if you take a look at what the expectations are, rate cuts coming off the table next year, shouldn't stocks be higher?
Yeah, he was puzzled by that for sure. I mean, big tech is, so, maybe that should lift the markets overall. Let's not forget that we do have earnings coming out after the bell.
Yeah.
There's still corporate news, and FedEx will be reporting. We'll be all over that.
Yeah, we're going to get FedEx, and I see you got Klaviyo up there. Its debut here on the day. Let's continue this conversation right now as we count you down to the close. Jeffrey Rosenberg joining us right now, BlackRock portfolio manager of the Systematic Multi-Strategy Fund. And Jeff, I just want to get your take right off the top here. When you heard the commentary from Powell at the press conference and kind of the back and forth with regards to where rates might be, where the neutral rate might end up here, this seemed to be just once again him trying to work that magic on the market and keeping their expectations in line with the Fed's expectations. Do you buy into it?
Well, I think that, most of the action in this meeting, comes from the statement of economic projections. And as Powell, tried to lay out, that's not part of the committee's deliberations. It's not a plan, but it is really, the signaling of each individual participant's, expectations. And so that was really the dominant story. And so Powell had to kind of navigate that. But I think it was a story that he wanted to tell, particularly in showing, higher or restricted for longer in terms of the 2024 dot. The 2023 did not have the decline. So overall, it preserves a lot of policy flexibility to become less restrictive over time. And I think that's the easier path for Powell to have taken. And I think that's probably a good outcome for him and the FOMC today.
Less restrictive over time would suggest that current policy is sufficiently restrictive. And I fixate on that clause, that phrase, because that's a qualitative, not quantitative judgment, isn't it? What does sufficiently restrictive mean in the current context? Is it a moving definition or range, or is it a fixed target during this rate hike cycle?
Yeah, and as you saw, there was a lot of discussion and a lot of questions on that. And I think the answer is sort of you know it when you see it, which is that the policy rate has the impact on the data, on the economy, and most importantly on inflation that they're expecting. So, most of the forecasts that were written down today, and most of the market forecasts basically say the Fed's going to have success here on inflation, and so therefore we're sufficiently restrictive, and we're about to move the discussion to, are you too restrictive? What about cuts in 2024? Why did you take 50 basis points out of the cuts in 2024? But that may be premature. It's basically, counting your chickens before they've hatched in the form of, we're expecting that inflation decline. And if we don't get that expected decline, that's going to be a bigger surprise. Noting that, we've had a lot of failures in the consensus forecasting around inflation. Now it's too benign. Now the market is too complacent around the expectations that inflation will go back down to its pre-COVID level. I think that's where the surprise in the forecast may come from. But right now, there's pretty good consensus both at the Fed, in the SEP, and in the market that inflation has been won. The war on inflation has been won, and it's just not as Powell laid out. And part of the Q&A, now it's more two-sided and trying to secure that soft landing that is so much in the consensus, and I think is also reflected, partly in these SEP forecasts as well.
So, Jeff, how high is the hurdle for a rate hike in November? And he himself said that, it probably wouldn't do anything for the economy.
Yeah, I mean, as he said, and I think it's right, one more hike here is not really the make or break story. The story is really that they're going to be high for longer, restricted for longer. We're pretty much at the end of the hiking cycle. Whether there's one more or not, very much depends on how strong the economy is. And as he highlighted, the change from the prior forecasters really about the strength in the economy, contributing to people's unease about how quickly they had penciled in cuts in 2024. So that's really going to be the story here going forward is, does the strength persist? Does inflation not fall as much as forecast because of that strength? And the Fed actually needs to do more or hold at the higher rate. Well, both needs to do more in the form of one increase, but then hold at that higher rate for a longer period of time into 2024.
And Jeff, I'm still stuck on Chair Powell's comments on real rates, these meaningfully positive real rates. And just to recap what we've seen so far in 2023, you have 10-year real yields up about 45 basis points. You look at the S&P 500 up about 15% so far this year at the moment. I know that AI is very exciting, but when does the U.S. equity market start to respect what we're seeing in the bond market?
Well, the discussion on real rates is very interesting because, both you have an increase in kind of the projected real rate into 2024 with the 50 basis points of cuts in nominal rates being taken out at the same time as you basically maintain the inflation rate decline. Yet the discussion also brought about the longer run estimate and effectively the discussion on, what is the real neutral rate? So, right now, estimates for the real neutral rate imply that these are very high and therefore restrictive real rates. But there is this possibility, and Powell talked about it. He admitted that, the resilience of the economy might point to the fact that your neutral rates are indeed higher, that post-COVID structural changes have led to that. And, that will be the kind of historical reckoning of this tightening cycle, that if real rates indeed did go up, that we actually weren't as tight as as we expected in real time. And that might explain the lack of the inflation decline down to the 2% level. Sort of the easy parts of inflation declines are behind us. The hard part is ahead of us. And whether we achieve that as easily as these forecasts in the SEP are implying very much depends on whether or not these real rates are as tight as we think they are today.
All right, Jeff, going to have to leave it there. Jeffrey Rosenberg over at BlackRock. He basically made it clear here, guys, that I thought he used the phrase here, the hard part really is here. And I just want to quote something. Enda Curran, one of our Bloomberg reporters here, wrote something great in the live blog that we had. He basically said it's clear, in his words, it's clear the Fed is now in a much more, quote, complicated judgment territory than it has been. And he goes on to talk about this idea that when you go forward, these next few meetings, it's going to be insane.
What do they say about script writing, that the third act is the hardest?
I don't know. I've never taken a script writing class. What are you doing in your free
Maybe I
time?
revealed too much about myself.
Yeah, what is the script about?
You think about how close the finish line is.
Does it involve me and Scarlett?
No, it's all about the Fed, actually.
Oh, is it?
Yeah,
Okay.
basically, and how hard it is, their path forward.
Hold that thought, Katie Greifeld. We're moving closer to these closing bells. Our full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld and Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast with our friends Carol Masser and Tim Senovic. Welcome to our audiences across all of our Bloomberg platforms. Here on Fed Day, of course, the big headline, guys, is the Fed holding rates here at the September meeting, but making it clear in those projections that it expects rates to be higher for longer into 2024 and beyond.
Right. And it looks like, Romaine, that the Treasury trade certainly got that memo and that note and that message very clear. Your 2-year note now at 5.15. I mean, we're at the highest in since 2006, I believe. So we've really seen kind of a bit of a reset again. I feel like this week it's certainly on this day when it comes to rate expectations. And we just talked with Larry Pitkaski over at Good Haven, and he said, I love what he said. I think we're in a higher rate, risk-free environment without existential worry. So in other words, higher rates for longer, get it, but maybe without some big risks.
But here's the thing. When you look at the summary of economic projections, how can you know what's going to happen in 2024? How can you know what's going to happen in 2025? It's you really, as Yelena Shaleatova over at BNP Paribas told us, you have to take anything beyond this year with a giant grain of salt. We just don't know what's going to happen.
So Scarlett, should it not be considered a plan then?
He was very clear that this was not a plan. These are the median, the average forecast among, all these different participants who submitted their numbers. And by the way, economic forecasting is very difficult, guys.
I've heard that before. I heard that today, actually, from Fed Chair Jay Powell.
I mean, not if you have a crystal ball. I don't know. Do you guys not have one?
Yeah, we don't. Let's walk you through the market numbers here. We've been talking a lot about the macro, but it was a pretty busy day for equity markets. Obviously on pins and needles about the Fed, but of course you had an IPO today in Klaviyo, and not necessarily the best trading day for Instacart and ARM once again. The net effect of it all is the Dow Jones Industrial Average lower by about 0.2%. The S&P 500 giving back almost 1% on the day, or roughly 41 points, a close right around that 4,400 level, a key technical level there. The NASDAQ Composite down about 200 points, or 1.5%, while the Russell 2000 looks like it's going to finish out the day lower by about 0.9%.
All right, and quick look at the S&P 500 in terms of the names, about 173 to the upside, 328 to the downside. So certainly more of that risk-off trade, no doubt about it, and 2 unchanged, Scarlett.
Yeah, volume also slightly lower than the year-to-date average. Let's look at the sector performances here for the S&P 500. It was a down day for the major indexes, as Romaine told us, but there are some sectors that did finish higher, including telecom names, healthcare equipment, and food, beverage, and tobacco. So you're seeing a lot of those dividend plays, those safety plays come out ahead. On the flip side, you've got a lot of those big tech names, media, entertainment, semi and semiconductor equipment companies, and tech hardware, along with software and services, all leading to the downside, all down by at least 1.5%.
All right, a little nervous, making sure that my gainers actually held on to their gains, but let's go to it. Klaviyo, right? The IPO. It's been a big week.
Not all of them did, Carol. Can we just get rid of that fourth one?
Darn it, gosh.
All right. Can you just block out her box?
Wow.
Again, I'm here. I can hear this. All right, so Klaviyo up about almost 32% at its highs today in its first day of trading as a public entity here, finishing up though with about a 9% gain. It was oversubscribed nearly, I think, 30 times. So, it's interesting. Limited supply, another one of those kind of IPOs, but nonetheless, a gain, but lost a lot of that momentum that it saw earlier in the session. Pinterest, I want to go there because it's been on quite a 2-day rally, up another 3%. It gained 3% yesterday. Analysts were impressed by Tuesday's Investor Day, saying that the social networking company was upbeat and that the long-term targets look achievable. It's up roughly about 12-13% so far this year. And then Enphase Energy, once again, rallying up 4% yesterday, up another 1.5% today. News Monday, late Monday, after the close at co-director Thurman Rogers bought about $4 million worth of shares. It's the only news I could find, but it looks like still some momentum. Still down more than 50% year to date, and you got about 8% of the float shorted. Initially, a lot of other solar names were higher, which meant the Invesco Solar ETF was up almost 2% at its highs today, but finishing with a decline. of 0.1%. So over to you, Mr. Decliner.
Handing it off to me.
I am.
I'll take it. I'll take it. Let's talk about some of the stocks that moved lower on the day today. In the S&P 500, mega cap tech declining after the Fed's higher for longer message. Apple among the worst performers on a points basis in there. Microsoft there as well. Nvidia, Alphabet there as well. We should note that Dow Jones also reported a note from UBS's David Vogt that questioned demand for the Pro version of Apple's new phone, saying demand was not as strong as it was for the Pro models last year. And then Zebra Technologies, the worst performer on a percentage basis in the S&P 500, down 6.5% today. It's a company that makes barcode scanners, interactive kiosks, and more. Got downgraded to underweight from equal weight at Morgan Stanley. Morgan Stanley analyst writing that the pace of recovery at the consumer electronics company will likely be slower than expected. And then let's check in on Maple Bear. That's, of course, Instacart. The price for that IPO was $30. It closed today just above that IPO price. Yeah. So hung on to that, but still down 10.7% today. This after raising earlier this week, $660 million.
And the do you know why it's Maple Bear?
No. Oh. Well, anyway.
Oh, do we have something more important? Let's go to something more important.
Well, something more important, I would say, is the bond market. Yeah. I know there were some interesting single stock stories, but on Fed Day, of course, we got to take a look at what's happening across the Treasury curve, all the action in the front end. As you can see there, you have 2-year yields managing to rise 6-7 basis points, 5.15%. That is the highest 2-year yield since 2006. You go out the curve, not as interesting. You have 10-year yields. I'm going to call that unchanged. Your 10-year yield about 1 basis point higher, 2 basis points higher, 4.37%. That curve back to inverting rather at about negative 78 basis points remain.
Yeah, we actually still getting some earnings, believe it or not, here. That's kind of the last stragglers from the past quarter. FedEx out with their numbers here for their fiscal first quarter. Revenue coming in at about $21.7 billion. That's a smidge lower than what the street was looking for at $21.84. But operating income does look like a pretty solid beat at $1.59 billion versus a street estimate on average of about $1.34 billion. Here's your forecast here. The company basically saying that it sees full-year adjusted EPS at $17 to $18.50 a share. The previous guidance it gave was $16.50 to $18.50, so effectively just raising the lower end of that range by about 50 cents. You can see the price reaction there, the knee-jerk reaction higher by about 2%.
And of course, when it comes to FedEx, what's notable, of course, is how it stands in contrast to UPS. UPS had to give big pay raises to its workers who had threatened to strike. FedEx, of course, is has been cutting costs and has been doing that. And the CEO says that they're well positioned to deliver, or they've started fiscal 2024 with strong momentum and are well positioned to deliver improved profitability. So kind of just putting that out there and reminding everyone.
Yeah. They're not apples to apples when you look at FedEx and UPS. We often talk about their different models, but man, investors have been really sitting up and taking notice of what FedEx has been doing in terms of transforming the company. I mean, it's up more than 40% this year. You've got UPS down about 9%. There, of course, have been, concerns with the striking, strikes and so on and so forth. So very different stories for these, but it really does feel like Wall Street investors have taken notice of what the changes they've made.
But it's interesting, too, to look at this report as well as a couple of the reports and to sort of tie that into some of the questions that Powell was peppered with here. This isn't a revenue growth story. I mean, this is cost cutting. And I think this is the fear that a lot of investors have that, that's great in the short term. It gets you through the quarter and it bolsters the stock price. But how much longer do we go like this, particularly if you do believe that rates are going to stay higher? Yeah, the press release, Romaine, literally spells that out. It said that first quarter results improved primarily due to the execution of the company's DRIVE program and a continued focus on revenue quality. But, and this is a big but, the improvement in operating results was partially offset by ongoing demand weakness. That's the thing. I mean, it's you can cut costs. No one's poo-pooing that, right? But you can't sort of cut your way to prosperity, more or less, right? And you sort of wonder what the strategy is for FedEx. And we don't want to just pick on FedEx here. A lot of other companies are in the same boat as them. Other blue chip companies are in the same boat as them. And I wonder if that's sort of the next thing that the Fed really has to be mindful of. We've so focused on the consumer and the homeowner, but we forget there's stresses out there for businesses as well.
But maybe against this backdrop, that's good enough. And you can see that in the share reaction after hours, FedEx shares up 2.5%. To your point that, I mean, that's not necessarily growing, that's cutting costs. But you think about some of FedEx's peers, maybe cost cutting is good enough to make it stand out.
Well, and sometimes you have to clean house, right, to get to a better business strategy or business equation. I do also want to mention that, and could be another reason why the stock is popping. Company expects to buy back an additional $1.5 billion in shares during fiscal 2024. We see companies doing that a lot, when they've got some excess cash. Again,
so $1.5 billion to buy back the stock.
Right.
Not into CapEx, not into the business.
It's not building the business.
Okay, got it.
Paying workers, whatever.
Okay.
But it allows you to buy time while you wait for things to recover, right? I mean, Jay Powell made it really clear that the economy is doing better and holding up better than a lot of people anticipated, certainly than the Fed anticipated. And so demand might be more muted than it was before the rate hikes, but it's held up for the most part.
No, you do wonder, right? You can't cost cut your way to, a really strong company, but you can certainly make investors happy maybe for a little while. So more to come, certainly, on that story. Guys, that's a wrap. All right, that'll do it for our cross-platform coverage.
Happy Fed Day.
Happy Fed Day.
Good to see 5 of us.
Yeah.
Did Tim say big butt before?
No.
He did. You did. It's
On
a
what?
big butt. You said that.
Oh, okay.
Sorry.
Maybe I did.
I know. I'm being like an 8-year-old again. That's a wrap. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. We will see you again tomorrow.
Stick with us. A lot more coverage coming up here on Bloomberg Television, a reaction to what we learned out of the Fed today, a reaction to what we learned in markets as well. David Balin from Citi, John Taylor from Stanford University, and Raghuram Rajan, former India Reserve Bank governor. All that and more coming up in just a bit. This is Bloomberg.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
A down day for equity markets, an up day for yields, the most severe price reaction, the most severe volatility, of course, coming right around the 2 p.m. mark here in New York when the Fed released its decision. The big thing, though, the big takeaway, though, that we learned from that press conference, from Jay Powell, and from those economic projections is the idea that the economy has held up way better than what the Fed had originally projected when it embarked on this rate tightening campaign about 18 months ago. And so, too, did the market. In fact, the S&P, while down about 0.9% on the day, believe it or not, actually is still hovering just slightly above the levels it was at in March of 2022 when the Fed started this rate tightening cycle. So a market that has been through a lot of ups and downs ever since then, but the net effect of is that it's held up and, more importantly, delivered for most investors some modicum of return. The Dow Jones Transportation Average slightly unchanged here on the day, while we did finally see a pullback in the oil markets. We saw a pullback in gold, and we saw a bid come back into the dollar. That's basically the cross-asset story right now, minus what we saw in yields. But let's talk about what we saw in yields today. Of course, there will be a lot of talk about the 2-year yield hitting the highest level since 06. But quite frankly, most of the Treasury curve right now has been camped out at some of those levels that we've seen back in 06, 07, and 08. That includes your 10-year. That includes your 5-year here. A cycle right now that has us at these, well, let's just call it a cycle high, a generational high, if you will. But if you believe those economic projections and if you believe the words that came out of Jay Powell's mouth, these lines will continue to creep higher.
Yeah, I like the way you put that, generational high. Well, the Fed's ongoing draining of its balance sheet has also removed a backstop for a key corner of the funding space. And that is fueling volatility in the market for repos, repurchase agreements. For more, let's bring in Bloomberg's Alex Harris. I think we tend to forget that at the same time, there's still quantitative tightening happening. Why is this important?
Yeah, I wish we would have heard a little bit more about it in the press conference today because it is important. And especially if you think about it in the context of these basis trades, the whole foundation of a basis trade is you're taking a position in futures, but you're also taking a position in the cash market for treasuries. And those trades that leg gets financed in the repo market. So now if you're trying to finance basis trades and now you're looking for paper and it's not there and you can't go to the Fed and get more of it because they're backstopped, they're not holding as many treasuries anymore. This gets really expensive, and it makes for a very, very volatile repo market, more so than we already see just on typical periods.
But why don't you think that Powell is, at least publicly, doesn't seem to be as concerned about it? I mean, he only really mentioned this once on his own, and I think one of the questions that was posed to him on this, he kind of didn't really even answer it.
I think there's just so many wild cards when it comes to the balance sheet in terms of reserves. The key question when everyone talks about the balance sheet and quantitative tightening is this lowest comfortable level of reserves. What's the total number of reserves that banks need to be holding on to before you hit that point of scarcity, before the markets get volatile and we get something similar to a blow-up that we saw in 2019. And after March of 2023, after SVB and the other and the turmoil in the banking sector, nobody knows. And there was a senior financial officer survey that the Fed released in August. And they were saying that those levels are actually much higher than they were at the beginning of the year. So now the calculus has changed and nobody knows. And it's a big wild card. And I think if you're the Fed, you need to present confidence that this is going well.
But if you're the 19 members here on FOMC, or if you're the staff providing these reports, and you go into that next meeting, October 31st, November 1st, and you have to discuss this issue here, can't you make a case, and I think Powell used this phrase to some degree or another, of normalization, the idea that while there is some ructions going on in the market, it's kind of just taking us back to what, in his mind, where the market should have already been?
Yeah, yes and no. But again, it's like that risk of going too far. And that's what we saw in 2019. And I think that's what really has people concerned is when the Fed isn't quite sure of where that lowest comfortable level of reserves is, where that flat part of the demand curve is, that's what gets them scared. Because if they don't know, nobody knows. And then you risk running into, and creating this volatility and creating this turmoil. And then that causes an abrupt stop to their whole plan. So that means no rate hikes, because how do you communicate that you're stopping the balance sheet unwind while you're still raising interest rates? And communication, let's face it, isn't necessarily the Fed's strong suit in trying to work with these dualities.
Yeah.
All right, Alex Harris, great to see you. I know it's been a busy day for you.
By the way.
You do?
I think it's the best we've had in years.
You think he's doing a good job?
I didn't say good. I just said it's better than what we've had in the past.
He's doing a job. I agree with that. Well, let's ask our next guest that question. We have Andre Skiba. He is RBC Global Asset Management Head of Blue Bay U.S. Fixed Income. And Andre, come into that debate that we just had. When you think about what we heard from Powell and what we've heard from Powell really over the past couple of years, how would you rate his communication job?
Well, hello. Thanks for having me. It's been a difficult message because Fed is essentially telling you it's all going to be okay on multiple fronts, that growth will come back soon close to long-run averages, inflation will moderate, and unemployment will only tick up modestly. And there is a fair dose of awareness within the market that Fed's projections have changed dramatically every 3 months, quite a few times when you're looking at historical summary of economic projections. And what we could be hearing from the Fed 6-9 months down the line could be very different from the very benign message that we're hearing today. So there is a fair amount of questioning. Is it too good to be true in terms of the forecasts?
Yeah, and I think that question was put to Jay Powell as well when people kept pressing on this idea of a soft landing. What surprised me is that I think for the first time I heard him say that the soft landing or a soft landing is a primary objective for the FOMC, even though we know it's not part of its mandate. Do you get a sense that policymakers are getting ahead of themselves here in talking up the likelihood of a soft landing? New York Fed President John Williams recently said recession talk in the finance sector has basically vanished.
Look, there is some truth and validity to that concern, that how much are you locking yourself into specific outcomes, but at the same time, Chair Powell was careful not to say that that is their base case scenario. So that still opens the door to responding to changing economic conditions over the coming months and quarters. And at the end of the day, after so many hikes and also meaningful tightening of bank lending standards that is filtering through the economy, it would be really surprising to see everything proceeding very smoothly over the quarters to come. So saying that soft landing is not a base case scenario, we think that is appropriate.
Then when you measure up the market reaction today, and we'll see whether this actually carries over beyond just a couple of hours post-meeting here, but we talk about the direction of the yield curve right now, pretty much across the board. We talk about inflation expectations if you go out at least 2 to 5, 10 years, seem relatively grounded here. And of course, you had the big sell-off on the front end of the curve and somewhat sparing the longer end of the curve. What does that tell us?
Well, higher for longer seems to be the theme of the day. Doves did not get any interesting news from the press conference. So the market is adjusting front end of the rates higher, and the expectations for maybe middle of the year cuts next year have been pushed out to maybe July or September. And look, we will see how the data is evolving. It is very clear that the world can look very different 6 months down the line. So we should be open-minded to Fed adjusting communication further down the road. What was interesting, though, is how some of the FOMC members have changed their long-run rate expectations. So there's been this great debate about what is the R-star, what is the neutral rate, and is there a need for that to increase? And we have now seen the evidence in the summary of economic projections that the range of estimates has actually, the upper band has moved up. And Chair Powell has also admitted that it's a possibility that it's higher than Fed is currently forecasting. And when we're looking at fixed income universe over the coming quarters, how that debate is unfolding will also have meaningful implications for how risk assets are doing and whether people are taking advantage of the current high yields within fixed income or taking a step back.
Yeah, and it's interesting, too. We should point out a unanimous decision today, and we should point out all the meetings we've had going back to March 2022, all but 2 of them unanimous. Anjay, great to catch up with you. Anjay Skiba there over at RBC Global Asset Management. We're going to continue this conversation, our special Fed Day coverage, continuing with David Balin, Citi Global Wealth Chief Investment Officer and Global Head of Investments. That conversation coming up after the break. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
The Fed decided earlier today, and the decision was to leave the benchmark interest rate unchanged. The second pause in this rate hiking cycle, but Jay Powell, as well as those economic projections, signaling that another hike could actually happen this year, and he expects rates to be higher for longer through 2024, maybe into 2025. As to what this means for the global markets, let's get some insights out of David Balin. He's Citi Global Wealth Chief Investment Officer and Global Head of Investments. And David, the market today had the knee-jerk reaction largely to the downside here, at least on a price basis. When you look out a little bit further over the next few months as we try to sort of figure out where the Fed goes next, do you think market sentiment is going to be, I guess, somewhat commensurate with what we heard out of Jay Powell today?
When you look at the macro trends that underlie the decision that the Fed made, they're actually pretty positive, right? They increased growth rates for this year and for next year. They're talking about an economy that is essentially resilient. They're talking about earnings probably that are higher than have been expected. And so what they're talking about is an economy that's going to take a longer time to slow down to allow inflation to get to their target, 2 to 2.5%. So to me, the underlying economics, for the economy and for what earnings could be next year are actually pretty positive. From a rate perspective, what's happening is that you're obviously seeing, higher rates for longer. And if you think about what that does, is it makes investors much more likely to consider the possibility that they're going to consider fixed income more primarily, which is going to dampen what I think equities can do. So the net impact of this over the next year and a half, I think, is going to be pretty positive for equities, but it's going to take 18 months to see that come through.
Wow, 18 months. Yeah. So it's going to be, when you look at what's to come, are bond yields going to be driving equity prices then in the near term if it's going to take 18 months for things to filter through?
Well, we're going to see equities go up, I think, over the next year. Let me give you some sort of context for this. The context is that if you think about where we were at the end of 2022, we had been through one of the only 2 years in 100 years where you saw both bonds and stocks go down. In those last two instances, when you look 2 years later, the average 60-40 portfolio is up 20%. So it's possible, and I think it's likely, that we're going to see portfolios, 60-40 portfolios, do that by the end of 2024. So a combination of profits in fixed income as inflation abates, and due to the fact that equities themselves will actually appreciate as earnings actually rebound. 2025 could actually be the first normal post-pandemic year that we have, and I think that's what's going to play strongly into portfolios for clients.
All right, 2025, a year of normalcy, hopefully. And David, since we have you, I want to get your thoughts on some of the recent things that we've seen in the equity market outside of the Fed decision today. When you think about some of the huge IPOs that we've seen, huge by recent historical standards, what could this mean for the IPO market going forward and for the equity market going forward?
Right. So we just wrote a little bit about the fact that the IPO market reopening is a big deal. But it is not something that's going to take place with any great speed. There are several hundred companies that could go public. The valuations, with the exception of the semiconductor company, have been normal, market rates. But I do think the reopening is a big deal in the sense that it's going to drive investor sentiment, more positively. We see the market opening much more for IPOs in the next 6 to 9 months than we do over the course of the next few months. But in general, again, that's a positive thing. We need to see rates ultimately peak in order for the equity markets to really have, some more momentum. And I think the other thing that we should look for is labor, actual employment numbers going down. No one's really talked about the fact that the real Fed declines in interest rates are going to occur when we see labor, initially even more levels of employment dropping and ultimately going negative. The Fed has a great history of stepping in at that point and saying, wait a minute, we've got to support the labor economy. That data could be 3 months from now, could be 6 months from now. But with this level of tightening and with money supply actually negative, it's more likely than not that we're going to see a negative impact, to labor that people just are not anticipating in 2024.
All right, David, great to catch up with you. David Balin there, Citi Global Wealth CIO and Global Head of Investments. Stick with us. John Taylor up next.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
Romaine Bossack here with a look at how markets perform here on this Wednesday, a Fed decision day. And well, the decision by the market, it was very volatile here. Right around 2 p.m. Washington time, we saw a huge spike higher in Treasury yields, and we saw a huge drop lower when it comes to equity prices. That was the net effect overall, with the big drag coming from the tech space. The Philadelphia Semiconductor Index down almost 2% on the day. And as far as the Magnificent Seven, nothing really there to talk about today. All 7 of those stocks lower on the day, including Apple and Amazon down for a fifth day. In fact, Amazon now erasing all of its gains for the month of September here. You did see a slight uptick in the dollar. Finally, some perking up in the VIX index right now around 15 here. And a big stay for in the crude oil space. The net effect, though, was WTI pulling back by about 1% here on the day. That's the knee-jerk reaction here on this Wednesday. Of course, Scarlett, we're going to have to wait for the next few days and weeks to get a better sense here as to whether this price action sticks.
Yeah, but that was the knee-jerk reaction. And you look at those red up arrows, red, of course, indicating lower prices for treasuries, and the up arrow indicating the move up across the yield curve. And that is the picture here following the latest Fed decision and, of course, their economic projections as well. Let's bring in Bloomberg's chief correspondent, Global Macro Markets, Liz McCormick. Liz, you recently wrote that the dot plot, the updated economic projections would be a key decider for where the Treasury market goes next. What did you gather from this latest dot plot?
Yeah, I really like the dot plot today because I feel like the Fed out-trumped what we thought, because a lot of investors were saying next year what the dot plot shows, they thought they would take away one of the cuts because there was 4 signaled in June, but the Fed took away 2 cuts. So they kind of slashed in half how much easing they'll see next year. So, to me, now it's about, because, the Fed did signal one more hike this year, but whether they do it or not is kind of very marginal. But it's how long do they stay there? And the Fed seemed to really double down on it is higher for longer, and we mean it, and that's why, like Romaine was saying, there was a lot of volatility, but now both short and long end rates are up for the day.
So, Liz, you love the dot plot. I don't know if Jerome Powell necessarily loves the dot plot, but...
remember when he said he was going to kill the dot plot?
That didn't happen. You can't kill a good dot plot. But you made an interesting point before the camera started rolling, actually. The median long-run dot didn't change, but the average has actually been moving around a little bit.
I even brought my wonky papers
and highlights. Is this where you're going to explain us the difference between median and average?
And I was looking, the median. I did take statistics in my life, but I was looking, and even though the long-run dot is stayed at 2.5, that's the median that we look at, but the average, which our Bloomberg people are great to put out as well, did go up almost 10 basis points, to like 2.7, say 6 rounding from 2.66 in June, the last updates. And Chairman Powell even said that, there's a chance that that neutral rate, what we call the R-star, which some people look at that long-run dot as somewhat of a proxy, could be getting higher because the economy's been more resilient and other factors. So I see a lot of investors, that's what they're paid to do, kind of deep in the weeds saying, hey, that long-run dot may be moving. So we have less cuts coming in next year, higher for longer. And, think of the long-run rate for the Fed as kind of the base rate of a lot of policy. Mm-hmm. So if that's higher, that you've got to kind of nudge up rates in the Treasury market across the curve on that.
I'm curious about the market reaction, and we were speaking with your colleague Ira Jersey over at Bloomberg Intelligence, and I thought he made a good point here that even if we do start to see an uptick in yields here, is there some sort of threshold where then all of a sudden the market positioning sort of kicks in and then actually exacerbates that move?
Well, I think, one yield my colleague Mike McKenzie and I talk a lot about is 4.5 on the 10-year, right? That people thought, we couldn't get there. And there's a lot of people saying if we break 4.5, then that might be that trigger, because people keep thinking, we can't go that much higher. But then when they do, you start seeing stops triggered. People have to scramble out. And then you see that kind of rapid, those jump moves. So, I mean, I'm old enough to know, like, maybe 5 on a 10-year is not that high, right? So I think Ira's right that you have to watch. Things can go gradual until they don't, right? And you hit these trigger points.
Yeah, I think the more useful dot plot is they just took all those stops that the market has and just published those, made those public. Then we'd have a better sense of what's going on. Liz McCormick, chief correspondent for Global Macro here at Bloomberg. We want to keep the conversation going right now with John Taylor, professor of economics at Stanford University, senior fellow in economics at the Hoover Institution, formerly, of course, with the Treasury, and, of course, the creator of the namesake Taylor Rule. And, Professor, I want to start off here with this idea, this balance that I think Jay Powell is trying to create here, the idea of continuing here with the hawkish policy while still encouraged by a relatively resilient economy. And I just want to read you a quote here, because there were 2 papers that came out, one this month and one that was presented at Jackson Hole, and they both made the same case that, quote, the majority of disinflation has been driven by expanding supply rather than decreasing demand.
You want me to react?
I do.
Well, I think that's missing the point. You remember, it was just a little over a year ago. The interest rate was 25 basis points. So while we have come up quite a bit, it's still not quite all the way. I think I feel a little better if I did 25 basis points as well. But we went 25 basis points to 5.25, 5.5, and that's a good stuff. So I think that's what's happening. They signaled it, they were clear about it, but and it hasn't done the damage we were worried about.
Professor, I want to get your take on wages and how they fit in here. Do wages follow inflation, or do wages cause inflation? We know that the global economy has seen some big structural changes after the pandemic, and here in the U.S. we continue to have a relatively tight labor market. Is there any reason to expect wages to continue to cause inflation in the future?
I don't think so. I think it goes both ways. Sometimes it's inflation, sometimes it's wages. I think at this point, we have inflation, which is well above 2%. It's not 9.1 like it was a year and a half ago, but it's over, say, 4%, 3.5%. So we got a ways to go to get it down, and that's the main thing, which is affecting wages, and thereby affecting prices. So that's the main goal, and I think we referred to the Taylor rule for a few minutes ago. The Fed has recognized that. They're very close to it now, not far away at all, like they were a year and a half ago. So that's a good sign.
And let's talk a little bit more about the Taylor rule, because you have your own function on the Bloomberg terminal, TAYL, and you look at the current Taylor rule estimate, it clocks in at about 8.6%. You think about the upper bound of the Fed rate now, that's at 5.5%. Would 8.6% make more sense, or would you tweak that model?
Well, the one I use says about 6%, so it's really close to where it is. And remember, it was 5.5%, 6% when the interest rate was 0.25. And so that's really what things should be thinking about, what people should be thinking about. I would not recognize going further at this point. I think the Fed is right to slow down a little bit, maybe not pause completely, but I wouldn't go as far as that. And there are different versions. The Taylor rule that I use says around 6%.
All right. You need to share that with us, John, so that way we get it right next time. In all seriousness, we talk about this idea of sort of what that neutral rate might be, how long the Fed keeps it there, and the economic ramifications, if you will. If 5.5 percentage points of rate hikes didn't necessarily destroy this economy, are we to believe that holding it there or holding it even a quarter point higher would do that?
The thing is to look at that inflation rate. It's still 4%, 3.5%, supposed to be 2%. And I think it was good that Jay Powell emphasized that was their goal. So they're not there all the way at this point. And I think that's what people should be looking at. Whether you look at a Taylor or whatever you look at, that's what it's telling you. And so that's a little bit more. I think hold it a little bit longer. If we're lucky, it'll come down faster. But so far, it has come down quite a bit, but not all the way.
Once the Fed does wrestle inflation to 2% and can end this hiking cycle at wherever it does, do you think that resets everything, kind of clears the board so that perhaps we can get back to a rules-based approach to monetary policy?
Well, in many respects, we're already back to it. And so, 5.5, 5.25, 5.5 is very close to 6. So I think they were far away, and I wish there were more emphasis on how far away they were. But we were already back, and many other central banks around the world, the Bank of Japan, the ECB, are following the same strategy. So I think it's a good sign that the rules didn't work so well when they were off them, and they're working better now that you're closer. So let's focus on that. I think that's what I get out of this.
All right, Professor Taylor, always wonderful to catch up with you on days like today. John Taylor over at Stanford University here on a big Fed decision day. Our coverage continues in just a moment with Raghuram Rajan, professor of finance at the Chicago Booth School of Business, and of course is also former Bank of India governor and former IMF chief economist. Going to get his thoughts on the Fed, and why not? Let's just push ahead to the BOJ as well. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
powering financial solutions that transform industries, powering seamless execution in evolving markets. We deliver our entire global bank to power new possibilities for you. Barclays Corporate and Investment Bank, powering possible.
Our coverage here of the Fed Decides continues right now with Raghuram Rajan. He's a professor of finance at the University of Chicago Booth School of Business. He's a former governor of the Reserve Bank of India and a former chief economist at the IMF. And I want to start off, Professor, here with an interesting exchange that we heard during the press conference here, where Powell was kind of talked about his baseline expectations for economic conditions and that proverbial soft landing here, at least as of right now, where I know we're only 18 months into this rate hiking cycle. But at least for right now, it seems that the elements of a soft landing are there. And if you believe their economic projections going out over the next 2 years, that seems to reinforce it as well. Did you also have the same takeaway?
Yes, but look at it. The reason you want to say soft landing is the economy has resisted. All that has been thrown against it and is still, projected to do very well this year and maybe slow a bit into next year. So that's suggesting a resilient economy. But a resilient economy is not necessarily good news for inflation. So it does raise the question, is the Fed right to be as confident about the path of interest rates if, in fact, the economy exhibits the kind of resilience it's showing? Now, what plays into Chairman Powell's statement is that he believes the economy is also slowing. So it needs sort of a combination of circumstances, slowing but not slowing too fast, and the interest rates are doing their job, so they don't have to raise interest rates too much more, and it all works out really well. And this is why most people say, yes, it is a possibility, but we must consider other possibilities also.
Given where we're at right now, in your view, how much of that can actually be attributed to monetary policy, to Fed policy? And I'll pose the same question that I posed to Professor John Taylor just a few minutes ago. This idea that, at least based on some economists' estimates, a lot of the disinflation we've seen has come more from the supply side rather than the demand side that we typically associate with the monetary policy tightening cycle.
Well, it is a bit of both, but to the point that it seems more like the supply side. Yes, we have seen supply chains essentially reestablish themselves. All the disruption during the pandemic, that has gone away. So that's been on the supply side. But on the demand side, yes, there has been some slowing, for example, in the housing sector. But clearly, there hasn't been as much slowing as one would have expected with a 525 basis point hike in interest rates.
What about the external factors, the things that Jay Powell wouldn't answer, but everyone kept trying to press him on? Things like a possible government shutdown, the student loan repayments, the strikes that are currently taking place in Hollywood and in the Midwest with the auto workers. How can the Fed be so optimistic about GDP, at least in the near term, when there are so many headwinds out there?
Well, there certainly are headwinds, but there are also tailwinds, right? One of the interesting factors over the last couple of quarters has been productivity growth. Seems really, really strong. So if that plays out, it's not just a blip, but it plays out for some time, that would be a positive factor for growth and would actually be positive for the fight against inflation, because it would mean we can sustain higher wage rates without necessarily that translating into higher inflation. So yes, there are a mix of factors. I think the big unknowns are how fast the economy is going to slow going forward, given what has already been thrown against it. And of course, the factors you mentioned, the withdrawal of fiscal support, for example, because of higher student loan payments having to be made. And of course, the inflationary effects of these strike settlements, not so much in the direct impact, but what it sends as a message to what appropriate wage rates might be in the economy.
Strikes, of course, a big unknown. Another big unknown is what's going to happen with energy prices, what's going to happen to the price of oil and this incredible rise that we've seen over the last few months. What is the read-through from higher energy prices into inflation expectations and thus into Fed policy?
It absolutely matters, right? Because one of the worries is the higher inflation caused by energy prices. Fuel prices at the pump are very salient for people. As they see that and start thinking, yes, inflation is back with a vengeance, and then that starts feeding into wage effects, and that becomes the second round effects that central banks really fear. So we're not done, which is why I think Chairman Powell made it very clear that he wasn't in any way saying mission accomplished, that there's a long way still to go. And some of these, blips can turn out into something more that requires more Fed action. So I think the message that we have to take away is so far so good, but a lot remains to be done. And really, we don't have a whole lot of economic models to tell us how this is going to play out.
And of course, the Fed is just one of many central bank decisions that we have this week. The action starts again tomorrow morning. We get the Bank of England decision at 7 a.m. New York time. I know there was better than expected, cooler than expected inflation out of the UK today. Do you think that's a game changer for the BOE?
I mean, it does seem that the BOE is somewhere near the, near a point where they will feel comfortable pausing and watching. I don't think any central bank at this point is going to say it's done. The question is whether they go with another rate hike, given their high rates of inflation, or do they say, well, we've seen enough, because the UK economy is seemingly slowing, and that should be on their minds. But I think the more dramatic question for central banks is really for the Bank of Japan, as every other central bank is raising rates quite a bit. And the Bank of Japan is still figuring out at what point it gets out of its out of its yield curve control, and then gets to start raising interest rates. So the Bank of Japan is really far behind. The two big pressures, of course, on it are exchange rates, whether the Japanese yen plummets even more. And the second, of course, is the betting against their holding the yields at where they are in the markets, basically turning against the Bank of Japan and trying to push yields higher.
All right, I'm going to have to leave it there. Professor Raghuram Rajan there. He's a professor of finance at the Booth School over at the University of Chicago. He's also a former Bank of India governor, as well as serving a stint as the chief economist at the IMF. Scarlett?
All right, well, let's talk about FedEx, because amid all of this, FedEx did report earnings, and the company managing to handle the fallout, of course, of a costly labor fight this summer. Actually, that was UPS that did that. FedEx didn't have a labor issue, but we do want to bring in Bloomberg Intelligence senior analyst Lee Klaskow to give us a little bit more here. And I'm glad I brought up the labor issue, because certainly that provides a contrast to FedEx here. FedEx managing to post profit that topped estimates because of cost cuts. As Romain pointed out earlier, this might be something that investors like in the short term, but it's not a long-term recipe for success, is it?
I would have to take the other side of that trade, because I think what they're doing is FedEx for a long time is considered somewhat of a fat organization with a lot of bureaucracy, and that they're trying to thin down not only the corporate structure, but they're also trying to make their operations more efficient. So I think the cost cutting is not cutting to the bone. I think what they're doing is they're trying to create a more fluid network, a more efficient network, and a more profitable network long term. The issue with FedEx for the longest time has been on execution. I think what this quarter shows us is that they are executing on their plan. They have a plan to reduce costs by around $6 billion. You saw that in the earnings print. They beat expectations around 83 cents a share. And so that's, driving the stock up in the pre-market. They increased the low end of their guidance for the full year by 50 cents. I think that's, I think that's probably a little conservative given the 80-cent beat. Maybe they're just trying to be a little conservative, just given, where we don't know where the outlook's going to head from here.
Yeah, absolutely. Here, I know the numbers look good, and we're looking at the after-hours trade. They're up 6% here, Lee. When we talk about some of the things that maybe aided not only what we saw in the most recent quarter, but what could aid them further here, I know they benefited to some degree by some of the concerns about the strike at UPS, which, of course, never actually happened, and then some concerns, of course, also about what happened with Yellow and whether some of that business actually ended up in FedEx's with FedEx.
Sure. So on the UPS side, yeah. So when the labor contracts were going on and there was a risk of strike, some shippers looked to divert freight away from UPS to FedEx. Now it's up to FedEx
to see if they can win that business, if that business is going to be sticky. I would guess that some of it is not, but they probably could keep some of it. So that's net a good thing for market share. As it relates to their freight business, which is their less than truckload business, Yellow, which was at one time one of the largest LTL carriers out there, it went belly up. And that is an opportunity for them to win share. What I would say is not all of Yellow's freight is something that FedEx might want to carry, because it's not necessarily profitable freight or good freight that an LTL carrier would like. They like palletized freight, stuff with typically that have low cargo claims. Yellow is known to have a lot of that non-palletized freight, and also they shipped a lot of glass and TVs and things like that. But definitely a market share opportunity for FedEx. So not only can they cut costs, but they do have some opportunities to win share in that business, that LTL business, which is called FedEx Freight.
All right, Lee, always smart, and thanks. You actually taught me a new phrase today, palletized freight. I wasn't familiar with that, but I understood it. Lee Klasko over at Bloomberg Intelligence. A look at FedEx. FedEx posting profit, the topping analyst estimates, and actually nudging up its forecast going forward. Those shares up 6% here in after-hours trading. And so we wrap up our coverage here on this Wednesday afternoon. A push ahead to what the markets will have their eye on Thursday. That's coming up after the break. This is Bloomberg.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Opportunity.
People.
Things get done.
Before, I never did business in Georgia. I was amazed what kind of opportunities. There are many of them here.
Very little bureaucracy, simplicity of doing business.
You have access to markets, finance, and authorities.
It's perfectly located logistically. We have the biggest suppliers nearby.
EBRD has invested 4.6 billion euros in 270 projects, and I think that speaks for itself.
Georgia.
A pleasure
doing business.
A busy Wednesday, and of course, financial markets already looking forward to another big central bank decision tomorrow.
Yeah, Bank of England, 7 a.m.? They did get a CPI print today.
They did. Cooler than expected. You saw the odds shift around a little bit. We'll see if it actually changed the needle at all.
And we're going to come back to the U.S. and interview with James Bullard, formerly of the St. Louis Fed.
I've missed him. We don't hear enough from him.
Well, you're going to hear a lot from him tomorrow. We're also going to get some economic data, Scarlett, including jobless claims.
Yeah, high-frequency data and, of course, jobs of paramount concern for everyone following the Fed decision. There's also Philly Fed and existing home sales as well.
And on the political front here, the president is going to be meeting with the Ukrainian president, Volodymyr Zelensky, at the White House tomorrow. This has been fun, guys. You want to do it again?
Let's do it again.
All right.
Is there another Fed special coming up?
We're going to do a BOE Decides tomorrow. Stick around. Balance of Power is coming up next. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Trying to get things moving in U.S. relations with China, in the economy, in public stock offerings, and in producing cars. This is Bloomberg Wall Street Week. I'm David Weston. This week, contributor Larry Summers of Harvard on how the Fed is handling a stronger than expected economy.
Still think the Fed is considerably too optimistic.
Stephen Ratner of Willett Advisors on a car industry at a crossroads.
For the Detroit companies to be winners in EV, they need help from the unions.
And Jose Minaya of Nuveen on investment ideas you may not have thought of.
That narrative, which was one that was largely academic around alternatives and how do you get a better portfolio, better correlated assets, today it's not an academic discussion, it's an urgency.
This week, global Wall Street watched as people tried to get started, or at least back on track, around the world. President Biden went to the United Nations to send China a message that there's still room for cooperation.
I want to be clear and consistent. We seek to responsibly manage the competition between our countries. We are for de-risking, not decoupling with China. We will push back on aggression and intimidation and defend the rules of the road.
Fed Chair Jay Powell steps to the podium to get everyone to believe in that soft landing after all.
Soft landing is a primary objective, and I did not say otherwise. That's what we've been trying to achieve for all this time.
The public offering market took another step forward with Instacart finally going on sale on the NASDAQ.
We have the shares of Instacart trading higher by 39% right now, so we're looking at a valuation that is closer to $14 billion.
Quickly followed by e-marketer Klaviyo.
Well, the way we think about it is that part of being a public company is showing the world, how you run your business and saying that you're going to be there for a long time.
The auto industry tried to get going again, leading to the UAW expanding its strike to additional plants at the end of the week.
We will be striking 38 locations across 20 states, across all 9 regions of the UAW.
The equity markets reacted to all of this, and particularly what came out of the Fed, by selling off, with the S&P 500 having its worst week since March, down 2.93% for the week to 4320. That is falling below the median year-end forecast of our Bloomberg L's. That's 4435. While the NASDAQ took an even bigger hit, dropping just over 3.6%. The yield on the 10-year added almost 10 full basis points, ending the week at 4.4317 after spiking above 4.5 early in the day on Friday. Here to help us sort it all out are Peter Krause, chair and founder of Aperture Investors, and Sarah Ketterer, CEO and co-founder of Causeway Capital. Welcome back to both of you. Peter, let me start with you. What is going on in the markets? I didn't think what the Fed had to say was that radically different from what we'd heard before, but boy, the market sure reacted this time.
Well, look, in the short run, what the markets are reacting to is their expectation of where interest rates are going to be in 24. Investors believed that the Fed was going to be able to engineer a soft landing, which Powell, again, reiterated he was trying to do, but investors believed that in 24 interest rates would begin to be cut. And the Fed has been a little bit more hawkish on that. The Fed has said, well, there's probably another rate increase this year. And if you look at the dot, which is the explanation of the committee's estimation of where rates are going to be, those dots moved up. And that's what unsettled the market. Now, that's a very short-term activity, but the market reacted significantly to that.
Sarah, at the same time, the Fed, I thought, said, boy, the economy, if anything, looks stronger than we thought it would before. Is that good news or bad news? I mean, if it's stronger than we thought, does that mean actually the Fed will have to keep pushing on the interest rates, which could lead to something breaking?
Likely. It appears the Fed might have underestimated how insensitive the U.S. market is to U.S. economy is to rising rates. There's many corporates, for example, have termed out their debt. So longer duration debt at fixed rate creates a level of insulation to what the Fed is doing. So there may be less sensitivity, but ultimately, as rates remain higher for longer, this will catch up with those who have borrowed too much or where assets prices are falling, thinking in particular about parts of the real estate sector.
Peter, what about the real estate sector? As we don't want anything to break, but it's a decided possibility, I think it's fair to say. Is that what we should be looking at?
So the real estate sector in the economy breaks into two pieces. There's the residential real estate business, which is very large and affects a lot of people. And to Sarah's point, is the part of the economy that is very rate insensitive today, because most mortgages today are fixed rate. And they were fixed at low interest rates. So households today have a big, big benefit. They own a very long liability, or effectively an asset to them, at very low rates, which allows them to continue to spend and gives them positive operating leverage in their daily budgets. In the commercial space, however, that's totally different. In the commercial space, there you had buyers buying buildings at low cap rates and low interest rates, which do need to be refinanced. And there, Sarah, again, is absolutely correct. We are going to see refinancing. That is going to cause problems in the real estate business. We've already seen that. We've seen significant owners in real estate over the last 6 months literally walk away from buildings. That's highly unusual.
And this comes at a time when bank credit is tightening, too. So it's a bit of a double whammy.
Well, and Sarah, let me ask you, some people are now saying, forget about the higher for longer. What if it's higher forever? I mean, what if this basically is a new normal, as it were? What does that do to the investment proposition?
Well, cycles don't normally work that way. Our expectation at Causeway is that the Fed will achieve its 2% or thereabouts level of inflation, but that will come at the cost of employment. And as the U.S. economy shifts downward and slows dramatically, that in turn will precipitate the Fed easing. But that might not happen again for quite a while. It could be several more quarters. It could be a year. It could be longer. It's very hard to say. But the longer rates remain high, it's like a slow asphyxiation for those that are over leveraged. And there's plenty of that across this economy. In fact, there's plenty of that globally.
There might be a slightly different outcome there. Certainly the Fed has said they want to get to 2%. But I don't think the Fed will consciously break the economy to get there. And it may be that we see inflation at 3%. And then the term structure of interest rates, may shift a bit. And perhaps the 10-year isn't going to go down to 3%. It's going to be at 5 to 6%, and cash is going to be at 3 to 4%. And that's not an unusual position for the term structure of rates to be. In fact, over the last 70 to 80 years, it was more likely that than not. And the economy can be just fine there, and stocks can do just fine there. And that, I think, is also a possibility.
Sometimes, Peter, I think we tend to focus on the Fed and the economy, like that's the only two players in the game. There's also a federal government that is spending a lot of money and borrowing a lot of money. What does that mean potentially for the rate structure? Well, look, that's going to crowd out borrowers on the duration side. And so that is another reason why 10-year rates may not drop back to 3% or 3.5%. The federal government is spending a lot of money. We have three big programs: infrastructure, CHIPS, and other spending programs in climate. Those things are going to continue no matter what. And, there's a multiplier effect in those programs, too. When you spend money in infrastructure, the government's basically the equity in the infrastructure. And then banks come on top. And so if you have $100 million in an infrastructure project and a bank lends $200 to $300 million, now you have, whatever that is, $400 million or $300 million, much bigger than you think. So I think that that stimulus is going to continue. That's going to make it hard for rates to come down. We could have a complete recession, a bad recession. And then, of course, rates will come down, and we will see lower rates. But I don't think they'll stay there. So, Sarah, what about the world of maybe a 5% 10-year, or even, Peter said, 6% 10-year? If that were the case, how would that change your investment approach?
Well, the higher real rates are great for value investors because that means a discount rate of all stock is worth at the present value of the cash flow it can generate into perpetuity. And as that discount rate rises, it becomes more punitive for really long duration stocks, more speculative. They have their earnings promised and their cash flow way out in the future. So all of a sudden, cash earned today is worth more, which means dividends are more valuable to investors and income up front. So I consider it to be propitious, which is why there have been these moments of value outperformance and what we can see for undervalued stocks. This is true globally, not just the U.S. market. They're showing some significant strength, and I think this is the beginning of a very long cycle as rates remain high. After all, it's 18 to 24 months typically is the time it takes after a rate rise, a Fed funds rate rise, to see an impact. The first rate rise occurred 18 months ago. We've had multiple rises since then. So this story is just starting.
Peter, to what extent is the United States, the markets in the United States, benefited by the fact of what's going on elsewhere, such as China, such as Europe, something? The alternatives may be less attractive to the United States.
Well, certainly for the last 10, 15 years, the U.S. has been the place to invest. China's turmoil is well publicized. Europe has not grown anywhere near the same rate as the United States. And so the U.S. has benefited from that. We probably maintain that edge over time. I think that the U.S. economy is probably the strongest and most dynamic of all of those places. And until we see real stability and, I would say, laws that protect investors being applied effectively in China and not, capricious actions on the part of government, I think the China market will continue to be challenging for external investors.
Sarah Ketter of Causeway Capital and Peter Krause of Aperture Investors will be staying with us to talk about some of the other risks markets are facing right now, which include that spike in oil prices this week, something Wall Street Week has dealt with more than once over the years. Here's Louis Rukeyser back in December of 2000.
The year's big international economic story was oil. From below $11 a barrel just 2 years ago, oil climbed over $37 this past September before retreating to today's $26.80, a little more than $1 higher than a year ago.
This is Wall Street Week on Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
With Barclays, every change leads to a bold possibility. You have the vision, we have the insights, financial solutions, and global perspectives to help you make it real. Barclays Corporate and Investment Bank, powering possible.
This is Wall Street Week. I'm David Weston. Still with us are Peter Krause of Aperture Investors and Sarah Ketter of Causeway Capital. So, Sarah, let me start with you. There are also some other risks out there we're seeing right now in the marketplace. One of them is that big UAW strike that actually got expanded some on Friday, at least against two of the big automakers. How big a risk is that for the markets, do you think, over the medium term? I won't even talk about longer term, but medium term.
The risk for inflation in the U.S., and the reason why some of this comes from one of our favorite economists, Nancy Lazar. She noted that since 2016, auto industry productivity has been declining while auto industry compensation has been rising. So that means unit labor costs in the auto industry have been increasing quite significantly. So without better productivity and having wage hikes, this is going to make it really hard on auto industry profitability, which is why this negotiation is so incredibly fierce. The 32-hour work week is definitely not an increase in productivity. So let's just say the UAW gets what they want or something close to that. Then there's a contagion effect because labor across the country, even globally, says, we want that. And that just adds to labor inflation, which is something that I think the Fed is very concerned about, given how tight employment is in this country.
And Peter, we're focused on the auto industry, but it's broader than the auto industry. We've already had the Writers Guild. They're in talks again now. They haven't settled it. We have the actors. We had UPS. We had the ports. We got others waiting in the wings right now. Is there the possibility of really a broader set of labor issues here that will increase wages rather substantially?
I think we already have it. I mean, the amount of union labor in the country we know is low. It's certainly historically low. Sarah's right about the demands of the UAW and what that may portend, at least for that coterie of workers. But there's a large number of workers in the country that are not unionized, that are also demanding higher wages. And we also know that we've got a very tight labor market, which is frankly the real source of the issue. Unemployment still remains relatively low. It's not rising very much. And that means labor has a stronger leg at the bargaining table. And frankly, they probably should, because the last 10 or 15 years they haven't. So I think that the Fed knows that. The Fed is why the Fed is being tough on rates and why it's not talking about taking them down. And I think why it's going to be longer for, higher for longer.
Sarah, right now we have the strike going on with the auto industry. A week from now, it looks like the government may well shut down. A lot of people who know a lot about this say they don't see much prospects of a settlement anytime soon. If, in fact, there's a government shutdown, this would be a broad shutdown, would that have effects on the economy?
Well, it certainly won't be helpful, David, and it creates more uncertainty and also tarnishes the U.S.'s image as a phenomenal country with the most extraordinary economy. And we don't look quite so phenomenal and may have some upward pressure on long-term bond yields as, again, confidence is eroded. So it won't be helpful. We think it's unlikely to happen because these last-minute settlements are more typical, but this happened as recently as 2019, so it's certainly possible.
So what about that, Peter? We've seen this play before, at least in some version. Is this more just for those of us in the news media to talk about it a lot? Does it really affect the economy, affect the markets in your experience?
Well, the effect on the economy has to do with the duration of the shutdown. If the shutdown goes for a month or longer, of course it's going to affect the economy. The government is too large a provider of funds and spending into the economy for it not to be. If it's a short 2 weeks, 3 weeks kind of a thing, it's political drama, it's probably markets drama. I think, Sarah said this, but I think it's right, is that investors will take their risks down. They'll try to have less uncertainty in their portfolio, but those are temporary effects. For the shutdown to have a major effect, it has to go for a long period of time.
One last quick thought, if I could, Sarah. What about oil? Because we did get to start to pay attention to pretty expensive oil again this week.
Up. WTI is, U.S. crude is up 29% from June 1st of this year. That hurts. Oil year to date is up in the mid-teens percentage terms. That just adds to that's problem, because it's not just crude oil, it's all the derivatives of that, including marine fuel, jet fuel, you name it. So all of this feeds its way into the economy and just makes the central banks, their efforts much more challenging. Go ahead, Peter.
No, I'm sorry to interrupt, Sarah, but on oil, I think it's interesting that you had this Ruckhauser piece on.
Right.
Back in that time period, first of all, oil went from $11 to $26. That's a much bigger multiple, number one. And number two is the percentage impact of oil on the economy in that time period was dramatically bigger than it is today.
Many thanks to Sarah Ketter of Causeway Capital and Peter Krause of Aperture Investors. And this is Wall Street Week on Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
This is Wall Street Week. I'm David Weston. As the Fed hit the theme of higher for longer once again this week, investors may need to be looking for opportunities in different places. Here for his thoughts on where those might be is Jose Minaya. He is CEO of Nuveen. So, Jose, welcome back. Great to have you on Wall Street Week.
Always good to be here, David.
So you are responsible for so many investors and their decisions. It does look like we're going to have higher rates for longer. We can talk about how much longer. But how does that change potentially investment decisions at this point?
I'm going to go back to a narrative we've been talking about for quite a while. If you go back in the previous decade, or we've had more than a decade long of just rising markets and low interest rates. At that time, we would talk about, hey, you should be thinking about inflation. At some point, it's going to show up. By the way, you may want to have assets that are not correlated to each other in your portfolio because you may have more volatility. And by the way, rates eventually will rise. They go down over time, and it takes a while as they go back up, but they will start rising. That's why that narrative, which was one that was largely academic around alternatives and how do you get a better portfolio, better correlated assets, today it's not an academic discussion. It's an urgency, right? The idea of having a 70-30 portfolio largely in index-type, passive-type funds, that is a little bit more stressful in thinking about hitting your return targets over the long term. So again, going after things like private credit, going after things like farmland that we've talked about here before, timber, infrastructure, private equity in general. These are things that are going to be important that today largely have only been accessed by large institutional sophisticated investors.
Whether it's timberland, agricultural land, other things like that. Give us a sense of how that fits into the portfolio if you do know that we're going to have inflation and higher rates for a while.
Sure, and look, one of the things where you get alpha in alternatives is purely from getting access, right? So today you look at things like farmland, real estate, private credit, largely invested by, again, large institutions. What we've seen more recently in the ultra high net worth channels, you're seeing more penetration and people more demand wanting this, right? Because there's an urgency. You've seen more innovation around products. So you think about farmland, we had a fund strictly for institutions. Today we have an open-ended fund that goes into wealth channels as well. And I think that innovation is going to continue on to get more exposure because today the everyday investor has virtually no exposure to alternatives. And you think about how is it going to get there? Some of it will be through these creative funds. But I will tell you, if you think about a legislation they just passed, the Secure Income Act, the idea of getting guaranteed income in traditional retirement funds, i.e. 401ks, that is maybe not a sexy way, but it is a way of giving that guaranteed income is largely backed by
alternatives. It is for us in my parent company, TIA. In those investments around farmland, those like yield-enhancing type of investments support a AAA guaranteed income stream. Getting access to that in an everyday 401k fund it's a way of getting access to vineyards, toll roads, and bridges.
So connect the dots for me on that, because as you suggested, I tend to think of the big alternative investments as really being for the ultra-high net worth people. You're talking about now, for example, teachers who are looking forward to their retirement. How do they participate in some of the investments that traditionally have really been for ultra-high net worth people?
Well, I will tell you, obviously our parent company, TIA, manages money across for over 5 million participants, largely in universities across the U.S. They've been benefiting from this for the past 100 years. And again, how do they benefit? They have a guaranteed stream of income in perpetuity for their lifetime. And when we've made those, how we got into the alternative space, investing in things like farmland, private credit, timberlands, vineyards, has been around creating that stability that helps us deliver those returns backed by a AAA. So they've been getting access to that through that. Again, not a very sexy way. You may not feel like you actually own a piece of a vineyard, but you are benefiting from those investment characteristics.
You talked about a balanced portfolio. You manage something like $1.3 trillion worth of money. How much of that would be in alternatives, would you say?
About 25–30% of it is in alternatives.
Wow, that's higher than I thought, I must say.
And growing, because again, part of this is developing the platforms that gives you access to generating and getting these types of assets. So for us, it's been through acquisition. Organically, it's taken over the last 10, 20 years to once you build a platform, now we have access to this. So our exposure is growing. And again, to me, it's the best form of alpha. It's not one driven, do I pick the best security? It's just, I've just created access to something that other people don't have, and it's giving me a better risk-adjusted return.
If you go back just a short time ago, all the talk in investing was about ESG, supposedly ESG, environmental social governance investing. Now we see some retrenchment. We see some of the big guys really pulling down some of the funds that they created for ESG. By the way, you see the government of the United Kingdom putting off some of the dates that we're talking about. Is ESG investable at this point? Is it less investable than it was?
I believe what you're hearing in the narrative today is actual tailwinds for the ESG discussion. And I say that because 10 years ago, people would ask me the question, is this thing real? People are talking about it. Do clients really want to buy it? And I would always say, you'll know when it's real when the regulators show up. You know when it's real when it becomes a political issue. And the reason is, that's when you know money is really in motion. People will wake up when money is in motion. What is not going to go away is the risks embedded in around environmental issues, climate risk. These things are hitting portfolios. What's not going away is client demand for this as well. But why you're seeing more people, the quote-unquote pullback, well, a lot of the push into ESG was a narrative. It was language. It's how people talked about it. I will tell you today that whatever the retrenchment is or people moving in and out, what they're actually doing underneath isn't changing much. But now people are checking to kind of confirm what you're saying. Is this fund that you label ESG, is it really ESG? And then the other piece here that I don't find very interesting is ESG funds. We manage over 40 billion in ESG labeled funds. That's not unlike any other product. Somebody wants it, we can create it and sell it. It's the ethos of how you talk about your entire platform. How do you manage your investment process? Every RFP we get a question from clients on that. And there's going to be more focus from regulators and others coming in validating what you're saying. So I think this is the transparency the industry needed to really get better institutionalized and provide better transparency.
Jose, it's always such a treat to have you here. Thank you so much for spending time with us. That is Jose Minaya of Nuveen. Coming up, the auto industry enters the second week of selective strikes hitting the big three. We talk with where it all could end with former car czar Stephen Ratner of Willett Advisors.
The more the auto workers get paid, and I'm in favor of them getting paid more, the fewer jobs there are going to be.
That's next on Wall Street Week on Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
automotive breakdown. That's what's happened in Detroit with the auto workers into their second week of striking selective GM, Ford, and Stellantis plants with no end in sight. President Biden has more or less sided with the UAW demand that the big three share their record profits to make up for lost time.
Auto companies have seen record profits, including the last few years, because of the extraordinary skill and sacrifices of the UAW workers. But those record profits have not been shared fairly, in my view, with those workers.
While Republicans like former Vice President Mike Pence say President Biden has helped create the problem with his push for electric vehicles.
What I'm hearing around the country is that auto workers are very concerned about Joe Biden's Green New Deal, heavy-handed effort to use taxpayer dollars to drive these automotive companies into electric vehicle production. I mean, you got 145,000 workers out there many of them built a lifetime making gasoline-powered cars.
And auto CEOs like GM's Mary Barra say that whatever the politics, they need to invest all those profits so they can make the move into EVs.
We need to invest in our future, and we have a plan to take all of our employees along. I think this is very important. We have worked very carefully to have a job for everyone so we can make this transformation together. And frankly, when you put have a strike and we're not making vehicles, you start to put that at risk.
Some investors, like Bruce Richards of Marathon Asset Management, think the shift back from capital to labor can ultimately be good for us all.
Companies in the next few years are going to have a real issue because they're going to pay a lot higher labor costs. You see that with the UAW. You see that in Hollywood. Yep. You see that with what the pilots negotiate with the airlines. The labor costs are increasing, and we love to see labor cost increases. It's good for America. Mm-hmm. It's good for Americans.
But former Treasury Secretary Larry Summers warns that this may turn out to be a zero-sum game, where the union can't afford to lose and the auto companies can't afford for them to win, which could mean things will get worse before they get better.
I fear that there's a bit of an endgame dynamic going on here. And in that situation, the incentives for the union, like the incentives at one stage for the coal miners, like the incentives one stage for the steel workers, are to get as absolute much as they can while they can.
And here to take us through the auto industry as we find it today is Stephen Ratner. He is the chairman and CEO of Will Advisors, which invests the personal and philanthropic assets of Michael R. Bloomberg. He is our founder and majority shareholder. Steve, thanks so much for being back with us. You know a little bit about cars, goodness knows, given your service in the Obama administration, putting the industry back together beforehand. Is there a way out of this impasse right now? Because I sure don't see it.
Look, it does certainly look tougher than I've ever seen in any of these contract negotiations. First of all, the UAW's demands are, even by the standard of opening demands, pretty extreme. Secondly, they're conducting this negotiation largely in public, which makes it harder for the union in particular to back off their positions if and when they need to. But all that said, there's never been a strike that I know of that hasn't gotten resolved one way or another, and it's not hard to see a resolution here, but I think the mood is that it's going to take a good while.
You have written in the New York Times that you certainly can understand why there needs to be more wages for auto workers. They've lagged behind for various reasons, inflation, but also the contract that they had. At the same time, it's about more than just money, is it not? Because the auto workers say you're going to electric vehicles, which will require fewer of us. And on the other side, the auto industry says we have to go to electric vehicles or we're not going to be in business anymore.
Look, the classic Harvard Business School case is that a company or an industry that tries to protect an old business model when there's a new one coming ends up failing. If the Detroit companies want to be competitive, if we as a country want to have a viable domestic auto industry, and by the way, it is the government's policy to encourage electric vehicles, then we have to welcome this change, and there will be displacements, and we have to deal with those.
I guess I'm asking, how much of this do you think in the end is about money? How much of a raise people get, because everyone agrees they're going to get a significant raise, and how much of it is more fundamental things about the way the companies actually run their businesses?
I think it's mostly about money or money-related things. I think, yes, there's a lot of concern about the future number of jobs and so on and so forth, but I'm sympathetic to the union in the sense that if you look at the last 15 years, Auto workers as a whole in this country have basically stayed flat after inflation, whereas other workers have gotten some after inflation real income increases. And there are good reasons. There are reasons for that, which is the fundamental competitiveness of the auto industry on a global scale. But nonetheless, in a world of 3.8% unemployment and 1.5 jobs for every American, I can understand why these workers feel like it's time for them to get a bigger share.
Last week, President Biden weighed in on the issue, and at least to my hearing, weighed in pretty heavily on the UAW side, saying there had been record profits out of the car industries and there should be a record deal, I think he called it basically. Is he making the situation better or worse? In the port situation, I don't recall him weighing in that heavily on the worker side.
I think that's fair. I think we are closer to an election. I think we're talking about the Midwest, which are swing states. I don't think California is ever going to be a swing state. But I have to say, I don't think it's overly helpful for him to put his finger on the scale. Look, the politics are what they are, and I get that. But this is a tough situation, and I think there are equities on both sides.
Whenever we have a very large conflict like this, in my experience at least, there are unintended consequences. There are the principal players and who does well and who doesn't, but there are people around the side. I can think of people like Tesla, other automakers around the world, certain states, that are right-to-work states. What are the unintended consequences, you think, perhaps, of this dispute?
Look, the unintended consequences are what happens to the number of jobs, not the price paid for each job. The yin and the yang of this, and it's a tough one, is that the more the auto workers get paid, and I'm in favor of them getting paid more, the fewer jobs they're going to be. That's just the inevitable result of this. If you look, for example, back since 2009 at the number of jobs that have moved to Mexico and the fact that there are now more auto jobs in Mexico than there are in the United States, it tells you something about how capitalism and free enterprise works. It finds the lowest cost locale that can meet its needs.
Are there potential consequences for the transition to EVs? I mean, I think most people think we're going to make the transition, but could it slow it down?
I don't think on an overall basis it slows it down because there's so many players in the EV market. I think it affects who the winners and who the losers are. I think for the Detroit companies to be winners in EV, they need help from the unions. They need cooperation from the unions. And we'll have to see how that unfolds. But if the unions make it tougher for them to produce EVs on some economically rational basis, then the Detroit companies are going to end up being the losers in the EV race.
In your piece in the New York Times, you point out the ratio of the CEO's payment to wages to, in fact, the average wage and how much it has gone up. I think it was something like from 60 times to 400 times over a period of time, right?
I think it was even 460 times, but it's some big number like that, yes.
Exactly, which raises a broader issue that goes beyond the auto companies. As you point out in the piece, it's not just the auto companies where that's true. And that is, in my mind at least, the question about how much goes to capital and how much goes to labor. There has been a shift, without a doubt, toward capital in recent decades.
Well, there has been, but I think this is a question of how much CEOs should get paid. They're not necessarily the capitalists, they're employees, actually. And I think you can argue that the auto workers ought to get paid more because the CEOs are getting paid more. I think you could also make an argument the CEOs should get paid less because these numbers have become crazy. In 1979, I think I used in the piece, the CEO of General Motors made less than $1 million a year, and now today we're in the $25 to $30 million range. That's a huge increase, and as you point out, that's happening all across the economy, and that's a whole other subject perhaps for another day, but CEO pay and C-suite pay is a real issue.
What does this say potentially to investors like you making investments, not just in the auto industry, about whether you invest in the auto industry, but more broadly, if in fact there is a shift back toward labor that's got to squeeze margins, it's a practical matter, does that mean that the prospects for equities come down some?
If all that happens, the answer is sure. I don't think we know yet. Yes, there are a lot of strikes and a lot of what look like big pay packages coming through. But you also have an economy on the other side where companies have more pricing power than they used to. There's less competition, frankly, less antitrust enforcement, fewer unions in general, and so forth. And so profit margins, companies have stayed surprisingly robust. Corporate profits are far higher right now than I think most people thought they would be at this point in a cycle. And so, yeah, sure, corporate profits could get squeezed a bit. Maybe they should get squeezed a bit. But I don't think that's not what keeps me awake at night.
What does keep you awake at night?
Well, if you want to talk about this area, I think the whole future of manufacturing is a conversation to have. President Biden has been clear, and so have a lot of other people, that they would like to see a manufacturing renaissance in this country. The IRA and some of the infrastructure bill and other things are heavily tilted toward making things here rather than elsewhere. But we have to recognize that we cannot produce most things on a globally competitive cost basis. We just have too high of a wage structure. We have too high of an overall cost structure. We have much tougher environmental restrictions, which we should have, in my opinion, but which add to costs. We have permitting problems, which add to costs, and now those are unnecessary. And so I expect that, so people who basically say we're going to have this big manufacturing renaissance, I think are kidding themselves and, frankly, kidding the American people.
Steve, it's always great to have you on. Thank you so much. That's Stephen Ratner of Willett Advisors, and he is, fortunately, a regular contributor to Wall Street Week. Coming up, we wrap up the week with special contributor Larry Summers of Harvard.
We've still got very real risks to the soft landing scenario.
That's next on Wall Street Week on Bloomberg.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
Die Welt zu einem besseren Ort zu machen, das treibt uns Menschen an. Und genau das treibt uns auch bei Bayer an. Mit Hilfe der Wissenschaft verfolgen wir unser Ziel: Health for All and Hunger for None. Wir wollen, dass jeder Mensch die Chance auf ein besseres Leben hat. In einer Welt, die wir mit Stolz an nachfolgende Generationen weitergeben können. Bayer.
This is Wall Street Week. I'm David Weston, and we're joined once again by our very special contributor here in Wall Street Week. He is Larry Summers of Harvard. Larry, thank you so much for being back with us. Let's start with the Fed. We did hear from the Fed today. We have a new statement of economic projections. What did you make about what we heard from Jay Powell, the chair, about where we are?
I thought broadly it was in line with expectations. Broadly it was reasonable. I think the tilt to being worried about inflation was correct. I still think the Fed is considerably too optimistic. It's possible that we will have the proverbial soft landing, but I think the risks that inflation will be worse than what they say are very real. You've got the UAW strike. You've got oil prices having spiked. You've got a budget deficit that this year will approach 8% of GDP if you take out the student loan accounting item, and you've got a variety of technicals like in health insurance that are getting ready to kick in. So I think you've got real concerns on the inflation side, and at the same time you've got concerns on the other side that the consumer, since Labor Day, it's not much time yet, but looks like the consumer is slowing a bit. Delinquencies are starting to rise. There's some wall of maturities that's going to come due over the next year. So it's certainly possible that it will work out as the Fed has it, with inflation getting back to 2, with only negligible increases in unemployment. But that strikes me as more of a goal than a forecast. So I think we've still got very real risks to the soft landing scenario, both from the no landing, continued inflation, the Fed's going to have to raise rates more than it now expects side, and from the fact that every recession that we've had for a generation, people have been talking soft landing right before it, and they've turned out to be wrong. So I think that people are just a little too optimistic right now, and I think the Fed's caught into that optimism. And, you know, on the one hand, things won't be any better than you aspire for them to be. On the other hand, it's a good idea to under-forecast and overperform. So it's a very difficult balance that the Fed has to walk. But my suspicion is that it's more likely than not that they're either going to get surprised on the higher inflation side or on the weaker output downturn side, or possibly both could materialize in a stagflationary kind of dynamic.
Larry, you mentioned the UAW strike that is ongoing as we speak here, and the risk for the upside on inflation there coming out of that. What do you make of where we are right now in that? Because my point of view, looking at it, is I'm not sure where these parties can come to yes between the two of them. They seem to be almost really opposed to one another on some very basic things.
Look, it's always easier to compromise on numbers than it is, like, how big is the wage increase going to be, than it is on principles, like what's going to happen to the battery factories. It's easier to compromise on numbers, like the size of pension packages, than it is on questions like changing the separate wage structure for recently hired workers. So they've still got questions of principle as well as questions of numbers separating them. So this may go on for a while. And I think there are two big questions. One is, what will the spillover be to the larger economy and to the Midwestern economy, including through price increases if cars get scarce, and what that means for automobile and used car prices. I also think there's some real questions here about when you have these highly publicized labor conflicts and you see what's likely to be a big number for the wage increase. I suspect that's going to give a lot of workers in a lot of places some pretty big ideas, and that may be a source of wage pressure as well, which complicates the issues around inflation. So this is a very difficult thing to manage, and I suspect it's going to be one of those things that will be with us for quite a while.
Well, you raise a really important, profound point here. Is it possible we're looking at something more than a couple of labor disputes, so into more of a fundamental shift in the power between capital on the one hand and labor on the other? Because we've had this with the ports in Los Angeles, we had it with UPS, we've got the Writers Guild out, there are a lot of other ones. And as you know, Larry, there has been a shift in the past, really away from labor and the power of labor. You've even talked about the importance of organized labor.
I think that's the question. I mean, I think there's no question in my mind that a lot about what's happened in the economy over the last several decades can be explained by changes in labor power. I think that's contributed substantially to increased inequality. I think that's contributed substantially to rising wage differentials between industries. I think it's probably been a contributor to the flexibility that's allowed the normal rate of unemployment to come down as well. So it's been a two-edged thing, and we may be looking at things go in the opposite direction.
Larry, you have been outspoken on this program and elsewhere about the plight of Ukraine and what the United States and the West should be doing, particularly when it comes to some of the Russian government assets, not private, but government assets. We've had President Zelensky, of course, at the UN in New York this week, then going on to Washington. Where are you right now on what can and should be done with respect to perhaps reparations for Ukraine?
I would just say this. It does little good to win wars if you don't win the peace. The peace in Ukraine can't be won without a viable economy that's able to look to Europe. That's got a price tag that's measured in the hundreds of billions of dollars. There are enormous global needs that are already unmet for climate change, for pandemic, for Africa. It's a very difficult budgetary time in the United States and other major economies. What those facts say to me is that we're not going to find hundreds of billions of dollars for Ukraine in our budgets, and that if we find a lot of money, it's going to be enormously expensive money in terms of what it means politically and in terms of what it means for the rest of the world. And there's a place we can go for those resources. We can go to the assets of the Russian state that have already been seized and frozen and made unavailable to the Russian state. So it's practically necessary, morally right, and legally entirely legitimate. And I hope that President Zelensky will push President Biden on the issue. I hope that President Biden will push his lawyers. He's had pretty flexible lawyers when it's come to matters like student debt relief, when it's come to matters involving environmental protection. It would take a lot less flexibility to free up resources here and in Europe for Ukraine at a critically important time. And by doing it, we would also make it possible for the world to have a much more robust climate change, global poverty effort going forward.
Larry, thank you so much for being back with us on Wall Street Week. That's Larry Summers of Harvard. Coming up, come as you are, but to work and in the Senate? That's next on Wall Street Week on Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
Finally, one more thought. Clothes maketh the man. So wrote Erasmus in his collection of adages from 1508. Though a version of this particular adage can be traced all the way back to Homer or maybe even the Babylonians. Until recently, many the man walking the halls of power, that's whether corporate or government, took the maxim quite seriously, invariably showing up in the uniform of a well-cut suit, a white shirt, and a power tie.
The richest 1% of this country owns half our country's wealth, $5 trillion.
And women haven't been far behind, as they adopted their own versions of power suits.
Hold all calls, Miss McGill? Yes, Cynthia, thank you. Can I get you anything, Mr. Trainer? Coffee, tea, me? Isn't she right? That'll be all.
But the pandemic may have changed all that, as people learned to work from home, where it didn't matter whether you were wearing your power suit or your track suit.
People who sat at home, which I'm not a fan of today, people who were home were dressing casually, but I think that the world is going very much in a different place.
So as CEOs chafe at their workforces not showing up at the office, at least physically.
My golden rule is don't put the genie back in the bottle you can't. On the other hand, this is not an employee choice. They don't get to choose their compensation, they don't get to choose their promotion, they don't get to choose to stay home 5 days a week. I want them with other employees at least 3 or 4 days.
They may want to consider giving the incentive of some extra perks, like Meta did just this week with its announcement.
Meta is restoring its happy hours. It's giving out branded T-shirts once again. It's trying to boost morale.
Yeah, you said the 2 magic words for Carol Massar.
Boost morale,
I think she just put in
or
her
was it
application.
happy hour?
And now it turns out that no less than the United States Senate is moving to loosen its dress code for our nation's highest elected legislators. Until now, the Senate required that men wear jacket and tie on the floor, and that women wear what they called business attire. Apparently, the junior senator from Pennsylvania, John Fetterman, isn't comfortable in jacket and tie, so he's been turning up in something decidedly less formal and casting his votes from the doorway, prompting Senate Majority Leader Chuck Schumer to eliminate the Senate dress code altogether so that Senator Fetterman can come into the chamber and do his work dressed however he likes, though colleagues like Senator Ted Cruz may stick to the old way.
I can tell you,
In the 11 years I've been in the Senate, I've only been on the Senate floor in a suit and tie. And as far as I'm concerned, I will continue to only wear a suit and tie on the Senate floor. I think virtually every senator is going to follow that, or for women, the professional dress equivalent.
And Senator Fetterman himself has now said that he's willing to put that suit and tie back on if it will get Republicans to agree not to shut the government down. Call me old-fashioned. My wife and children certainly do, but I still think how you dress says something about how seriously you take what you're doing.
Now, didn't I tell you dress appropriately?
I wore this ridiculous thing for you.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
Let's start with the Fed. We did hear from the Fed today. We have a new statement of economic projections. What did you make about what we heard from Jay Powell, the chair, about where we are?
I thought broadly it was in line with expectations. Broadly it was reasonable. I think the tilt to being worried about inflation was correct. I still think the Fed is considerably too optimistic. It's possible that we will have the proverbial soft landing, but I think the risks that inflation will be worse than what they say are very real. You've got the UAW strike. You've got oil prices having spiked. You've got a budget deficit that this year will approach 8% of GDP if you take out the student loan accounting item. And you've got a variety of technicals, like in health insurance, that are getting ready to kick in. So I think you've got real concerns on the inflation side. And at the same time, you've got concerns on the other side that the consumer, since Labor Day, it's not much time yet, but looks like the consumer is slowing a bit. Delinquencies are starting to rise. There's some wall of maturities that's going to come due over the next year. So it's certainly possible that it will work out as the Fed has it, with inflation getting back to 2, with only negligible increases in unemployment. But that strikes me as more of a goal than a forecast. So I think we've still got very real risks to the soft landing scenario, both from the no landing, continued inflation, the Fed's going to have to raise rates more than it now expects side, and from the fact that every recession that we've had for a generation, people have been talking soft landing right before it, and they've turned out to be wrong. So I think that people are just a little too optimistic right now, and I think the Fed's caught into that optimism. And, you know, on the one hand, things won't be any better than you aspire for them to be. On the other hand, it's a good idea to under-forecast and overperform. So it's a very difficult balance that the Fed has to walk. But my suspicion is that it's more likely than not that they're either going to get surprised on the higher inflation side or on the weaker output downturn side, or possibly both could materialize in a stagflationary kind of dynamic.
Larry, you mentioned the UAW strike that is ongoing as we speak here, and the risk for the upside on inflation there coming out of that. What do you make of where we are right now in that? Because my point of view, looking at it, is I'm not sure where these parties can come to yes between the two of them. They seem to be almost really opposed to one another on some very basic things.
Look, it's always easier to compromise on numbers than it is, like, you know, how big is the wage increase going to be, than it is on principles, like what's going to happen to the battery factories. It's easier to compromise on numbers, like the size of pension packages, than it is on questions like changing the separate wage structure for recently hired workers. So they've still got questions of principle as well as questions of numbers separating them. So this may go on for a while. And I think there are two big questions. One is, what will the spillover be to the larger economy and to the Midwestern economy, including through price increases if cars get scarce, and what that means for automobile and used car prices. I also think there's some real questions here about when you have these highly publicized labor conflicts and you see what's likely to be a big number for the wage increase. I suspect that's going to give a lot of workers in a lot of places some pretty big ideas, and that may be a source of wage pressure as well, which complicates the issues around inflation. So this is a very difficult thing to manage, and I suspect it's going to be one of those things that will be with us for quite a while.
Well, you raise a really important, profound point here. Is it possible we're looking at something more than a couple of labor disputes, into more of a fundamental shift in the power between capital on the one hand and labor on the other? Because we've had this with the ports in Los Angeles, we had it with UPS, we've got the Writers Guild out, there are a lot of other ones. And as you know, Larry, there has been a shift in the past, really away from labor and the power of labor. You've even talked about the importance of organized labor.
I think that's the question. I mean, I think there's no question in my mind that a lot about what's happened in the economy over the last several decades can be explained by changes in labor power. I think that's contributed substantially to increased inequality. I think that's contributed substantially to rising wage differentials between industries. I think it's probably been a contributor to the flexibility that's allowed the normal rate of unemployment to come down as well. So it's been a two-edged thing, and we may be looking at things go in the opposite direction.
Larry, you have been outspoken on this program and elsewhere about the plight of Ukraine and what the United States and the West should be doing, particularly when it comes to some of the Russian government assets, not private, but government assets. We've had President Zelensky, of course, at the UN in New York this week, then going on to Washington. Where are you right now on what can and should be done with respect to perhaps reparations for Ukraine?
I would just say this. It does little good to win wars if you don't win the peace. The peace in Ukraine can't be won without a viable economy that's able to look to Europe. That's got a price tag that's measured in the hundreds of billions of dollars. There are enormous global needs that are already unmet for climate change, for pandemic, for Africa. It's a very difficult budgetary time in the United States and other major economies. What those facts say to me is that we're not going to find hundreds of billions of dollars for Ukraine in our budgets, and that if we find a lot of money, it's going to be enormously expensive money in terms of what it means politically and in terms of what it means for the rest of the world. And there's a place we can go for those resources. We can go to the assets of the Russian state that have already been seized and frozen and made unavailable to the Russian state. So it's practically necessary, morally right, and legally entirely legitimate. And I hope that President Zelensky will push President Biden on the issue. I hope that President Biden will push his lawyers. He's had pretty flexible lawyers when it's come to matters like student debt relief, when it's come to matters involving environmental protection. It would take a lot less flexibility to free up resources here and in Europe for Ukraine at a critically important time. And by doing it, we would also make it possible for the world to have a much more robust climate change, global poverty effort going forward.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
Markets struggling to regain their composure after the Fed dashes those cut rate dreams. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you down to the closing bell here in the U.S. We're looking at green, but just barely. If you take a look at the S&P 500, up less than 0.1%. We'll see how the next 2 hours go. Big tech faring a little bit better. You can see the NASDAQ 100 up by about 0.4%, helped by what we're seeing in the bond space. You're looking at 10-year Treasury yields. They got as high as 450 overnight, but their yields are actually falling right now, down about 7 basis points or so. And I wanted to highlight dollar yen. Of course, we had the Bank of Japan overnight remain dovish, didn't do much, and as a result, you're seeing the dollar strengthen against the yen, that pair up by about 0.5%.
Yeah, interesting to see stocks coming off the highs of the day. Big tech has actually gotten a bit of a reprieve here, coming off what was the worst 3-day sell-off in almost 2 months for that sector. The respite that we're seeing for small cap stocks, not actually seeing it all. Somewhat negligible here with the Russell 2000, relatively unchanged on the day as it heads for what's going to be a third weekly decline and a third month of underperformance relative to the S&P and NASDAQ. The Russell well below its August lows and not far off from that year-to-date nadir set back in May. Matt Maley over at Miller Tabak, he noted this in an interview, saying that when you factor in the moving average convergence divergence indicator, the MACD, that's now in negative territory, which means that bout of weakness that we're seeing for small caps, it might actually continue. A counterpoint, though, is the folks over at Bloomberg Intelligence say Russell 2000 and their fair value model suggests the index could rebound if, and I do mean if, the Fed can stick that soft landing. Of course, the latest Bank of America note out on fund flows actually shows most bets right now for that soft landing aren't so soft. In fact, most people planning for a potential hard landing. In the week through Wednesday, investors pulled almost $17 billion from global equity funds, the most since December. Michael Hartnett saying the higher for longer on interest rates means, quote, pops and busts in the financial markets. Hartnett says you're already seeing those tails starting to appear, including a steepening yield curve, a rise in the unemployment rate, and higher defaults and delinquencies. He says pay close attention to the reaction in this year's stock market leaders once bond yields start to drop significantly. If those lower yields spark a rally in home builders and chip makers, then it's bull 5,000 again. But if they can't generate those gains, it's back down to what he says is, quote, bear 4,000. For now, Treasury market volatility as measured by the ICE Bank of America Move Index remains subdued, at least relative to the peaks we saw in March. But the uncertainty, Katie, about the Fed's trajectory, about the potential for a gray swan event, if you will, with that big government shutdown everyone's talking about, means that volatility could pick up.
And what's interesting about this period leading up to a potential government shutdown is that yields are very, very high right now. You look across maturities, we're well above 4%. The 10-year in particular getting above 4.5%. You take a look at that purple line, of course, that is your 2-year yield above 5%. We have not seen that in quite some time. So that's the setup heading into what could be a government shutdown. And if we take a look at past periods, Romaine, you had mentioned the fact that right now you have seen bond volatility come down. You can see we spiked and then we're coming a little bit down. But if you take a look at past shutdowns, these red lines here, we tend to see a little bit of a jump. Again, when you think about where we are when it comes to Fed policy being very restrictive and this big sell-off that we've seen, particularly in the long end of the curve, it could lend itself to some fireworks, if you will.
All right, let's get some insights out of Michael Pond, head of global inflation market strategy at Barclays, joining us right now to help us kick off to the close here. And let's push ahead, Michael, I think, to the next couple of weeks here. We kind of forget about that government shutdown. And I've heard from a lot of folks here saying that if we do actually reach that precipice in a material way and go beyond it, we could see a material pickup in volatility in the bond market.
I think that's right. Next week might be a bit of a quieter week.
We have some more minor data focused on housing, although at the end of the week, we do have that core PCE number, which is quite important for the Fed. But then we lead into October 1st. And October 1st, we could have a government that's shut down, and that will likely lead to some heightened uncertainty. Usually, what happens is government shutdowns. We get furloughed government employees. They all come back when the government opens, and they get their back pay in their hands. So, it often costs the government money because we're losing that workforce, but then we pay them anyway. But so if we do reopen relatively soon, the economic impact and hence the impact on the markets will likely be fairly limited.
Right.
But again, there's concern that this could go longer than others.
Well, let's talk about what happens if it goes longer, because in addition to just the economic and financial implications, there's also this issue here that the government agencies effectively stop putting out much of the data that this data-dependent Fed is dependent on, and for that matter, the market is dependent on as well.
Right. A big difference between the shutdown that happened in December 2018 and January 2019, which lasted 35 days. So that was a pretty long shutdown in historical standards. But the Department of Labor, and hence the BLS sits within that, was already fully funded through the end of September 19. So the Department of Labor and data that we were getting over that shutdown was not affected. This time, there could be a greater concern. With some of the market numbers, particularly CPI, which is important to the TIPS market, while the Treasury does have a backup plan of what happens, again, it just creates uncertainty and hence volatility. But even going into the Fed meeting in early November, if we don't have enough data in hand, the Fed may hold themselves back on making a major decision.
And Michael, before we get to a potential government shutdown, we have to get through the PCE numbers that we're getting next week. And similar to what we saw with CPI, you're expected to see core continue to cool. You're expected to see the headline figure pick up a little bit. Let's say that energy prices keep rising. Let's say that divergence between headline and core continues to grow. What does that mean for the Fed?
Historically, the Fed has dismissed food and energy prices as simply due to volatility. And not something they should react to, though. During the pandemic, Chair Powell was indeed focused on food and energy prices, so headline CPI and PCE, because he was particularly worried about losing faith with consumers through inflation expectations. He wanted to make sure that inflation expectations remain anchored, and oftentimes consumer inflation expectations are driven in large part by food and energy prices. And so if energy starts to ramp up, that affects consumer expectations, and the Fed may feel that they're starting to lose grip again. But for now, we think that they'll just look through the energy price moves that we've already seen that will be reflected in next Friday's data.
And it's a point that I think about a lot, that you said that, of course, when you think about food and energy, the Fed likes to poo-poo that, but it obviously matters to consumers and their inflation expectations. If you take a look at market-based measures of inflation expectations, I'm taking a look at 2-year break-evens right now. We really haven't seen that much of a bump up. Are you surprised by that? Would you have thought that this big upswing that we've seen over the past few weeks, particularly in oil, would have translated more directly into the bond market?
Now, whether we look at the 2-year, the 5-year, the 10-year, the 30-year, the market, especially in forward space, is basically priced for Fed perfection when it comes to its 2% PCE target. And as a baseline, we think that's relatively reasonable. Again, for the Fed to get it right over time, sure, that's a good baseline. But we think the risks are significantly to the upside, and we do think that, just as you noted, that we do think that break-even should respond more strongly to these structural risks in the economy, as well as the near-term oil move. We did get a decent bounce in very front-end break-evens from the oil move, but it really hasn't filtered through into forwards further out the curve.
Michael, always great to catch up with you. Michael Pond there, head of global inflation market strategy over at Barclays, to help us kick us off to the close here on this Friday afternoon, with a close eye right now on what's going on with that United Auto Workers strike. They're now saying that they will expand their strikes against GM and Stellantis. We're going to get you an update on that and tell you why Ford is not part of that expansion. Katie.
Plus, we'll get insight on consumer demand for skincare products from Heather Wallace, the CEO of Curology.
And one of the strongest pockets of the market today is in the emerging market equities. We're going to get the outlook for EM with Christine Philpotts, who launched 2 new funds this year over at Ariel Investments. That conversation coming up in a bit. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
All right, as the dust settles on more than a dozen central bank rate decisions around the world this week, emerging market stocks are trying to regain some of that lost ground today, but they still look set to end the week in the red. Longer term, though, there's an opportunity there for returns. Driving that and driving the strategy right now over at Ariel Investments is Christine Philpotts. She's a portfolio manager there for their Emerging Markets Value Fund. In fact, you all launched 2 funds this year in the emerging market space. And I'm curious about sort of what ends up being kind of the dominant driver of returns going forward, particularly if you believe, I think what we've heard a lot of central banks this week, both in the developed world and the emerging markets world, that the rate hiking cycle is either at or near the peak.
Yeah, absolutely. And thanks for having me. So I think what's interesting is to think about the divergence that we're seeing between the emerging market world and the U.S. And a lot of focus this week has clearly been on the Fed having a more hawkish tone and that rates are potentially staying higher for longer in the U.S. But what's important, I think, to focus on is not just the absolute level of rates, but the relative real yields that investors are able to get in emerging markets relative to the developed world. So unlike in the U.S., where we see inflation has been more persistent and stickier than had been anticipated, in many emerging markets, such as Brazil, we're seeing inflation coming down meaningfully. So in Brazil, for example, inflation rates had peaked at 12%. They're now at 4.5%. And so this is providing additional scope for many emerging markets to actually cut rates. And we've seen, whether it's in Poland or Brazil or other emerging markets, central banks starting to cut rates, which should help accelerate local economic growth without compromising the real yield differential, which is still at relatively high levels versus the U.S.
So if that scenario plays out, and let's just take Brazil as an example, if that scenario plays out there, then what becomes attractive from an investment perspective? Is it like cyclical stocks? Is it financials? I mean, what becomes the dominant driver?
Yeah, so we think there's several opportunities that are really exciting in Brazil. So, for example, within the financial sector, we own Banco BTG, which is the largest investment bank in Brazil. And it benefits directly from lower rates through higher capital markets activity. But it's not just a macro play. It's also a play on the fact that they're gaining share in wealth and asset management, which should lead to higher multiples, given that it's a less cyclical and less volatile business. So we think that opportunities in Brazil benefit from lower rates driving higher growth and higher valuation levels, but also idiosyncratic drivers for the individual companies we're betting on.
So Brazil is a bright spot here. Talk to us about China, though. It feels like every conversation in emerging markets right now especially comes back to China and maybe how optimistic we were at the beginning of the year. How are you thinking about China right now?
Yeah, so the Chinese growth has clearly disappointed the markets. I think what's interesting or what's important to note is that we still see meaningful opportunities at stock-specific levels, even if the macro were to remain status quo. So, for example, we're seeing opportunities in consumer, in autos, in companies that are able to gain market share through new product development, through increasing utilization of existing capacity, through, in some cases, exports, and being able to have product mix shift towards higher margin products relative to their legacy products. And we think that some of these stocks are trading at single-digit valuations at all-time low levels. And so even if the macro were not to meaningfully be stimulated, we still think there's many opportunities and ways that those stocks can outperform.
So you specified Chinese equities there. Does that logic carry over to the debt of some of these Chinese companies?
I think it depends. So I think it really becomes a matter of digging through the individual balance sheets and risk profiles of the companies. So clearly, if you look, for example, at the real estate sector, meaningful dislocations in that market, but I think it's important to not throw the baby with the bathwater. So even though you have many privately owned real estate companies that are clearly struggling and whose debt payments are under question, you have many larger state-owned enterprises that have relatively strong balance sheets that are also seeing weaker earnings from the broader lower demand in the real estate sector, but they're actually well positioned given their land bank to gain market share from some of these weaker players. So I think it's really important to look at it on a security by security level as opposed to painting all of the securities with a broad brush.
I mean, as I'm sure you know, there are still a lot of folks out there who want exposure to EM, not necessarily to China, at least not with the magnitude that maybe it was in the past. That's led them to look to India and to a certain extent South Korea as well. Are you finding any opportunities there?
Yeah, absolutely. So I think South Korea is a great example where we see many opportunities and actually with two different levers. So one opportunity we see is, for example, in Korean banks. So banks like KB Financial, which are trading at 0.4 times price to book, but should be trading at 1 times price to book, given that they're generating ROEs that are essentially equivalent to their cost of equity. And more recently, we've seen some progression in higher return of capital to shareholders, announcements of more buybacks, which is positive, but also the opportunities for sequential increase in loan growth, given some stabilization in the real estate market and improvement in the real estate market, which should further benefit the earnings outlook. On the other side, if we think about the export-driven markets within Korea, we still see many opportunities in the memory value chain, particularly with pure play memory producers like SK Hynix. They're benefiting not only from a cyclical rebound in DRAM prices, but the structural underpinning of growth in artificial intelligence.
Is there an AI story in there somewhere or no?
There is, absolutely. But I think that's not the only story. So with AI, it requires more bandwidth. The memory content requirements are 4 to 8 times greater than non-AI applications. So SK Hynix chips are required for those high-end servers and for all the processing that's required. But what's also interesting is that we find ways to benefit from this trend, not only from the memory producers, but also other service providers. So Kingwon, which is a company in Taiwan, provides testing services for semiconductor producers. That's another stock at 13 times forward PE. We think it's quite attractive and different ways to play that theme.
There's an AI story everywhere. Come on.
If you look hard enough, yeah.
You knew the answer there. Christine, it's really great to see you. Our thanks to Christine Philpott. She is portfolio manager for Ariel Investments Emerging Markets Value Fund. Now, coming up on the close, we'll give you fresh headlines from GM and Stellantis as they respond to the UAW, who expanded strikes today. That's next. This is Bloomberg.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
With Barclays, every change leads to a bold possibility. You have the vision, we have the insights, financial solutions, and global perspectives to help you make it real. Barclays Corporate and Investment Bank, powering possible.
Well, the United Auto Workers said today that it has flinched, rather, key concessions from Ford and will not escalate walkouts at those plants. However, it will, though, expand the strike to 38 additional facilities run by rivals GM and Stellantis. UAW President Shawn Fain spoke earlier about the wider strikes.
We can and will go all out if our national leadership decides the companies aren't willing to move. Stellantis and GM in particular are going to need some serious pushing. All of the parts distribution facilities at General Motors and Stellantis are being called to stand up and strike. We will be striking 38 locations across 20 states, across all 9 regions of the UAW.
Well, just in the last few minutes, both companies responded with GM saying the strike escalation is, quote, unnecessary, Romaine. And we heard from GM also saying that the UAW leadership is manipulating the bargaining process. So it seems to be very, very tense still.
Yeah, very tense here. But I mean, we've seen this before, right? You kind of have this back and forth. And I think the idea, particularly when you see the latest headlines of at least coming with some degree of a counter offer, at least there is a back and forth. Because we've seen these labor negotiations where folks don't even talk. And then, you know, just months go on with nothing.
I feel like we just saw that with the writers and the actors strikes. For so long, it seems like they were just not getting to the table, not actually being in the room. We're starting to see some movement there. And to your point, I mean, these two sides, they're talking. The words aren't necessarily warm, but they're talking.
And it's interesting. We've spoken with a lot of analysts about what the potential economic impact, or I should say fundamental impact, would be on the companies. They talk about, obviously, the relatively healthy balance sheets that the automakers have, the inventory that they have on dealer lots, which should, at least for the next few months, be enough to meet whatever supply, whatever demands are out there for new cars. But then the question becomes, too, that if the production is halted in a material way, similar to what happened at the onset of the COVID crisis, then what is the longer-term issue when you head into the spring season when a lot of people are looking for new cars? Are they going to have anything to test drive?
It's a great question, and it's going to be interesting to see if we...
You're a car owner, right?
I'm not.
You're not?
I know, at least I'd like to buy one.
You're a horse owner, though.
I own a horse.
That's good. Are the horses on strike?
Rates on horses aren't as necessarily punishing.
Is that a good financial investment, owning a horse?
I don't know. JP Morgan Private Bank actually had an entire note out on that today. But we'll have to talk about that at a later time because David Welch, he's the Bloomberg Detroit bureau chief. He joins us now. And David, what happened in the Ford conversations that didn't necessarily happen when it came to GM and Stellantis?
They gave in on cost of living increase. That's been one of the core issues for the union, cost of living allowance, or COLA. It's something the unions gave up in 2009 as General Motors and what was then Chrysler, now part of Stellantis, went into bankruptcy. It was one of a number of concessions the union made to improve the cost base and get the companies financially stronger. And what it does is it basically gives workers a raise that matches the rate of inflation. So if inflation's 3%, in addition to whatever percentage the union and the companies agreed to for a base pay raise, you get that on top of it. What GM has wanted to do, and it's a fundamental disagreement between the company and the union, is they want to give the union protection if there's abnormally high inflation. I don't know exactly what the formula is, but it's not just sort of an addition to the raise that matches the rate of inflation, which is what the union wants. So that doesn't sound like a huge issue. It's just something GM doesn't want to make inflation sort of a structural part of their pay.
Yeah.
So it's always rising and getting compounded every year.
But this is kind of the crux, I think, of what the UAW, at least publicly, what we've heard from Shawn Fain, are really getting at. I mean, even their whole slogan, you know, record profits, record contracts, you know, you can interpret that how you will, but they seem to be making the case that when you look at the trajectory of what these auto companies have made since the last contract, if they didn't have their share, if they didn't have those adjustments, give it to them now.
That's right. And the other thing they brought up is some of the CEOs have seen their pay rise, 30, 40%. So they're saying, look, if we're going to get 20, COLA is not that big a deal when the top executives are getting so much of a bigger raise throughout the course of the contract as well. So, look, I think GM is, they're probably going to have to give in on this one. This isn't the traditional pattern bargaining we've seen, but Ford seems to have set the pace here, and it looks like they don't have a deal yet, but it looks like, there's light at the end of the tunnel for Ford.
Yeah.
And it seems less so with GM and Stellantis, and it looks like both of them are going to have to do something similar on this inflation adjustment issue.
Yeah, they're going to have to come to some agreement. It'll be interesting to see who thinks they have the most leverage and, well, how it actually shakes out. David Welch out there in Detroit. And we've seen, of course, this labor issue play out in other industries. Been talking a lot about Hollywood, but there was a big strike going on over in Australia surrounding some liquefied natural gas facilities. And we did learn this morning that those sides, primarily led by Chevron on the corporate side and the labor unions, have come to an agreement there.
Which is a relief, because you think about still the very delicate global supply chain right now and how important LNG is just to the global energy picture. So some good news there, but it really neatly shows again that this is happening across industries, across the economy.
And ask yourself this, why does that get settled? Why did UPS avoid a strike? You know, there was a certain degree of leverage that those labor unions had that the companies had to sort of meet, right? We saw that with Chevron meeting their demands for the cost of living increases. Similar story for UPS. For whatever reason, at least right now, the automakers don't think their workers have that same leverage.
And we'll see how that develops over the next, couple weeks, couple days.
We'll see. Stick with us. A lot more coverage coming up here on The Close. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's CBOE, the exchange for the world stage.
This is the countdown to the close. While broader markets right now are still holding on to modest gains and losses, depending on what index you look at. As far as the commodities space, a little bit more green on the screen. Abigail Doolittle standing by right now with our commodities close.
Indeed, Romaine. So for the Bloomberg Commodity Index overall, we have a very small gain, but here are some of the bigger winners, for lack of a better way to put it. Crude oil, about 0.4%. You can see natural gas outperforming up 1%. Gold, a small bit. And then wheat actually turning it around. Earlier, it had been lower, I believe. No, actually, it's been higher. There's been a second ship leaving a Ukrainian port from the Black Sea, so even more supplies making on the world. Grain traders, wheat traders looking past, probably in part because wheat is down almost 30% on the year. Now, copper, it's really interesting, not really doing much on the day. But if we go into the Bloomberg terminal and take a look at what's going on, this is a really interesting risk of asset divergence. So this is a year-to-date chart. You can see earlier this year, especially when there was the idea of China reopening, and China, of course, the world's largest user of natural resources. Copper and the S&P 500 really trading right there next to each other. Copper declining as the China story deteriorated, the S&P 500 going higher. Well, we have we have copper going back below 0% again on the year, negative move on the year. The big question here, Romaine, we have an uptrend breaking on the S&P 500. How much is the S&P 500 going to connect, and where will these two risk assets reconverge at some point in the future?
Yeah, good point there, Abigail. Abigail Doolittle there with our commodities close. We want to pivot from that to the world of financial regulation, a big debate taking place right now in Washington. We are learning that U.S. officials led by Janet Yellen want to make it easier to label firms as systemically important. But the big financial titans are preparing to fight back. That's because that too big to fail label would bring greater oversight and new compliance headaches, including capital requirements that a lot of them just don't want to have to deal with. Katanga Johnson is joining us right now, our banking regulation reporter down there in Washington. And first, let's start off with the implications for this. When we hear the words too big to fail, we think of the J.P. Morgans and the Citigroups of the world here. And I think we can all easily make the connection of their importance to our economy and the need to keep them solvent should the worst come. Why are the regulators looking to expand that definition?
Biden's top regulators are really hoping to have more authorities to designate a firm as opposed to just the activities of the market as systemically important. Sources make it clear that this push to undo a guidance that under the Trump administration sort of made it difficult, applied a sort of costlier test for the top regulators in the financial system to designate such firms as SIFIs. They're trying to undo that, make it easier, shorten the amount of time, so that in the event of an event that took place early this spring, where you had a number of banks failing and also, challenges that ripple effects that might have stemmed from that, regulators want to be able to step in sooner and spot those risks with this blueprint.
And let's say that this designation is extended. Who are we talking about? What kind of firms, non-bank firms, could this be extended to?
The likes of hedge funds, money market funds, as well as non-bank mortgage lenders are likely to be wrapped up in this. Regulators have said that these firms play a significant role in the financial system, but the level of data that regulated firms like big banks and others have to submit to the regulator and disclose to the public is not as readily available in all cases. That makes it harder for them to really spot as firms continue to grow, as non-bank firms continue to grow in size, they're really concerned about their ability to spot whether there's a risk that could potentially have knock-on effects to other parts of the financial system, including banks, which in many ways provide liquidity to many non-bank firms.
Give us a sense of kind of where we are in this process. I mean, anytime you get a new rule, particularly one that's going to be this size and magnitude, you're going to have a huge lobbying push, if not to kill the rule, at least certainly to neuter it in such a way. How far along are we in this process?
It's very early stages. Of course, the Biden administration's regulators proposed to make this change in April. They had a meeting today and a closed-door session to discuss the comments that stemmed from that April proposal. The hope is, sources tell us, to adopt this measure by the end of the year, to have these powers by the end of the year, so that as soon as next year, regulators can consider which firms might likely make a short list to be considered. And it's important to note that even though sort of this race to the finish to have these powers by the end of the year is likely, it may take about a year before regulators can actually notify firms that they're on a short list. And therefore, in some ways, firms are trying to get ahead of it and make changes to the consideration ahead of time.
Well, Katenga, I'm sure we're going to check in with you soon on this. Our thanks to Bloomberg's banking regulation reporter, Katenga Johnson. And Romain, to your point, you take a look at some of the reporting. BlackRock, Fidelity, and Vanguard are all among the players who've sent in comment letters about this.
Yeah, and this will be interesting. I mean, we talk about, 8 systemically important banks, and we kind of forget that they tried to expand this label before. Remember, I think it was Prudential, MetLife, and a couple others, insurers who actually got caught up in this, but then they were actually later allowed to shed that label, primarily because of the big lobbying push. But you kind of wonder, too, the clock is ticking. Remember, Trump administration sort of pushed back on these rules himself. Biden now wants to put them back in, but he's only got, another couple years in office, and, assuming he doesn't get reelected.
Yeah, better hurry up. And in a way, it's like a backhanded compliment. You're really big. You're really important. Here's a bunch of regulation. I'm sure we're going to be all over this story as it develops. But still ahead on the close today, PayPal downgraded at MoffettNathanson. We'll talk to the analyst about the headwinds she sees ahead for the payments company. That's next. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
All right, time now for our top calls, a look at some of the big movers on the back of analyst recommendations. And we start off with a look at Volkswagen, an upgrade today to buy from holdover at Stifel, with the analyst saying that while the stock remains a, quote, risky call due to some of the long-term challenges and short-term order softness, he says the stock has already corrected for some of those possibilities, and he sees an opportunity for the company to cut costs and preserve margins. ADRs here up 3% on the day. Next up, Deere getting cut to hold over at Canaccord, which also slashed its price target all the way down to $400 from $530 a share, saying industry data showing slowing unit growth for new agricultural equipment and rising dealer inventories on used equipment. Those shares down 2% on the day. And finally, let's take a look at Charter, upgraded today to overweight from equal weight at Wells Fargo, and the price target going up to $550. The analyst saying that the worst of the cable TV downturn is behind the company. And he says Charter is actually, quote, the clearest expression of the new normal, with new opportunities for growth in mobile and rural customers. Those shares, though, unfazed on the day. unchanged on the day, I should say, down about 0.2%, and those are some of our top calls. We want to stay in the sell side space and take a look at PayPal. The shares have been under pressure all week. A little bit earlier this week, we did learn of a downgrade to market perform over at MoffettNathanson. Pleased to say that Lisa Ellis, analyst over at MoffettNathanson, joining us right now to talk about that call. And Lisa, I am curious, interesting quote in your note was about this idea of some of the competition that PayPal has seen as of late. And I'm curious as to where that competition is coming from.
Yeah, they're seeing competition from a few different angles. The most significant one is from Apple Pay in the core branded checkout button at PayPal. That sort of pay with PayPal checkout button that you see on merchant websites contributes over half of the gross profits of the company. So disproportionate contributor to their profits. And it's under increasing pressure from Apple Pay, which got a lot of momentum coming out of the pandemic. And we estimate now has about half of the same share of checkout that PayPal does, but is gaining very rapidly.
I am curious when we talk about, I guess, some of the first mover advantage that PayPal had in this space, and of course, even with Venmo and that sort of a level of transaction here. Is there any sense that they have the opportunity to maybe reclaim some of that market share, or is the strategy and leadership just not there to do that?
Well, they do have a new CEO coming in. He starts next week. That will be kind of an injection of new talent. He will have a lot of work ahead of him. He has to, it's not only him, but he has to bring a whole team with him because there's been a lot of turnover in the senior ranks at PayPal. He comes from Intuit, so has a lot of experience and success with small businesses, which if you go back to PayPal's original value proposition, 25 years ago at the advent of the internet, was very, very focused on small businesses and facilitating payments for smaller merchants on the internet. We expect that he will sort of refocus the company in that direction and really focus on winning in that space, which is where PayPal competes more with a player like a Stripe or the European player Adyen. PayPal has very strong products in that space as well. And that's an area we expect them to kind of try to, pivot a bit and gain some additional momentum.
Lisa, I want to talk a little bit more about the C-suite because this line from your note really struck me that if you take a look right now, PayPal currently has vacancies or temporary assignments in the COO, CFO, Treasurer, and Chief Strategy Officer roles. How unusual is it that a company has that many important open roles at once?
Yeah, that's pretty unusual. Yeah, for sure. The outgoing CEO, Dan Schulman, has been with PayPal for 9 years since prior to the spin out of eBay. He joined when it was spinning out of eBay. He has had a very strong, loyal team around him for a long time. Unsurprisingly, as he's transitioning out of the company, many of those folks who have also been there for 8 or 9 or more years would naturally be retiring or just moving on. But the CEO transition at PayPal has taken a little bit longer than maybe I think investors were hoping it would. It's probably, taken, could have happened as much as a year ago. So there has been a bit of a kind of air pocket where we've had some departures. And since we did not yet know who the new CEO was, and he has to bring in his own team, right? There's sort of these seats that have been sitting sort of vacant or temporarily filled now for quite a while, which is probably contributing a little bit to the sort of sluggish performance of the company this year.
And once we get the bench assembled, once the team is up and running, what should be the first item that they should focus on? Is it the market share? Is it the margin? What's first on the list?
Absolutely, first on the list has to be addressing that competitive threat from Apple Pay, because that business for PayPal, the branded checkout business, contributes, it's more than half of the profit of the company. And right now it's not a disaster. It's still growing. It's growing in the mid-single digits. But we need to see that business reaccelerate. And the things, for example, they can revitalize the value proposition of that digital wallet. They have a lot of good capabilities. They have like a really strong buy now, pay later product, for example, that competes with a player like an Affirm. And they have some good, kind of credit and debit products, some other interesting feature functionality, but they really need a strong kind of product and marketing push around it to kind of steer consumers back toward using PayPal to check out and be their preference for checking out on websites or in apps, and moving a bit away, and kind of turning the tide back away from Apple Pay.
All right, Lisa, great to catch up with you. Lisa Ellis over there at MoffettNathanson, a closer look at PayPal. Meanwhile, we want to bring you some breaking news. This involving WW, the company formerly known as Weight Watchers, up about 3.5%. And in fact, just within the last 20 minutes or so, it's actually spiked about 10% off of the lows of the day here. This is based on a report coming out of Goldman Sachs, which is citing a posting on the Blue Cross Blue Shield website in Michigan that seems to imply that they will be covering the cost for some of these weight loss drugs. These GLP-1 weight loss drugs, such as Wegovy, which is made by Novo Nordisk. Remember, Katie, there was a lot of discussion here about the cost of these drugs and whether the insurance companies would actually pick up some of the costs. Basically, what we're learning right now is that Blue Cross Blue Shield of Michigan has designated the drug as being highly effective when used alongside healthy diets and exercise. And then the Goldman analysts are extrapolating from that this could mean that we could see some sort of coverage, insurance coverage for these drugs.
It's a good thing that Goldman had their alerts set up on the different websites. As you can see, the after-hours share reaction.
I don't have one of those alerts for Blue Cross Blue Shield.
Now I'm thinking I should.
Yeah, I feel like I'm behind the curve.
Probably set one up. Interesting to see what would be a pretty quiet Friday, a big pop in the shares.
Yeah, and we should point out no real action, at least as of yet, in shares of Eli Lilly or the ADRs of Novo Nordisk, which are just relatively unchanged here in the session. Coming up, we're going to talk about skincare. Skincare spending holding up in the face of inflation. We're going to discuss the resilient demand for creams and serums. The CEO of Curology, Heather Wallace, on deck. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Skincare, it's everywhere, whether you're scrolling on TikTok or following your favorite celebrity influencer, Romaine. Consumers still spending big on creams and serums, and our next guest is the CEO of a big player in the space, Curology. It's an online skincare platform that offers customers online assessment and virtual consultations with its providers. I'm thrilled to say that Heather Wallace joins us now. And Heather, it's interesting. I mean, I don't know whether it's because I spend a lot of time on TikTok, but I feel like skincare is really picking up, and its popularity and just the presence that it has in daily conversations is growing.
Absolutely. Skincare has been growing for many years, and it keeps growing. It's a very resilient category. I always say people face the world with their face, right? And so as you think about prioritization of spending, skincare is always at the top of the list.
Is that typical, though, when you're heading into, I don't know, a period where there's a lot of talk about a potential economic downturn? Of course, inflation remains very, very high right now. When you think about how consumers prioritize their spending, where does skincare tend to fall?
Skincare really sits at the top of the list. If you think about what happened last year with tons of inflation, skincare was actually one of the only categories that grew units and not just dollars.
So talk to us a little bit, I guess, about how Curology works, because this isn't just going out and just buying a cream on your own. You actually do get to consult with a dermatologist or some other sort of medical professional. Is that true?
That's exactly right. So Curology is very different in that we were founded to make effective skincare accessible. And the way we do that is we combine a dermatology-focused telehealth practice with custom compounding ability. So we create personalized multi-RX ingredient formulas that truly raise the bar in terms of efficacy.
Because this is what I'm curious about. I mean, she mentions TikTok, and we know a lot of people are getting advice on TikTok and these other social sites, but not necessarily from reputable people, or at least people with actual real knowledge of it. How do you make sure that what's being advised to folks is best for them, best for their skin, and isn't maybe going to cause some adverse reaction?
Yeah, so we recommend that everybody comes directly to us, and you can speak for free to one of our dermatology providers. So they assess your skincare goals, they look at pictures, and they give you really good advice. And they can prescribe the products that we can create and personalize for you, but they'll also help you build your full skincare regimen.
And Heather, this is a real question. What role have influencers, if you will, TikTok, played in basically growing the industry? Because, again, I spent a lot of time on TikTok. Every other video on my For You page feels like it's about skincare in some way.
Yeah, so TikTok definitely plays a role. If you think about how our company was founded, we were actually one of the first companies picked up authentically by our own patients. And so we were trending on Reddit in early days. And a lot of our own subscribers come from other subscribers who are getting on platforms and talking themselves. So we leverage it where possible, but we really leverage our dermatology providers to provide the recommendations and the personalization and make sure that we can kind of straighten out any myths that might be happening from a skincare perspective.
And if you think about that from a user acquisition cost standpoint, has the fact that it's become so big on TikTok, does that make it more or less expensive to get users?
I think this space is crowded, right? And so the more crowded the space gets, the more expensive it gets. Luckily for us, we are 9 years now. We're a scaled company, and so we have the dollars to be able to go and reach consumers in many different ways, and not solely focusing on social media.
Yeah. Do you need like a big celebrity, spokesperson or a big celebrity endorser? Is that? I mean, when we talk so much about skincare, or really anything in the kind of the beauty and cosmetic space, it always seems like there's some, big actor, actress, or other athlete or something attached to it.
Yeah, I think that works great for some brands for the right purpose, but we're really focused on our dermatology care. We're really focused on efficacy. And so for us, it's about our own providers and creating those relationships and really being focused on the science and the proof.
9 years, you scaled this up. You're still a private company.
9 years, we're still a private company.
Any plans to go public?
We're always looking at the market, but it's always about us delivering sustainable results. And if the timing is right, the timing will be right.
Heather, great to catch up with you. Heather Wallace there. She's the CEO over at Curology. And of course, Katie, as I'm sure you know, based on your TikTok feed, celebrity-backed beauty brands are everywhere. From Rihanna's Fenty, which I'm wearing now, by the way.
No kidding.
Selena Gomez's Rare Beauty, which you might be wearing. And Kim Kardashian's Skins, who I don't want to know who's wearing that right now. Carlisle co-founder David Rubenstein, the hard part of his job here was to sit down with Kim Kardashian, who I should point out is now a bit of a VC mogul herself. That peer-to-peer conversation was taped just a little while ago. Take a listen to her approach to running a business.
I'm so hands-on, I'm so involved. I mean, to this day for Skims, I'm still our fit model, which we have like a group of fit models, and I'll know the collection that I didn't fit for. I'm very specific on how things fit, and I pick the fabrics, I come up with all of the marketing. So with Skims and my beauty brand Skin, I do every last thing.
And Kim Kardashian there, who needs no introduction there in her Storm outfit. I guess that was for Halloween. But when we talk about sort of the need, I guess, to have these sort of big celebrities sort of attached to these brands, because like I said, you pay attention to this because it's Kim Kardashian, right?
Yeah, definitely.
Yeah.
I mean, you've been following her. In my case, you've been following her since you were a young teenager. And the brand loyalty, I mean, that some of these celebrities have is just amazing. And to Heather's point, I mean, it is a crowded space at this point.
Yeah.
Kim Kardashian has a skincare line, but so does everyone else.
But that's the thing, and we were talking with Heather over Curology. I mean, there really is so many players in this space, and it's like, how do you stand out, right?
Yeah.
Like I said, I mean, you'll pay attention to a Rihanna or Kim K, but if you don't have that type of person attached to it, how do people find you?
I really think that the first mover advantage also matters here because Kim has been out there. Rihanna has been out there.
Yeah.
You know their lines. And, for some of these celebrities that are just introducing skincare lines, and there's a lot of them, it's harder.
I'm just told in my ear, apparently our director, Jared, he's a big Skims person.
No kidding,
yeah.
Jared.
Yeah, that's staying slim there. You could catch more of David Rubenstein's interview with Kim K on his peer-to-peer conversations, of course, on Bloomberg Television, all of our Bloomberg properties here. As we start to round off into the final hour of trading here on this Friday afternoon, a wild week to be sure. And I just want to go back real quickly, if we can, Katie. The shares of WW have been all over the place. At one point up about 7-8% here on the day on the back of an alert put out by Blue Cross Blue Shield of Michigan, we should point out. Extrapolate that for what you will. One bright spot in an otherwise tepid day here of price action. We're going to break down all that price action for you when we come back after the break. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
Almost 3 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Katie Greifeld.
A view from the top here on this Friday afternoon. A bit of a reprieve for broader markets, but not nearly enough to erase those massive losses that we saw from earlier this week.
And it's been a really awful month in general. We're looking at back-to-back losses on the NASDAQ 100, the same case for the S&P 500. And, of course, today not seeing much of a lift at all, the S&P 500 flipping into the red.
Yeah, most of the sectors in the red. You have some bright spots here as some of the big cap tech names are higher, but not enough to really cause any real damage. You see the NYC FANG index, which actually it was up about 1% earlier in the day, now relatively unchanged. Bank stocks and a lot of the rate sensitive sectors have really been under pressure all week long. No change here on the day. And you take a look at that 10-year yield, actually getting a little bit of a respite here, down about 6 basis points here on the day, but still camped out at about 4.5 after, of course, trading above 4.5 earlier in the session. Flip up the board here because I was taking a look at the broader market and what the next catalyst could be for it, Katie. And remember share buybacks?
I do.
Well, apparently the companies don't, because a lot of them have given up on it. You can see this chart here, and you can see where share buybacks sort of peaked and how much they've come down. That may not look like a significant amount given just how far down we were, but when you consider that uptrend that we had seen, particularly in 2020, 2021, and how the bloom has really come off the rose, remember, that was a huge support for this market, and at least for right now, that support isn't there. Of course, a lot of companies now have to kind of go into that quiet period, if you will, ahead of the earnings season. So we'll see once we start to get those earnings in about, 3 weeks' time, whether those buybacks resume.
We'll see. Maybe one of the reasons why the wheels are falling off a little bit of this equity market. But let's take a look at some of the individual movers. Of course, we do have some green. Really, I actually picked 3 gainers. I didn't realize that. Ford up 2.3%. That's after the UAW said it actually got some concessions from Ford. It's going to spare Ford from some of the pain it's inflicting on General Motors and Stellantis. Shares up 2.3%. Let's talk about the iPhone, though.
Okay.
Let's talk about Apple.
Yeah, I heard the iPhone went on sale today. iPhone 15.
Did. iPhone 15
Which
Pro.
is actually like the 17th or 18th version.
Yeah, something like that. It went on sale in 40 countries in its first wave.
And did you stand in line this morning for one?
I did not, but apparently a lot of people did across the world, including in New York. And if you take a look... In New York.
Did those people not have internet connections?
I don't know. A lot of them do order online, and the online orders sold out on some metric, I believe. But still, people like to go out and camp in front of the iPhone store. I'm not one of them, but shares are up almost 1%. Yeah. And let's quickly move on here and talk about Activision. Of course, shares rising since it looks like Microsoft's Activision deal is set to clear its final UK hurdle. The Competition and Markets Authority said on Friday that Microsoft's latest proposal opens the door to the deal being clear. That's giving a little bit of a lift to Activision shares.
Yeah, it'll be interesting to see if this deal finally closes. I thought one of the more interesting things coming out of that big antitrust on some of those documents filed was that they had actually considered buying Nintendo a few years ago. And obviously they passed on that, chose Activision. Meanwhile, Katie Greifeld and I are here as we move less than 1 hour away from the closing bell. Our cross-platform coverage, counting you down, it starts now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic alongside Katie Greifeld. We're joined right now by our colleagues Carol Masser, Jess Menton in today for Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms here on a Friday afternoon where we were looking for a little bit of a pop here, Carol, to kind of undo some of the damage from earlier this week. That's not happening. And one of the big laggards that we're seeing today is actually the Russell 2000 and the small cap.
Yeah, I'm glad you went there because there's a great story by our Esha Day taking stock of what's going on in the trade and looking specifically at what's been going on in terms of the Russell 2000. And she has said, in terms of talking to some individuals, including Matt Miller. She could have talked to Matt Miller.
Talking to Matt Miller.
Matt Maley of Miller Tape Back. Matt Miller, did you? No. So I'm just going to read from her story. The Russell confirming a move toward a bearish trend after breaking below an important support level, triggering several technical indicators in quick succession. I mean, read through the story, but it's interesting. You watch some of these different market indicators, Jess, right? And what it might portend, because it seems to be when you see extreme moves in small caps, often a precursor for even more challenges in the equity trade.
And typically small caps are the ones that bottom before their larger counterparts, but they've been under pressure, particularly over the last 2.5 years, but they did recover towards the end of last year, but still over the past few months struggling there. So what that really means when you're looking more toward bigger cap stocks. But I have to point out, Bloomberg Intelligence, they do have a fair value model that does suggest that, say there is a soft landing type scenario for them, they could actually end up orchestrating a pretty big move there. But again, it remains to be seen as far as what this means moving forward.
Yeah, well, they have to, of course, get to that soft landing, Katie Greifeld. Another big story out there on the terminal today that I know you've been obsessed about.
Oh, my gosh. I'm glad that you made the segue for me because I was not sure how to do it. We're talking about the Liver King. Actually, Romaine handpicked this story to talk about a great piece out that basically there's this influencer named Brian Johnson. That is his real name. He's known for eating raw organs, but the problem is a lot of his followers decided to also eat basically raw meat to try to get the physique that this man has. But it came out that actually he's just been taking $11,000 of steroids every single month.
$11,000 worth of steroids? How is he still alive? I don't know. I thought, in all seriousness, I mean, this story has obviously kept a lot of attention. I've been aware of this guy for a while, and there's been a lot of talk about whether
have you been eating raw meat?
What he was selling. No, but what he was selling was legit, or at least in terms of the ethos. But this gets to, in all seriousness, this gets to a broader issue here about the FTC policing this. And if you remember, there's this thing, what is it called? The endorsement ad guidelines. And there was a study a few years back that basically showed that something like 99% of the influencers on social media weren't abiding by these guidelines. So the FTC has actually updated that. And it actually exposes folks like this to lawsuits now. I mean, in fact, he's facing lawsuits for basically, making claims that at least the people suing them think are fraudulent.
Is this like being kind of the modern day snake oil salesman or something? Like, no, I do wonder about like the responsibility, right? We're increasingly seeing influencers out on social media. If they say something, I don't know, like we're starting to see more scrutiny of these individuals in terms of what they say, because for celebrities, for a lot of people, like we're like, okay, they're a celebrity. They wouldn't lie about something.
Well, exactly that. And you remember, of course, I'm sure Katie remembers the whole fallout from the crypto endorsements when every celebrity seemed to have a crypto commercial, and then half of them got sued for what people felt were misleading statements.
This is actually all Romaine and I have been talking about so far.
Yeah, pretty much. Yeah, I'm going to take Katie out for a liver dinner later
Delicious.
tonight. Liver and onions, raw.
I don't know about that.
Hey, folks, you can't believe everything you read. I'm just going to say.
But it's the internet. If I can't believe the internet, who do I believe?
Exactly.
Seriously?
Yeah.
Come on, Romaine.
All right. Well, then I've got something to say.
Have you ever had liver, Jess?
No.
Oh,
I mean, come on, I'm from Texas. I eat a lot of meat, but I'm not going to be
right. You guys
raw
just
meat
eat the
like
brisket.
that. It's different. It's different down there.
Yeah. You guys got to work on your sauce.
All right, we're going to talk about liver, brisket, maybe, and some other things when we come back in less than an hour's time. We're going to count you down to the close.
What time is the wine segment?
I know. Wow. Not this Friday. What's up with that? All right, we'll be back in less than an hour's time. 4 p.m. Wall Street time. We're going to wrap up the trading day and week. Our cross-platform on radio, TV, YouTube, and Bloomberg Originals. Join us for Beyond the Bell.
We continue our coverage right here on Bloomberg Television, counting you down to the close. Just about 50 minutes or so until we get there. Let's talk about yields. Our next guest says 10-year yields are nearing a peak. Invesco's Rob Waldner writing, quote, "We still believe we are close to the top of the range and favor a modest overweight in 10-year treasuries." Rob Waldner joining us right now. He's chief fixed income strategist and head of macro research over there at Invesco. Rob, all right, let's just go there. I mean, we saw the volatility over the last 24 hours in that 10-year yield, a break above 4.5, and it got pushed back pretty quickly.
Yeah, thank you, Romaine. We've been in this since the Fed meeting here. I think we've really been knocking around, trying to figure out what the Fed was really trying to tell us. So the market is, in the last couple of days, is really concentrated on the SEP, the Statement of Economic Projections, and what it said, which is that there's still a majority that want to raise rates again on the committee, and they don't think there will be rate cuts next year. And so I think that's what the market's been pricing in. But I mean, in our view, the more important part of the meeting on Wednesday was in the press conference, Chair Powell said several times that they're data dependent. And, that's where we think the real difference is here, which is we do believe that inflation continues to come down. We do think we're getting this sort of bumpy landing, if you like, or meaning slow growth. And that should be relatively good for the bond market. So the question is, do you believe the SEP, which is their forecast of what may or may not happen in the next year and a half? Or do you take Chair Powell at his word that they're data dependent? It depends on the next couple inflation prints and the labor market, and position for that. And so we would say position for that.
Well, I am curious. I mean, we're showing a chart as you were speaking there of some of the losses that we've had over the past 3 months in the Treasury space, at least on a price basis here. We had comments a little bit earlier this week by Bill Gross basically saying more pain to come next year. Do you think that we might actually see a more attractive environment, both in terms of the yield potential for investors as well as the price return?
We think that the economy has been evolving along really kind of a soft landing, which has kind of been sort of the ideal scenario. If anything, the risks are here that the Fed overstays their welcome. Not that we get a pickup in growth and a pickup of inflation again, but more that the Fed overstays their welcome and really does what they say in the SEP, which is raise rates again and then, not cut at all next year. That really could, in our view, take the growth picture from a sort of soft, bumpy landing to something more adverse, and that would be positive for bond yields to come down. That would be positive for bond prices.
Positive for bond prices. Can we talk a little bit about real rates, though? Because it's been striking to watch real rates continue to climb and to hear Powell really emphasize that he sees that as a tool in his arsenal to keep real rates sustainably high in restrictive territory to combat inflation. How high could real rates go, and what does that mean for risk assets?
Well, you're showing here, I think, the 10-year real yield is implied from the TIPS market. We think that's pretty good value at 2%. Let's not forget, a year and a half ago, we were, -1 here. But you're also right that Chair Powell did talk about real rates. And I actually thought that was a little bit comforting that he acknowledged that real rates are positive. And what he meant is that nominal rates now are well above the level of the current run rate of inflation. And as inflation continues to come down, and nominal rates stay high, that's going to continue to grow that level of real rates. So if they don't move to take some of the tightening out of the market, real rates will actually continue to get high. Real rates measured against current inflation will continue to expand. And so policy will get tighter and tighter. This is what Williams was mentioning, not too long ago, is that as inflation comes down, if they want to keep policy, the same, they really need to start thinking about bringing interest rates down somewhat in line with inflation.
And when you think about that normalization process to just sort of tweak everything into alignment as inflation continues to come down, how does that translate into potential rate cuts? Obviously, we saw some cuts taken out of the forecast for 2024, but how are you thinking about that?
Well, we're thinking that it's all going to be about, as I think, if I remember exactly what Chair Powell said, he said we've had 3 good inflation prints, and that is true. We've had 3 good core inflation numbers, month-on-month numbers in a row. He said we had a good labor market data, which means it looks like the stress is coming out of the labor market. The openings are coming down, et cetera. And he said we need a few more. So he said, I like that, but we need a few more. So I think we're in his camp, which is let's watch the next couple of inflation numbers. And if they continue to come in as we kind of expect they will, relatively benign, then that would open up the conversation around rate cuts next year.
Wow. Do you think the market is positioned properly for that? Because it seemed like all of a sudden everybody's now starting to pare back those rate cut bets.
No, I think, it seems to us that the market is worried about a growth pickup. which seems not likely to us. And also, I think the market has taken the SEP at face value, and the SEP is nothing more than a forecast of the Fed, the individual Fed members' forecasts. So they could be forecasting correctly or incorrectly, but the market's taken this SEP to heart, and indicating that they are going to hike again. The majority thinks they're going to hike again this year, and that there's little chance of many cuts next year. And so I think that's what the market is trying to digest now. What do we do if rates are going to stay tight for quite a while? And I think that's why the equity market is struggling. That's why rates are higher. But as we work through this, we would expect things to, if we get a couple more good inflation prints, which we expect we will, for that pressure to ease.
All right, Rob, really appreciate your time on this Friday afternoon. That is Rob Wallner. He is Chief Fixed Income Strategist and Head of Macro Research over at Invesco. Now, coming up, we'll talk with CFTC Commissioner Caroline Pham about her plan to create the first ever U.S. pilot program for digital asset markets.
And after almost 2 years, the gap between Activision stock price and Microsoft takeover offer is narrowing. We're going to have the latest on why that deal more likely to win approval now in the UK.
And U.S. auto workers say that they will expand their strikes against GM and Stellantis. But for now, Ford is spared. All that and more coming up. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
43 minutes until we get to the closing bells. A bit of a TGIF type of trading day here. A reprieve for the broader equity markets out of what is going to still shape up to be a relatively brutal week for almost every corner of the cross-asset space. Most of the green on your screen is primarily because of the big cap tech names trying to reassert themselves today, including 2% gains for Meta as well as Nvidia. You're still seeing a lot of softness, particularly in some of the yield-sensitive spaces. That includes financials, bank stocks as a group having one of their worst days in a while, as well as in the utility space, and pressure as well when it comes to real estate, as well as some of the high valuation tech names, particularly in the Philadelphia Semiconductor Index here. Take a look at the board behind me here, because the numbers that you're seeing on this Friday don't necessarily tell the whole story for the week. NYMEX crude up today, $90 a barrel. But remember, at one point here, we were talking 94, 95 bucks a barrel, and the trend line seems to suggest that we could actually get back up to those levels very quickly here. You saw a lot of eruptions when it came to gold and some of the other rate-sensitive types of commodities as well. And then some of the soft commodities had a big downdraft here on the day. Some of that was related to weather conditions, but some of that tied to geopolitics. And of course, this was also a big week for IPOs, new issuances in the market. Instacart at $30 a share right now, down 2%. That has really been the story for a lot of these new issues, including Klaviyo, including Instacart, including ARM. All of these stocks right now either trading at or below their IPO prices just a few days after coming to market. That's the read on sentiment, particularly as we close out a wild week for central banks and head into the next week and beyond, where the end of the quarter awaits a potential government shutdown and the start of the earnings season. We'll be back in a moment. Romaine Bostick and Katie Greifeld right here on The Close. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
Well, the largest asteroid sample ever is plummeting towards Earth. The chunks of the asteroid that could tell us about the earliest days of the solar system set to land in the Utah desert on Sunday. And actually, Romain, I haven't heard anyone but you talk about this.
I am so obsessed with this story
Should I
here.
be worried?
So like years ago,
Yeah.
so they figured out this asteroid was coming close enough to Earth, and they knew that it had some implications for whether this kind of helped create the Earth. So they sent up this rocket, or this ship, or whatever you call it. And it takes years to get there.
Right.
It landed on the thing in 2020, scooped up this sample, and then now it's been making its way home, I guess, for the last 3 years. And finally, at some point, it's not even coming back down to Earth. It's going to come about 63,000 miles close to us, and then the ship is just going to poop out the sample, and it's going to land in the desert, and they'll scoop it up, and then we'll learn, hopefully, all of these great things about the creation of the universe. Or maybe they open it up and they release a virus that kills it all.
Like whether God is real, those types of existential...
I mean, it'd be nice to have some answers.
Why didn't anyone ask Jerome Powell about this on Wednesday?
Well, they might once it gets here, Katie. This is a big deal. Osiris Rex, that's the name of the craft.
Yeah.
You know what the asteroid's called?
No, I was
Bennu.
What is it?
Bennu. I don't know if I'm pronouncing it right.
Okay, so just to get the timeline right, so this is landing on Sunday.
It's supposed to, yeah. And they said if it's not successful, if it doesn't jettison this thing as needed, the next time it comes around, 2025. They got to wait 2 more years for this thing.
Well, that's actually
I actually don't know how these like space scientists even do their job, because nothing they do is immediate. Everything is like, hey, we're going to launch this rocket, and hopefully in 20 years we'll find out if it's
They're operating on different deadlines.
Yeah, I don't have that kind of patience.
No.
All right, we do have patience for Abigail Doolittle, who I'm pleased to say is finally joining us right now for our Options Inside segment. Abigail, take it away.
Well, Romain, we, of course, this week have one of the worst weeks for the S&P 500 going all the way back to March. So how could we not talk about that? Plus the volatility that we're seeing accompanying it. Let's bring in Tom Thornton, CEO of Hedge Fund Telemetry. Happy Friday to you, Tom. And what a week. What a 3 weeks. And really, what a 7 weeks, because this is not out of the blue. We are now out of the last 7 weeks, down 6 of those 7 weeks for the S&P 500. And I would say that the weakness started after the July Fed meeting when the Fed indicated that they weren't going to be going the dovish way, and we got a confirmation of that this week.
Absolutely, and I think the data still remains very, very strong. Technology's been leading this market. You're starting to see some cracks in the fabric there. You're seeing Nvidia drop pretty hard. Microsoft's dropped. Apple is off the highs. Look, I still think that there's risk right now that the market trying to hold the August levels could break pretty hard if they give up. And that's my big risk right now. And then add in higher rates that we've been seeing. And look, it's just a nasty setup right now.
Yeah, it is. And to some degree, those August lows, I'm looking at a chart right now, have already given in. We are above the S&P 500 is above that 43.35, and then I'm just taking a look at another level over here, 43.28. So I don't think it's cracked that one, but we are below the 100-day moving average. So how would you suggest playing this kind of a range? It does look bearish at this point, reversing the uptrend using options.
Yeah, we just had a nice little rally in the last 15 minutes while I've been waiting. So I like the October 2nd expiration SPY put spread, the 430, 420. You're going to pay about $1.75 for a 4x gain if you go through the lower strike. And look, I think that nothing motivates sellers more than when they see levels break and their positions start to turn red. If they, as you said, from the July peak, if they bought, they're going to start seeing losses in their portfolio.
Earlier today, Tom, in Commodities Close, we were taking a look at a chart of copper relative to the S&P 500. 2 risk assets, usually they trade together. They've been diverging over the last few months on China weakness, and copper's now down on the year. S&P 500 appears to be following. How do you bring in commodities in the real world into some of your trading ideas?
Well, one thing that I've looked at on the entire commodity complex is that what's led the market of the commodity, Bloomberg Commodity Index, it's all been crude. And I think crude right now is going to back off a bit, and then we could see some others start to gain a little bit. I think actually copper is at a pretty interesting level that it might start to see a bounce from these levels here.
Oh, interesting.
And I actually think gold, too, could start to move.
Okay, well, we'll have to keep our eye on that. And it's interesting what you're talking about with oil. Mark Newton of Fundstrat the other day was saying that he thinks it goes down before going back higher. Tom Thornton of Hedge Fund Telemetry, thanks so much for giving us all of your perspective today on Options Insight. And from New York, This is Bloomberg.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
This is the countdown to the close. About 30 minutes left to go here in the trading day where we're looking at stocks right now. A fight kind of going on in the markets right now to stay above the waterline.
Yeah, and actually we're seeing the S&P 500 perk back up a little bit. And if you take a look at the sector level, you do have more green than red. Big tech leading up top, up 0.8%, probably getting helped by the fact that bond yields finally cooling off for once. Energy also having a good day, up 0.7%. Then you go down the list to what's not doing too well. Consumer staples, we'll call that about flat. Real estate, financials, and consumer discretionary, actually the biggest loser today, but only off about 0.3%, Romaine.
Yeah, of course, big tech doing their job to keep this market afloat. Meta having a fantastic day, up 2% here on the day. And I was just taking a look here. This is going to be the 5th straight weekly gain for that stock. In fact, analysts over at Citi opening a 90-day catalyst recommendation on the shares. This is ahead of a big event that they're having next week. This is the big Meta Connect 2023 conference. And a lot of people are expected to hear a little bit more about their AI plans effectively and how that is going to be integrated into the broader business model. So keep an eye on those shares. Also keep an eye on Hertz, $13.56. That's a record low. Of course, a record after they came out of bankruptcy here, down 10%. This is after Oppenheimer, the analyst over there, basically said that the pricing power that these rental car companies had coming out of the pandemic, that has waned big time, and it could start to have a big effect on margins. Seagen getting a big bump today on the back of some relatively encouraging data for its bladder cancer treatment. And Visteon, among some of the auto parts makers, rallying here on the prospect that the UAW strike might not go on as long as some people thought. Meanwhile, we turn back to the broader market, and one of the big takeaways from this week isn't just the price action, but really the breakdown of some of those technical levels. We had spent so much time talking about that 50-day moving average for the S&P and the NASDAQ, that 100-day moving average now in play. A break to the downside on Wednesday for both the NASDAQ 100 as well as the S&P, and even with the modest rally we're having today, looks like it's going to stay there. Whether that's the start of a new downtrend, Katie, remains to be seen, but you can bet things are going to start to pick up once the end of the quarter is set.
Well, let's shift gears a little bit now and talk about regulation, specifically when it comes to crypto, because the CFTC is calling for the creation of the first ever U.S. pilot program for digital asset markets. Now, the goals here are to ensure the integrity of markets, foster liquidity, and address potential conflicts and also prevent fraud. Joining us now to explain how it works is Caroline Pham. She is Commissioner of the Commodity Futures Trading Commission. Joining us on set, Caroline, it's great to see you. And I guess a good place to start is, what exactly is a pilot program? What do they typically look like, not just in crypto?
So thanks so much for having me on the show, Romaine and Katie. It's really great to be here, and I'm super excited to talk about my proposal for the first ever U.S. pilot program for the digital asset markets. So this is actually an old concept. The CFTC and the SEC have for decades used pilot programs to explore new products or evolving market structures. And so, given that I was at the CFTC in the past and I've looked at these kinds of pilot programs, I thought, why don't we think about this for crypto markets or even DeFi markets? It's a hot topic right now. And in looking at this, so in the 90s, for example, agricultural trade options, what these pilot programs have is that they're for a time-limited period. So they're temporary. In the past, they've been 3 years. I think 1 year makes sense for just given the speed of change and just given the different issues that are coming up and the fraud. So if we had a 1-year pilot program, the typical components are things like registration and eligibility requirements, disclosures, reporting, risk management, governance. All of these things are very standard, obviously conduct, product terms, contract terms, and other things that you can put in as well. One of the things that I'm excited about doing this proposal is that I really want to hear feedback from the public. I know there's a lot of people who've been thinking very thoughtfully about what a pilot program or what digital asset markets should look like. So I'm really encouraging others to come forward and talk about it. But the CFTC has also been working on, through its various advisory committees, including the Global Markets Advisory Committee, which I sponsor, different recommendations in the space for crypto markets.
How long do you typically wait before something enters the vernacular, before we start talking about it, to when you actually propose a pilot program? Because if we first started talking about Bitcoin, I feel like really in mainstream conversations was 2013. To see 10 years before a pilot program is proposed, is that unusual?
I think it depends. There's different ways to go about things, and I know in this particular space people have been looking to whether or not there would be other solutions, but I feel like we can't wait, just given the concerns and the need for important safeguards in the space, and that's why I'm coming forward with this proposal. I've actually been working on it for a year. So what I did last year as part of my international listing tour, besides talking about macro and geopolitical with the different policymakers around the world, I also asked them, how do they approach innovation in their economies? And they told me about the different innovation facilitators or regulatory sandboxes that they do. So that got me thinking, how can we have an actual regulatory sandbox in the United States, but understanding that primarily the CFTC, just like the SEC, we are really enforcement agencies. That's sort of the authorities that we have. It's kind of the number one tool that we have. It's not the only one, but it is one of the main ones. And so that's where I looked back and I saw that these pilot programs have been really successful, and I thought this was something that could work for the U.S. framework.
Yeah.
So that's one of the key
Do you
things.
think that the chairman and the other commissioners are going to be receptive to this?
I don't see why not, because this is under our existing laws and regulations. And the important distinction here, too, on the pilot program is that it needs to fit within our existing product definitions. So it's the CFTC's existing jurisdiction.
Okay.
And so one of the things that's key here is that we're talking about tokenized financial products and services.
Right.
And we're not talking about the non-financial space.
But this gets to an issue, too. When we talk about, okay, you have this framework already there, you could create this pilot program. There still seems to be some disagreement, at least in Washington, over the definition of some of these instruments. And I guess if that's not resolved, how effective can this program be?
It's true. That is a huge challenge. But if you look at what they're doing in the EU, for example, they literally have a law that's called the DLT pilot program. It's for security, tokenized securities markets. And I think that when you look around the world, people are moving forward with exploring how this technology can make our financial markets faster, more efficient, and less risky. So why shouldn't we be exploring the technology in the same way, but in a safe, controlled manner? And that's the important thing about the pilot program is it's a framework where you can test, gather data, and then assess whether or not you should move forward with it or not.
And Caroline, zooming out a little bit, of course, we're talking maybe weeks before we're heading into a potential government shutdown. What would that mean for the CFTC's work and the CFTC's timelines?
So with a shutdown, we can't work. We would violate the Anti-Deficiency Act. There's emergency situations where we could, of course, make sure that we're continuing to function and to deal with anything that comes up. But, you know, we'll just be waiting and listening to see what happens.
All right, Caroline, really appreciate your time. Great to see you on a Friday afternoon. That is Caroline Pham. She is commissioner of the CFTC. Now, coming up on the close, the $69 billion deal between Microsoft and Activision takes a major step forward. There are stocks of the hour up next. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
It's time now for our stocks of the hour. A closer look at Microsoft and Activision, which appear to be nearing the finish line for their merger after UK competition authorities signaled that they will accept Microsoft's latest concessions around keeping the world of cloud gaming competitive. Jennifer Reed joining us right now, Bloomberg Intelligence Senior Litigation Analyst. Let's start off here with what those concessions were. I know giving some sort of titles, some sort of properties over to Ubisoft may have swayed UK authorities. Was there anything else there?
Really, that's the main thing, Romaine. Originally, Microsoft really just wanted to make behavioral promises. In other words, they wanted to say, hey, we promise we won't do what you think we're going to do with respect to discriminating against cloud gaming rivals. But the UK said that wasn't good enough. So they're transferring these rights. And I think they're making other kind of ancillary promises with respect to transferring the rights for cloud-based gaming for Activision games that'll protect those rights, like ensuring that, let's say, Ubisoft has access to the game at the same time that Microsoft and others have access to the game. Yeah. Just sort of ancillary provisions to make sure that there's nothing that Microsoft can do to play with that agreement to maybe make it unfair. And I believe in addition to that, there will be a monitor just to watch this agreement and make sure it's operating okay.
I am curious as to why this took so long. We're talking about a merger, an acquisition that was announced back in January of 2022. We're talking about a share price that never even came close to approaching the $95 offer, at least not until today. And the issues that you're talking about with Ubisoft, we were talking about those, I feel, back in the spring of 2022.
Yeah, Microsoft had to work so hard for this one. It's kind of unbelievable how long it took. And I think the reason is because there was just no expectation when they got into this deal that the UK would be as aggressive as it was with this particular deal. This is a fairly new agency. Since Brexit, they've kind of taken a front position with respect to the antitrust review of deals. And I know Brexit happened quite a long time ago, but there hasn't really been a great, big, huge tech deal like this one since then that the UK decided to step into and really get involved in. And I think Microsoft thought, and rightly so, really, at the beginning that the behavioral conditions would be good enough. And I think they worked really hard to get there. They fought hard for it. And when they finally saw that wasn't going to work, they went to Plan B, which was this more structural solution, which was to transfer these cloud gaming rights to Ubisoft.
Yeah, Jennifer, it's a great point that the UK's aggression here, if you'll call it that, was definitely surprising. And with that aggression in mind, could the CMA reverse here, or is this a done deal?
I think at this point it's a done deal. Technically, these are provisional findings, and they're going to take comments from the public or any interested parties, and up until October 6th, by the way, and then sometime after October 6th, issue their final report. I'd say we're 99.9% sure that it's going to be a good one for Microsoft, and they're ultimately going to be able to go ahead and close the deal.
And just to the question earlier that Romaine asked, why did it take this long? Of course, we heard from the CEO of the CMA who said today that Microsoft could have cleared this deal earlier had it made the remedy offer when CMA first published its concerns. Looking at that, why do you think it didn't?
Yeah, I think, again, there was some hope that given clearance by the EU, which was based on behavioral concessions, by the way, not structural, and the fact that Microsoft prevailed over the FTC in court in the United States and prevailed pretty soundly. I mean, that judge decided there simply wasn't evidence that Microsoft had the incentive and the ability to foreclose its rivals. I think what they were hoping was based on those two things, the CMA was going to change their mind. But, that really wasn't a possibility. And so they went through all the paces, and these paces take a certain amount of time. Everything has a certain time period that it takes, and it just drags on. And then that's part of the reason it's taken so long. And I think part of the reason they didn't just offer up this structural solution right off the bat.
All right. Jen, going to have to leave it there. Jennifer Rhee over at Bloomberg Intelligence. And we should point out, again, this was a deal announced back in January of 2022. At the time, you had shares in this company were actually trading in the 60s. It was a $95 offer, Katie Greifeld. The shares never really broke out of the 80 range until now because no one really thought this deal was going to get done. So at 93, 94, whatever the share price is right now, that's the highest it's actually been since the announcement.
Well, to your point, no one thought it would get done. Maybe now, though, the finish line truly in sight.
I know you're a big gamer, so maybe we'll talk about that a little bit more when we come back, as well as a discussion about the market as we round out into the final 14 minutes of trading. Megan Horniman over at Verdance Capital Management going to be joining us in just a bit. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
This is the countdown to the close. Romaine Bostick here alongside Katie Greifeld with about 10 minutes until we get to the closing bells. Katie, it has been a pretty wild week. We talk about some key technical levels that we saw broken with regards to the equities today, this week. And of course, the big spike that we saw earlier in the week in yields, although that's been retraced. But overall, when you look at the volatility and you look at the reasons for it, it really makes you wonder what the setup is into next week.
Yeah, and you take a look at the last few weeks. So, of course, the S&P 500 down this week. That would be a third straight week of losses. We also saw that in August, which we know wasn't too pretty either.
Yeah, absolutely there. And you take a look at some of the bright spots and some of the low spots here on the day, some of the rate sensitive sectors and some of those high valuations names really getting dinged here, and a flight into relative safety, at least when it comes to some of the big mega cap names. Megan Horniman joining us right now, Verdant's Capital Advisors Chief Investment Officer, to help us count you down to those closing bells. Just about 9 minutes away, Megan, and we've been talking so much here about market sentiment. I want to talk a little bit about consumer sentiment, because as we know, that is the primary pillar of this economy, and whether you think it's going to hold up, at least hold up in a way that's going to be advantageous to folks in equity and capital markets.
No, unfortunately, I don't. We've seen that consumers are re-leveraging themselves. We're looking at credit card debt now growing at a double-digit annual pace. Credit card rates are at a record high. We're seeing the cracks in consumer confidence. We're starting to see some things coming from different companies about a slowdown from the consumer at different income levels. This is, I think, going to continue through the rest of this year. You pile on top of that just so many things that can just hamper sentiment. You have the auto strikes right now. We have a looming government shutdown. I just don't see how the consumer can hold up going into the end of this year.
Then what does that sort of end up meaning for the markets here? Because we were talking all this gloom and doom earlier this year. For the most part, the economy held up. We saw corporate margins hold up as well, although some of that was because of cost cutting rather than actual growth. Do you think that there is a ballast there that maybe justifies some of the market valuations?
No, unfortunately, I think that the market is not fully repricing in what we expect the Fed to do. And we've been talking about the Fed and what they have the ability to do for a long time now. And yesterday, this week, when the Fed came out and they kind of reiterated to us that rates are going to stay higher for longer. Don't expect the Fed to come in and save the day. This is not something I think that the equity markets from a valuation perspective are pricing in. From an earnings perspective as well, the recession we think is unavoidable, whether it starts in the fourth quarter or starts in the first half of next year. The earnings expectations for next year have not come down enough to reflect that economic weakness.
Megan, can you talk about that transmission mechanism into the equity market a little bit more? You mentioned that, the fact that we could see higher for longer. If you look at some of these valuations, they don't necessarily make sense when you think about the two in relation to each other. But why is that? Why do sustainably higher interest rates necessarily hurt margins, or rather valuations?
You have to look at, first of all, from several different things. The interest rate risk when it comes to refinancing debt. So that's going to hurt some of the high debt sectors. As when you look at from a PE multiple, that's it's making it more valuable to actually own even bonds as opposed to equities. Look at the earnings yield in some of these in the equity sectors compared to the bond yields. It's making bonds look more attractive than equities. Why take on all that added risk in the light of so much economic uncertainty when you can get 4 to 4.5% yields on a treasury bond?
Well, to draw that out even further, why even bother going out the risk curve, the duration curve? Why not just stay in cash where you can earn 5-6% with very little duration or credit risk?
And right now, we do have a significant overweight to cash in our portfolios, but we did start to move out duration a little bit within the fixed income holdings. Not going super long. I agree there is still interest rate risk in the long end of the curve, but we have started to kind of match that duration to our benchmark. That's because we don't anticipate the economy is going to hold up. And when you do expect a recession over the next 12 months, you can see even those intermediate to long-term bond yields come down. The short-term yields will come down as well, reflecting the potential for possibly rate cuts. So you might be able to get some price appreciation as well as a coupon in a little bit more intermediate term bonds.
When you look at, I guess, then the positioning around that here, there's a longer term duration story there now or not? Am I mishearing?
Not long term. So your benchmark, if you're looking at the Bloomberg's aggregate, is about 6.5 years. You're not talking about buying 30-year bonds or 20-year bonds or even 10-year bonds or above. You can still get a good risk-adjusted return, we think, in that intermediate part of the curve. We've been very short duration as the Fed's been raising rates all through last year. And even in the first half of this year, we just started to move out on the curve as we've seen this spike here in interest rates in the past few months.
I'm curious, when you hear from clients and just other peers of yours in this space here, is there still a lot of appetite for that shortest of short duration? The idea of just, doing, say, I don't know, a 6-month bill or something even shorter than that and dealing with the rollover risk when you get to it?
Not necessarily looking at the 6-month or even 3-month T-bill. A lot of appetite still just sitting in cash. That's something you're earning 5 to 5.25%, if not more, on just cash. So they're not even looking to go out in 3 or 6 months because you can earn more in that cash, and you're very liquid. So you can be very quick to make decisions when we do see a correction in the market. What we've seen thus far, 5.5% down on the S&P 500. That's not a correction. That's just a minor blip here. We think, unfortunately, that we could be in for at least a 10% correction in the S&P 500.
And to keep the conversation going on cash, if we actually did reach that correction, a 10% correction in the equity market, would that just sort of stoke further demand for cash? Because in addition to pretty high yields right now, it also has that haven aspect.
Mm-hmm. It does have that haven, and you often have that investors have that fear of missing out. So you see investors going into the equity market. We've seen it this whole year. They're driving valuations up, and you see that fear that they're missing out on the rally on the upside. Well, it goes the same way on the downside. You get people that get spooked. They sell at the wrong time. Our philosophy has often been, from a contrarian perspective, we don't mind buying when the market's on its way down. We have a longer-term time horizon, and we think that that's when you're going to find the better opportunities.
All right, Megan, great to catch up with you. Megan Horniman there over at Verdance Capital Advisors, helping us count you down to those closing bells. About 3 minutes until we get to those bells, Katie. And I think we need to kind of step back here because we talk about the moves in the market, right? And sort of what predicated that sell-off that we saw on Wednesday and into Thursday here. The idea, not so much just of soft, hard landing, but the idea of those rate cuts that had been priced into the market and into valuations, that being taken off the table seemed to really rattle folks.
I agree. I think that was a reality check, and the price action backs that up. Because if you think about sort of the rallying cry for some of the stock bulls, is that the pain that we've been seeing from higher interest rates. Okay, you look into the future, though, it's coming down. And I think it was, again, a reality check for a lot of investors potentially that maybe not as quickly as we had hoped.
Yeah, and for some of those folks who came in to buy the dip this morning, that is those gains being erased here. All of the major indices were higher just a little while ago. Now all the major indices in the red as we move closer to these closing bells. Our full market coverage starts right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld. We're counting it down to the closing bell. And here to help take us beyond the bell, it's a global simulcast with our friends Carol Masser and Jess Menton. Welcome to our audiences across all of our Bloomberg platforms. Carol Masser, last time we spoke, it looked like we were maybe getting a bit of a rally here, but then, of course, after you last appeared, the market has gone south.
I'm so sorry, market. I had no impact on this, but I think it kind of makes sense after the week that was in the Fed meeting, and I think going into a weekend, I think people are a little bit tired, and we're kind of waiting for maybe Fed speak, economic data points, kind of what comes next. That just kind of feels about right to me.
And especially this week, the S&P 500 snapping its streak of 102 sessions without a drop of at least 1.5%. So that was its longest stretch since 2018, Katie.
Yeah, and the S&P 500, third straight week of losses. You would think I'd have a more impressive size and scope, but that happened last month too. It just feels like the wheels are maybe starting to come off a little bit here. Maybe those higher interest rates finally making themselves known to some of those equity bulls.
Yeah, and we talk about some of those key moving averages that have been broken for those technical analysts out there that are really sort of looking to that trend line. Is that trend line now, Jess, to the downside?
Yeah, definitely. And especially when you're looking at that downtrend line, if you're looking at the S&P 500 in particular, on a quarterly basis, it's on pace for its first quarterly loss actually in a year. So next week will be the final week in the third quarter.
Yeah, we should point out, of course, for the S&P 500, a down week to be sure. In fact, setting up here for what looks like it's going to be the worst week that we've seen in quite some time, erasing all of the gains for the month of September, erasing all of the gains that it had in the month of August, and erasing all of the gains that it had in the month of July. So this is a market that effectively has gone nowhere since that phenomenal run through the first 6 months. And now here on this Friday afternoon, here on September 22nd, the S&P 500 posting its worst weekly decline since March 10th. A 0.2% decline on the day, about a 3% decline on the week. The Dow Jones Industrial Average down 0.3% here on the day, while the NASDAQ Composite is going to finish fractionally lower by about a 0.1%. And the Russell 2000, that was your relative laggard here on the day, down 0.3%, setting up for what looks like it's going to be the fifth straight week of declines.
Yeah, a little perspective in terms of where we are in 2023. You still got a NASDAQ 100 that's up 34%, an S&P that's up about 12%. It is really the small cap universe that continues to lag, Katie. It's just up, what, about, I don't know, 0.8% here on the year.
And if you take a look under the hood of some of these indexes, and you take a look in particular at the industry groups, there's a lot of red, there's not a lot of green for this Friday. You can see up at the top, you do have some of the chip makers, the semis getting a little bit of love, up by 1% or so. Then some of those tech hardware names also managing to stay green. You go down the list, though, to some of the biggest losers. Banks on the day down by 1.4%. And autos off by 3.5%. Of course, Tesla is down by a not insignificant amount today, and that is weighing on the industry group overall.
All right, so let's get to some of the individual gainers. Ford Motor Company, right? We've been all focusing on the UAW, on the strike out there in Detroit. GM and Stellantis now facing some walkouts at maybe as much as 38 more facilities as talks with their workers union failed to make some headway. Ford apparently, like they all have different relationships with the UAW, the automakers. Ford spared the escalation after making some progress in negotiations. So Ford, it was the number 4 gainer in the S&P 500, up about 1.9%. Got to talk about Apple at its highs today, up 1.8%, still finishing the day with a gain of about 0.5%. The iPhone 15, you've also got watches going on sale today. And there was also another story late yesterday about the company giving smaller raises to its retail employees this year. So there's a lot of play, a lot of focus, but nonetheless, Apple eking out a little bit of a gain today. Don't judge me. I don't even know if you're going to bring it up, but Wayfair was up almost 5% in today's session. Bernstein coming out, raising their call on the name to market perform from underperform. Raised their price target from 65 or 265, excuse me, from 60. You had Wayfair down 2%, but as I said, it was up as much as 5%, closing the day just under $60 a share. Wah, wah, wah.
I'll take the decliners. Looking over at Scholastic. So this is the children's publishing company, ticker symbol SCHL. That's down 13%. It was its worst day since March 24th of this year. If you look at that, those shares were dropping after it did report larger than expected adjusted loss per share for the latest quarter. It also flagged some seasonality issues with the sales of its education solutions unit. Another one, of course, ARM, which was the biggest IPO of the year that went public last week. Chip Designer, it was recently listed, but of course, Susquehanna actually initiated a neutral rating on the company in this note from earlier today. If you look at that stock, though, it actually fell 1.6%. And then also Deere wanted to point that that out, the world's top agricultural equipment maker there. Looking at that stock today, down about 1.8%, its worst day since September 21st, so obviously yesterday. And then looking at that, Canaccord Genuity actually downgraded shares from hold to buy.
Let's talk about what went on in the Treasury space here. If you take a look at the Bloomberg Aggregate Treasury Index here, down on the week on a price basis here, continuing a trend that we've seen now for at least the past 3 weeks. Yields on a daily basis are lower, but on a weekly basis, they remain elevated. 5.1 and change right now is where we end on the 2-year. That's higher than where we were just 7 days ago. Similar story for the 10-year yield, which at one point did crack above 4.5%, now settling in today at right around 4.42. And on the longer end of the curve, you take your 30-year yield, we're at 4.5, and the 20-year at 4.7 here. And it raises a lot of questions here about the correlations that we're starting to see in the market, the positive correlation now between stocks and what's going on in treasuries and what that means for market positioning, particularly now that that Fed meeting is out of the way, right? We got to wait till end of October before we get the next one. And we don't have a whole lot. We get some economic data over the next few days. It'll give us maybe a read on inflation here. But this is a market kind of left to its own devices with a couple of potential gray swans out there, including a government shutdown that could come at the end of next week.
Yeah, that's the thing. I mean, it feels like we're entering into a little bit of a void. I mean, PCE, now that I've said that, we'll probably blow it out of the water, but we'll see what happens. It's interesting, though, to think about that positive correlation that has emerged, because even though you haven't seen it in the price action, I talk to a lot of people who say it's time to really step into bonds. It's time to lock in those really high rates and get comfortable with duration here. Maybe if we finally do see some relief on the yield front, they'll translate into good news for equities.
You know, it's interesting. Sylvia Jablonski over at Defiance ETFs was on with us, and she said she has seen a little bit of panic selling certainly this week, but she says she's also seeing a lot of, what did she say, buying on the income side, outsized buying. And she said this isn't the time to be selling. This is actually an opportunity. Mind you, this is her business, but nonetheless, that when you start to see a little bit of a pullback, this is when valuations kind of come back to making a little bit more sense, certainly maybe on the equity side of things, and you can find some opportunities. She was all in on AI, right, Jess?
She was, and especially when you're thinking about the dynamic between what's happening with yields, trading, especially the 10-year around the highest level since 2007, but then what that means for the equity market, in particular tech, but also unprofitable tech names. Those are the ones that are getting sold off even more so than when you're looking at those big tech counterparts.
I think it's interesting, too, when we talk about sort of where the outperformance was over the past few days here. I thought it was interesting, at least today, you had a sizable outperformance when it came to emerging market equities here. And the idea that people are still kind of on that hunt for a return. Maybe it doesn't necessarily have to be the Magnificent Seven. Maybe it doesn't necessarily have to be in the bond space. There are other pockets of quote-unquote value out there if you're willing to look for them.
I was looking at what was the top gainer in the S&P 500 this week. I think it was Humana. I'm waiting for it to kind of load here.
I thought it was.
Well, it was number 2, CBO Global Markets. But it's interesting, right? You know, there are opportunities out there, and this is where you have to fundamentally do the research, right, and look at what a company's business is all about.
And it gets, you have something to say, Katie Griffin?
No, I was hoping you'd go ahead.
Oh, I was just going to talk about horses.
No,
Are you going to talk about something else?
Yeah, no. I actually was also going to talk about
Can we talk about Tinder Select?
Well,
who's going to pay up $500 a month for exclusive search and matching?
Swiping left on that one.
So this story is interesting, right? So for our viewers and listeners who don't know, Tinder is offering a service, an ultra premium service, Carol Masser, where you can pay for the very low price of $499. That's $499 per month, $6,000 a year, and you get special VIP features.
Yeah.
What are these VIP
Which they
features?
haven't said.
Right.
Yeah.
Further details to come.
$6,000
Swipe
per year?
up, swipe down.
Yeah, well, I think, I don't know. I
left.
think Jess is the only one who would have use for this, because I think that the rest of us already have, you know.
Yeah, I think we're all married.
What is that supposed to mean?
Well, I mean, the rest of us are married.
Single. You can actually, you know.
I mean, but still, I mean, $6,000. Come on now. Per year? No.
I don't know.
No. Isn't that worth it? To find the love of your life? Or
I'm
something
reading
else?
the article. So for $6,000 a year, just to enumerate what you could possibly get, you'll be able to access VIP search. Again, not sure what that means. Matching and conversation. So I don't know. It's cool. Someone should try it out and tell us about it.
It's not going to be me.
Jess.
No, Jess.
Well, they're only rolling out to a very select group of people. It's just like 1% of their users there, like the power users.
Exclusive.
Right, who are like on it all the time. It sounds a little desperate.
I don't know. This is way outside of my frame of reference.
This is what
here.
happens when we We've done a lot
This
of
is
Fed talking.
definitely a Friday.
We go to Tinder and
Meanwhile,
influencers,
there's an
liver.
asteroid that's plummeting back.
Yeah, you
towards
guys
us
should
here
read about this,
with,
actually.
this is great. Did you read the story, Carol? Do you actually read?
No. Yeah, I do read.
Outside Bloomberg.
I
It's
do. I
landing.
love science and I love space in particular.
Well, you're going to love this. I mean, this asteroid that apparently might unlock the keys to the creation of Earth and the universe. We actually collected a sample from it like 3 years ago and been waiting for the spacecraft to make its way back into our orbit. Coming this weekend, it's going to shoot out the sample.
It's landing in the Utah desert. On
Where all
Sunday.
the aliens are, right?
That's why they
the
chose that.
government doesn't keep telling us about, right?
Put it right there in Area 51 or wherever that's out there. Or is that
This is
Nevada?
real, though.
The
Everyone should go
wine
Google
segment
it.
has started early.
Yes.
All right, guys. Well, asteroid or rains, have a
been
safe
fun.
weekend.
Hope
Tinder
to see you on Monday.
Select. Hope to see you on Tinder Select. Is that what you said, Katie?
No, that's
No.
All right, have a safe weekend, guys. That'll do it for our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you on Monday.
We're going to continue our coverage right here on The Close. An interesting story on the Bloomberg terminal today about podcasting and the #1 agent out there for a lot of these podcasters and how he's now coping with the potential crash of a market that he helped to create. That story coming up next. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
A third straight week of declines for U.S. equities sans the Dow Jones Industrial Average, which of course had that modest gain last week here. But this has been the downtrend now, quite frankly, going all the way back to early July, in fact, late June. Most of the bloom had come off the rose. Most of the gains for the year had been locked in. And the downtrend that we had started to see form on some of those technical charts, that really sort of asserted itself this week. A break below the 50-day moving average last week, a break below the 100-day moving average this week for the S&P and the NASDAQ. The new issues that we had to market, they tried to help out the market, but they could not hold. Some pretty strong debuts, but all of those, or at least 3 of those 4 names, at one point or another in the intraday sessions over the past few days, broke below their IPO price. Instacart was priced at 30 and traded well above that at one point, closed today, well right at 30. ARM Holdings, which of course debuted at 51, closed at 51.32 and at one point also traded below its IPO price at 51. Similar story for Klaviyo, which actually did not break below that $30 level, but did come close to it. And TKO at 83.79 today. Remember, the reference price for this, which was a mashup between the WWE, which was already publicly traded, and the UFC, that reference price was over 100 here. So you see, at least in the secondary market, the market does seem to be voting here with the idea here that maybe, just maybe, the sentiment isn't quite there, and more importantly, the fundamentals aren't quite there either. Another big reason why the sentiment might be under pressure as well, because of what we've been seeing in the yield space. A big uptick this week, third straight week that we've seen yields higher pretty much across the entire curve. And more importantly, the real yield, when you factor in inflation, still camped out above those 2% levels on some of the key points and 3% on that 2-year, Katie. That has a huge outsized impact. What you input into those Excel spreadsheets, into those TI calculators, into your financial models, and try to determine a valuation for the rest of the assets out there.
Well, normally, Romaine, I'd say let's keep talking about real yields, but I'm so excited for this next conversation. Over the past 10 years, podcasting has ballooned into an industry that generates nearly $2 billion a year in annual revenue. At the center sits talent agent Oren Rosenbaum. He controls a roster of well-known voices, including Ashley Flowers of Crime Junkie and Emma Chamberlain of Anything Goes. But now, as the industry faces a pullback, Rosenbaum, he's looking for creative solutions to keep it alive. Joining us now is Bloomberg's Ashley Carman, who wrote the story. Ashley, love this story. And before we get into those creative solutions, let's talk about what's happened over the past few years that we're even talking about them.
Yes, you might recall a few years ago, peak pandemic times, it seems like everybody was getting a podcast. Kim Kardashian, Meghan Markle, Lindsay Lohan. I mean, truly, all the celebrities had time on their hands and everyone got a podcast. There were huge splashy deals, millions of dollars, and in the past few years, we've seen some of that bubble pop.
And why is that? It's just people don't actually want to listen just to celebrities all the time?
So the thing is, the audience for podcasting is growing. It's just that there were these massive deals, and then there was this advertising pullback in the past year broadly across media, but it affected podcasting as well. So you really had this kind of double whammy of a high paycheck guaranteed for these stars, and then also a difficulty in making back some of the revenue to actually pay them.
Okay, so two things. I learned a lot from your story today, and I just learned today that Lindsay Lohan had a podcast, which I'm going to search for when we get done, because I figure that might just be funny for, hits and giggles. But I want you to talk a little bit more about one of the people you profiled in this story, Oren Rosenbaum. He's an agent to a lot of these podcast stars, and the idea that, at least as it's characterized in the story, he kind of saw the potential for this to sort of make stars and, more importantly, make money off of this in a way that at the time other folks at the talent agency didn't see.
Yeah, so basically Oren really started looking into podcasting in 2014 around Serial, which is a moment that for many podcasters is like the mainstreamification of podcasting.
It was like the gateway.
Yeah, it was this really big moment, a cultural moment for podcasting. Oren says he was listening to Serial. It had a sponsor at the time, MailChimp, which is also a famous sponsor.
Remember that.
And as an agent does, he said, I think there might be a business opportunity here. And so he really identified podcasting as this place where the podcasters were really operating as hobbyists, super independently. They weren't as formalized, and he saw the opportunity to talk to them, put representation behind them, and really advocate to build an entire media empire behind some of these stars.
And he really did, and other folks did as well here, not only because of what the podcast can be, but the idea you can leverage that into other things. You can take a book, turn it into a podcast, take a podcast, turn it into a book, or obviously into a Hollywood film or something else like that here. Is there any sense that the downturn that we're in right now is just that, a bit of a maybe shaking out some of the fat, if you will, getting rid of, because I mean, I don't know if you've ever been to a podcast feed as of late, but it's impossible to find anything. Yeah.
Yeah, I mean, Oren for sure would say this is just a downturn, as any industry would experience. It will bounce back. Personally, as a podcast listener, for me, podcasts aren't going anywhere. More people are probably going to keep creating them. More people will probably keep listening to them. It's just, how do you right-size the deals, more of a market correction, to ensure that it works in the long term?
Do you listen to podcasts, Katie Greifeld?
Yes.
Yeah, me
I was about to say, I actually
Yeah.
bought tickets to go to a live podcast next week, which I think is like one of the nerdier things you could do.
You're in good company.
I've already done that, so, so don't feel bad.
But where do we go from here? When we talk about a market correction, when we talk about it in equities, we ask, how long is it going to last? When it comes to the podcast industry, what kind of timeline potentially could we be talking about?
It's a good question. I think we're going to see some of these mega deals kind of linger for a bit, see a correction around those deals, maybe more layoffs, maybe more production studios close, which has happened over the past year. And then I think moving forward, we might see some level setting moving forward as far as how the deals look. There might not be those splashy mega $1 million deals, but maybe something that makes a little more sense for both sides.
What's your favorite podcast?
This is a loaded question. I can't say.
You can't say.
Not on the air.
It's Bloomberg surveillance, right? Or something like that.
I
Odd
respect
lots.
your integrity.
How about you, Katie Greifeld? I'll put you on the spot.
I don't know if I can say now. I'm
guys-
nervous.
you
Now
guys
actually, what's your favorite?
Yeah,
podcast?
you say it.
Drink Champs. You ever listen to that?
No.
Yeah. It's like old rappers, and they just talk about, reminisce about the old days.
That sounds
so
great.
it makes
okay,
me,
fine.
makes me
My favorite podcast is Case File. It's great.
There you go.
Love it.
And the host is anonymous. Very cool.
There you go. And Ashley Carmen, who's not going to tell us her podcast recommendation, you can check out a great story on the Terminal Buyer talking about podcasting's #1 agent coping with the crash of a market that he hyped. Coming up here, we're going to talk about the outlook for soccer in the United States. Superstar Lionel Messi and his team preparing to play in Chicago next month if he's healthy. We're going to talk with Dave Baldwin, president of business operations at Chicago Fire FC. That's coming up after the break. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
All right, U.S. soccer is really having its moment, from the Women's World Cup to the professional MLS League here in the United States, and of course the arrival of Lionel Messi giving a big shot in the arm for the attention for the league. The Chicago Fire also benefiting from that. That team actually scheduled to take the field against Messi against Miami later next month. Joining us right now to talk more about this is Dave Baldwin. He's the president of business operations at Chicago Fire FC. And before we get to Messi, I do want to talk just a little bit about some of the trend that we've seen with regards to Americans, U.S. folks, finally coming around to, I guess, what the rest of the world has already known for decades with regards to the popularity of soccer. A lot of people didn't think this was going to last. They thought this was just going to be a blip on the screen. What has created that sort of lasting impact on Americans to continue watching and continue going to games?
Yeah, thank you so much for having me. It's a great question. I think there's a couple things. One is definitely the movement of youth, right? I just heard a stat recently that soccer is outpacing, Little League baseball at 2-1. I think it's a great sport. My boys, I have a 5-year-old and a 3-year-old that play, and so I think that's probably where it starts. And then as more stars come up through academy programs and end up playing in MLS, homegrown talent, and then also stars coming from overseas, I think that has all had an impact on the league.
There's been a lot of money pouring, of course, into the league and into teams themselves as investors now sort of want a piece of the action here. There's been a lot of talk about valuations. The last time I checked, the Fire had something like $500+ million valuation, which is astonishing given where MLS teams were valued just, I don't know, less than 10 years ago here. What are some of the investments that you have been entertaining right now specifically into your franchise?
It's a good question. I think we have a world-class owner in Joe Mansueto who invests really heavily in our club. So currently we're in the midst of building a $100 million performance center here in Chicago. That is probably first and foremost, right? I think anytime you're investing in your players, in your on-field or on-pitch talent, data, analytics, nutrition, those are all things that will impact play on the field. We also invest really heavily in the city and have a really robust community relations department that runs a youth sports program, some of which is nonprofit, some of which is pay to play. And so to your point, as revenues continue to grow across the league, those are all some of the areas that our club is investing in.
And Dave, you made a really interesting point about youth participation. And I mean, speaking anecdotally, I feel like every kid that I grew up with played soccer at some point. When you think about the pipeline of how to grow soccer in the U.S. and maybe become one of the big sports, maybe overtake hockey, how do you do that? How do you continue that momentum from everyone playing soccer at the youth level into paying attention as adults to the professional level?
It's a good question. I played small college basketball. I'm 6'5", 6'6", so for me, I always was sort of geared more towards a sport like basketball where my height helped. But one of the things that is really unique about soccer is the academy program, which is where you're identifying 13, 14, 15-year-olds and getting them as part of your club early, and then being able to sign them to homegrown contracts where, some of the stars of our team are maybe 18, 19, 20 years old. So I think about, my own world where maybe I was in high school and I was trying to get ready to go play college basketball. Soccer is so different where you're able to take young players and kind of get them into your system early, and there's not necessarily the need to go to college. Obviously, a lot of MLS players do play in college and eventually make it to a senior team. But I think when I think about how youth are growing, that's definitely one of the areas where MLS excels.
And when we think about the Messi experiment and how that's really drawn a lot of eyeballs, American eyeballs to soccer, maybe in a way that it hadn't been in the past, have you considered at the Chicago Fire bringing in a star player from outside as well?
Sure. Well, congrats to everyone in Miami for the Moss brothers and David Beckham to get Messi to MLS. It's obviously having a profound effect, not just on Miami and their business and their fans, but really across the league. It's a good example of a rising tides lift all boats. And, I think across the league, you're seeing more and more stars join. This is truly becoming a league of choice here in Chicago. We have Xherdan Shaqiri, who is, a Swiss star and has had a lot of success in World Cups in the past and has helped our business over the last couple of years. And I definitely think, though, that all teams are probably going through some type of cost-benefit analysis on the business side while they work with their sporting directors to see what other global talent is out there that would be interested in joining the MLS. And to your point, we're really excited to have Inter Miami come to Chicago here on October 4th.
I am curious. They come to Chicago. They play at what used to be a great stadium. I grew up there. And until they put that UFO thing in the middle of it. There's been a lot of talk now about the future of Soldier Field. And, of course, we know the football team is looking for greener pastures here. Do you think the MLS will stay in the city, within city limits?
Here in Chicago? Yeah, I think. Fire. Yeah, I think so. We have a good relationship with the Parks District here in Chicago, and we have a lease that extends out a while with several options to continue to play at Soldier Field. So we're obviously keeping an eye on the Bears and what happens over there. I have a good relationship with their team president, Kevin Warren, and so it'll be interesting to see, how that plays out for them, and everyone sort of has to do what's in the best interest of their own team. But we're watching it really closely, and we're honored to be in Chicago right now.
All right, and of course, a lot of people will be watching in about 2 weeks' time, of course, when the biggest star in the league sets foot on that pitch. Dave Baldwin there, the president of business operations for Chicago Fire FC. And speaking of, and we're going to have a lot more coming up here. Stick with us. We'll be back in a moment. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
Pivotal week for U.S. equity markets, of course, driven by what we saw in U.S. Treasury markets. And that tail was, of course, wagged by the dog over at the Fed. Interesting outflows that we've been seeing in the equity space. The latest data out of Bank of America, their fund and their read on fund flows showed about $17 billion coming out of global equities in the week through Wednesday. So basically up through that Fed meeting here. It'll be interesting to see what that data looks like in a week, but the damage was done. Fractional losses here on the day, but on the week down across the board. The Russell 2000, an underperformer once again relative to the S&P and the NASDAQ, down for a third straight week, but really no one was spared. The S&P having its worst week going back to March, and a key break below some of the key moving averages, including that 100-day for the NASDAQ 100. The spike up in crude oil did moderate just a little bit, but still camped out above 90, And now, of course, everybody keeping a close eye on yields. A 10-year yield that traded above 4.5% at one point in the session today, pulling back just a little bit here on this Friday. But that's how we close out the week. It's a big setup heading into next week, where the catalysts are few and far in between.
Let's focus now on some of the labor issues in this country, particularly when it comes to the auto workers, because another 5,600 workers are striking at GM and Stellantis plants around the country. Now, this morning, UAW President Shawn Fain suggested progress has been made with Ford, but of course, all sides remain still far apart on a deal. For more, let's bring in Bloomberg Detroit Bureau Chief David Welch. He joins us now. And David, of course, it seems like some progress being made with Ford, but when it comes to GM, when it comes to Stellantis, what could this weekend look like?
Well, you'll see a bunch of more workers walking out at these parts and service plants. These plants, basically, they're really like warehouses. They send out repair parts to dealerships. And look, some dealers could be running short of parts really quickly as a result of that, because there were already shortages of some parts going back the past couple of years with some of the supply chain issues that have been out there. So that'll be starting. From the negotiating standpoint, I think the sides will be back at the table talking. And the big issues on the Stellantis bargaining table, we're talking about job security. There's the plant in Belvidere, Illinois, where the union wants a new vehicle to be put in there. And there's some other plants, too, where they want guarantees that there will be products that the workers can build for the life of the agreement. In the case of GM, it's a little bit different. They want this cost of living allowance, COLA, which gives them basically whatever the rate of inflation is. Workers would get that pay raise in addition. And they want paid time off, and they want fewer temp workers to cover it, which would make GM probably hire some more workers. So those are the big issues hanging out there for each company.
I'm curious about sort of the political football that this has the potential to become. We had learned earlier this week that former President Donald Trump is planning to show up at some point in Michigan on Wednesday, the day of a GOP debate that he's missing. And we're now learning from the Washington Post that President Biden plans to meet with UAW auto workers in Michigan on Tuesday of next week.
That's right. Look, auto workers in a swing state like Michigan, that's a big voter chunk. And Trump got more UAW workers to vote for him than Republicans traditionally have. It was usually, say, roughly 3/4 of UAW members would vote for the Democrats. That changed a bit in the first election, Trump and Hillary Clinton. There are some estimates saying that as many as 40% of UAW workers vote for Trump because they feel like the Democrats have kind of taken them for granted for years without really doing much for union workers. And certainly Trump has reached out to them with, editing NAFTA, turning it into USMCA. He kind of made it sound like he was protecting jobs for them. And so he does have an appeal to some UAW members who are also, in some of them tend to be more socially conservative, so Trump appeals in that sense. So he'll be coming here looking for those jobs, or for those votes, and Biden is going to try to defend that voter base. Sean Fain has said that he has no interest in Trump and he would never endorse him. So the union leadership is pro-Biden, at least when it comes to voting. They haven't endorsed him yet either, but they don't like Trump. So that's the football. It's in the air.
Yeah, it's certainly a big football here. And as we wait to see if there's any progress on those negotiations, David Welch out in Detroit here, a look at the auto workers strike. Let's go out to L.A., to Hollywood, where that strike, two strikes going on with the Writers Guild and, of course, the Actors Union. The latest news here is that progress being made on the writers' strike, which, of course, began about 5 months ago. Lucas Shaw joining us right now from our Los Angeles Bureau, or from Los Angeles. Give us a sense here, Lucas, as to what's on the table right now and whether it seems amenable to both sides.
Well, the two sides have traded proposals this week. The studios made a new offer on Wednesday. The writers countered on Thursday. They continue to negotiate today. And, we don't really know how this is going to turn out. A lot of the people involved in the process have expressed optimism. The fact that they're talking 3 days in a row is a really good sign. That hasn't happened. They may talk again on Monday, although that is a Jewish holiday. They're still arguing over things like the minimum number of writers in a room, how AI is used, data transparency. There are a number of hurdles to overcome, but the good news is that they're still talking.
Well, to that point, again, there are still plenty of distance between the two sides, but progress being made when it comes to the writers. The fact that they are talking, that there is progress, does that put pressure on the actors?
Not really. I mean, there'll be pressure on the actors if they do a deal with the writers, but the studios made a conscious decision to try to get a deal with the writers first. There had been some discussion at the highest levels of these studios about going to the actors when they were frustrated with the writers. They felt like they just weren't making enough progress, but they came to the conclusion, I think, that they needed to get a deal done with the writers first, and then they'd move on to the actors. Keep in mind that the writers went on strike a couple of months before the actors.
All right, Lucas, really appreciate your reporting. I'm sure we'll be checking in with you very soon. Let's keep this conversation going now on how these strikes may be impacting the U.S. economy with Gregory Dacko. He is chief economist over at EY, and we've been talking about basically that this isn't just specified to one specific industry. This is happening across the economy. When does this go from idiosyncratic company industry level strikes into something that would show up in the data?
I think we're already starting to show it, to see it in the data. We're starting to see the effects of an environment that is quite tight when it comes to the labor market, where labor has a little bit more bargaining power, and that bargaining power is being put to use with more strikes, requesting higher pay, better terms in terms of conditions, and that's being reflected across a number of industries. I think we have to be aware of the fact that these strikes can have an impact on the broad economy in a context where we're seeing other headwinds. We're seeing headwinds from still elevated prices, elevated interest rates, the risk of a government shutdown, the resumption of student debt payments. All those risks combined with the drag from strikes across a number of sectors can become a significant headwind for the U.S. economy.
Well, if you think about the things that are outside of the Federal Reserve's control, obviously strikes are as well. But if you think about how the Fed could have to manage some of these pressures, particularly when it comes to wage growth, for example, what could this mean for the path forward for the Fed?
Well, I think we've seen that the Fed is finally convincing investors, finally convincing business leaders and consumers that the higher rate environment is here to stay. We have seen over the last few days an acknowledgement, start of an acceptance, and then eventually a move towards realizing that this higher cost of capital environment is here to stay. That is being reflected in long-term yield. And we've seen this new narrative, this new paradigm where interest rates are likely to remain higher for the foreseeable future. We have to also acknowledge the fact that in this higher cost of capital environment, while this will be a deterrent to economic activity in the short run, it may also eventually lead to sounder business decisions, more discretion when it comes to what type of investment decisions are made. And eventually, if we end up in an environment where easing final demand, a rebalancing of the labor market help ease inflation pressures, we end up in an environment where the Fed is able to recalibrate monetary policy to the downside and lead to a less restrictive monetary policy stance. So it's right now a bit difficult on the economy, but over time, I think it will be something that is positive for the economy and for growth overall.
Yeah, certainly they're addressing, I think, some longer-term structural issues. Rather, this isn't just about pay itself. There are obviously much bigger issues, whether you're talking about what the Hollywood writers and actors are talking about with AI, and of course with what's going on with the UAW and their concerns about what type of staffing is needed for a new EV world. Try to assess the potential economic fallout if these strikes continue, because everyone looks at it specifically from the perspective of the output of these cars or the output of movies and the jobs lost. But there's a whole ecosystem built around all of these industries that may not be directly related to these unions, these people. But, you know, like I said, if the Hollywood writers strike, then, you know, there's no caterer to, provide food. If the auto workers go on strike, a lot of the ancillary services that service those businesses also are effectively shut down.
I think that speaks to the fact that what we are seeing across the economy right now is really a multi-speed type of environment. We are seeing some sectors that are doing relatively well, some sectors that are lagging. And these types of idiosyncratic shocks across different sectors of the economy, whether it's strikes on the auto union workers front, on the writers front down in LA, or on the actors front, those are strikes that have a direct impact in terms of the people that are being affected, but also in terms of all the industries that are indirectly impacted, or even the induced impact in terms of less spending. That is also the case when we talk about the risk of a government shutdown at the end of the month. Yeah. It's not just about the risk of furloughed workers, it's all of the other dependent industries that can be affected. And that's really the real risk for the economy right now. It's the combination of these headwinds that could lead to slower growth in the fourth quarter.
I am curious here about how you sort of model some of these labor actions and the idea that they've already gone up. I mean, Cornell University has this great labor tracker. I think it's something like a 50% jump in labor activity last year. And they haven't released the numbers for 2023, but I think we all know it's going to be much higher than what it was in 2022. But there are a lot of people saying that we'll probably see this for the next few years, that there is sort of an inflection point here of labor activity. And I would think that's hard to sort of create a more hard sort of scientific, model to say how this is going to affect things.
I mean, we can calculate the direct impact, the indirect impact, and the induced impact from these strikes. We know that there are going to be some workers that are not going to be paid, that are not going to essentially be able to spend as much as they would in traditional times. We estimate that for every week of a full strike of the auto union workers, 140,000 workers, which is currently not the case. We currently have about 13,000 workers on strike. But if all of these workers go on strike, every week of strike costs the economy about 0.1 percentage points of GDP growth. Not much when you think about just 1 week. But if you think about 2 weeks, 3 weeks, 4 weeks, then it starts to become a real headwind. And as I mentioned, if you combine that with an environment where consumers now have to repay their student loans, where the risk of a government shutdown is also a 10th on GDP growth per week, if you combine that with an environment in which people are being more sensitive to a higher price environment, to a higher interest rate environment with short-term and long-term interest rates on the rise, those become headwinds for the economy that could lead to a stumble in the fourth quarter and the early part of 2024. That's what we're paying close attention to.
All right, Greg, gonna have to leave it there. Greg Dacco over at EY, a look here at the potential economic implications from the labor strikes out there. And we're going to continue our full coverage of this now summer of strifes turning into an autumn of strife, a labor strife as well. A conversation with Steve Ratner, Willett Advisors chairman and CEO, about whether he believes there's a way out of the deadlock between the UAW and the automakers. Going to get some great insights, particularly given his involvement in the GM bailout just a few years back. That conversation coming up in just a second. This is Bloomberg.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Welcome back to The Close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joining us as he does every day at this time. And we want to continue our extended coverage of what's going on in the labor space here. Of course, strikes in Hollywood, strikes in the LNG space, and of course, obviously, the big auto workers strike going on right now.
Yeah, we'll move from Hollywood, would you cover over to Detroit? Because obviously there was a big development today as they announced expanded strikes for Stellantis as well as for General Motors, with Ford getting a pass at least for now. And we sat down actually with Stephen Ratner. He, as you know, supervised the restructuring of the auto industry under President Obama. He was there when they really created some of the things that the UAW is complaining about now. And we asked him just how bad this is. This is Stephen Ratner. He's the chair of Willett Advisors. They invest the philanthropic and personal assets of Michael R. Bloomberg, our founder and majority shareholder.
It does certainly look tougher than I've ever seen in any of these contract negotiations. First of all, the UAW's demands are, even by the standard of opening demands, pretty extreme. Secondly, they're conducting this negotiation largely in public, which makes it harder for the union in particular to back off their positions if and when they need to. But all that said, there's never been a strike that I know of that hasn't gotten resolved one way or another, and it's not hard to see a resolution here, but I think the mood is that it's going to take a good while.
You have written in the New York Times that you certainly can understand why there needs to be more wages for auto workers. They've lagged behind for various reasons, inflation, but also the contract that they had. At the same time, it's about more than just money, is it not? Because the auto workers say you're going to electric vehicles, which will require fewer of us. And on the other side, the auto industry says we have to go to electric vehicles or we're not going to be in business anymore.
Look, the classic Harvard Business School case is that a company or an industry that tries to protect an old business model when there's a new one coming ends up failing. If the Detroit companies want to be competitive, if we as a country want to have a viable domestic auto industry, and by the way, it is the government's policy to encourage electric vehicles, then we have to welcome this change, and there will be displacements, and we have to deal with those.
I guess I'm asking, how much of this do you think in the end is about money? How much of a raise people get, because everyone agrees they're going to get a significant raise, and how much of it is more fundamental things about the way the companies actually run their businesses?
I think it's mostly about money or money-related things. I think, yes, there's a lot of concern about the future number of jobs and so on and so forth, but I'm sympathetic to the union in the sense that if you look at the last 15 years, auto workers as a whole in this country have basically stayed flat after inflation, whereas other workers have gotten some after inflation real income increases, and there are good reasons for There are reasons for that, which is the fundamental competitiveness of the auto industry on a global scale. But nonetheless, in a world of 3.8% unemployment and 1.5 jobs for every American, I can understand why these workers feel like it's time for them to get a bigger share.
Last week, President Biden weighed in on the issue. and at least to my hearing, weighed in pretty heavily on the UAW side, saying there had been record profits out of the car industries and there should be a record deal, I think he called it basically. Is he making the situation better or worse? In the port situation, I don't recall him weighing in that heavily on the worker side.
I think that's fair. I think we are closer to an election. I think we're talking about the Midwest, which are swing states. I don't think California is ever going to be a swing state. But I have to say, I don't think it's overly helpful for him to put his finger on the scale. Look, the politics are what they are, and I get that. But this is a tough situation, and I think there are equities on both sides.
Whenever we have a very large conflict like this, in my experience at least, there are unintended consequences. There are the principal players and who does well and who doesn't, but there are people around the side. I can think of people like Tesla, other automakers around the world, certain states, their right-to-work states. What are the unintended consequences, you think, perhaps, of this dispute?
Look, the unintended consequences are what happens to the number of jobs, not the price paid for each job. The yin and the yang of this, and it's a tough one, is that the more the auto workers get paid, and I'm in favor of them getting paid more, the fewer jobs they're going to be. That's just the inevitable result of this. If you look, for example, back since 2009 at the number of jobs that have moved to Mexico and the fact that there are now more auto jobs in Mexico than there are in the United States, it tells you something about how capitalism and free enterprise works. It finds the lowest cost locale that can meet its needs.
Are there potential consequences for the transition to EVs? I mean, I think most people think we're going to make the transition, but could it slow it down?
I don't think on an overall basis it slows it down because there's so many players in the EV market. I think it affects who the winners and who the losers are. I think for the Detroit companies to be winners in EV, they need help from the unions. They need cooperation from the unions. And we'll have to see how that unfolds. But if the unions make it tougher for them to produce EVs on some economically rational basis, then the Detroit companies are going to end up being the losers in the EV race.
Tesla, thus far at least, is a winner. They do not have unions, as last I recall. In fact, President Biden has been somewhat critical of Tesla at various times for that very thing. Tesla already is doing pretty well, as far as I can tell, on EVs. Does this give them yet another head of steam?
Well, it's not just Tesla, remember. The automakers in the South, most of them foreign imports, transplants, Honda, Toyota, the German companies and so forth, they don't have unions either. And so it's not just Tesla, but yes, the cost differential, the more it becomes a differential, the better it is for Tesla, the worse it is for the Detroit companies. I do think it is fair to say, though, that labor costs are not the biggest cost of a car. I mean, they're 4, 5, 6%, depending upon whose numbers you believe. But these are also companies that operate in very thin profit margins, and so you do still have to be careful. But I don't think this contract necessarily is going to determine the future of EVs among the Detroit companies.
That was Stephen Ratner. He's Willett Advisors chairman and CEO. And you heard him there say this is the hardest he's ever seen it be. Yeah. But it's really important to remember this is not a closed system. There are other players like Tesla, like some of the other automakers, right-to-work states, and Mexico. Right. So it's not just a matter of who gets the money. It's actually whether they have the jobs.
Right. And, of course, even some of the automakers that have large union populations also have some non-union workers as well that they have to deal with. Yeah. I'm interested in the potential political football that this could become. We just learned a few minutes ago that the president, Joe Biden, is scheduled to make an appearance with the UAW in Michigan on Tuesday, which, I don't know, coincidentally happens to be the day before former President Donald Trump had scheduled a meeting up there as well.
Who Donald Trump really courted the United Auto Workers. And if you recall, there was something of a fight for Michigan back in 2016, and Donald Trump won Michigan back then. So it's terribly important to President Biden if he's going to hold on to his job.
Yeah, very important stuff, David.
So we'll also hear from Larry Summers. He'll comment on this strike, but also on the Fed. He thinks they're being a bit too optimistic. We're also going to hear from Jose Minaya. He is the head of Nuveen. They've got $1.3 trillion they're responsible for. And are they really backing off of ESG, as we've heard about some outfits? That's coming up at 6 p.m. in New York time.
Yeah, definitely tune in for that. It'll be a great way to wrap up a very wild week in U.S. equity markets, in global markets, to be sure, with 12 big rate decisions that we had this week. Big question is what's going to happen next week. We're going to set you up for what to watch after the break. This is Bloomberg.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
A push ahead to some of the big market catalysts next week, including U.S. new home sales data on Tuesday.
But what I'm really excited about is what we're going to get on Thursday. Just skipping ahead because we got PCE. We're expected to see core cool, but headline heat up a little bit.
Core cool. We're also going to get a lot of Fed speak now that that lockup is over. We're going to hear from Powell, Kashkari, Austin Goolsbee, Cook, Barkin, and Williams. Thanks for tuning in to us this week on The Close. We'll be back next week. Balance of Power is up next.